एवरीवन, गुड मॉर्निंग, गुड आफ्टरनून, गुड इवनिंग टू ऑल ऑफ यू। वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का सेशन। फिलहाल के देखोगे 12:30 होने वाला है। लंदन सेशन इज गोइंग टू ओपन। क्रूड ऑयल हल्का सा गैप डाउन हुआ था, साइडवेज चल रहा है। नेचुरल गैस भी रेंज के अंदर ही है। कल फेड का रेट कट का डिसीजन आया था एज एक्सपेक्टेड। उतना ही रेट कट किया जितना फोरकास्ट था। लग रहा था ज़्यादा करेंगे बट नहीं किया। 4.25 फोरकास्ट था, उतना ही किया। उस वजह से मार्केट पे भी देखोगे तो इतना कुछ खास इम्पैक्ट वो देखने के लिए नहीं मिला। इवन दो हमारा जो बैंक निफ्टी गिफ्ट निफ्टी था, हल्का सा ऊपर चला गया था, तो उस वजह से बैंक निफ्टी और निफ्टी एक पॉजिटिव ओपनिंग देखने के लिए मिली थी, गैप अप। उसके बाद से रेंज के अंदर ही चल रहे हैं दोनों के दोनों, निफ्टी भी और बैंक निफ्टी भी। एंड कल जब न्यूज आई थी उसके बाद जो गोल्ड है, मैं फॉरेक्स की बात करूं क्योंकि हमारा मार्केट तो बंद हो गया था, तो मार्केट ने भी कुछ खास लिया नहीं उसे, यू नो, हाई लेवल से, क्योंकि रेट कट वी आर एक्सपेक्टिंग कि अराउंड 50 बेसिस पॉइंट या उससे ज़्यादा हो तो बेटर है, बट अगेन ओनली 25 बेसिस पॉइंट। आगे के लिए भी उन्होंने फेड के चेयरमैन जो है पवल, उन्होंने यही कहा है कि आगे भी जो रेट कट है वो चांसेस कम ही है कि हम करेंगे, अनटिल अनलेस वहाँ पर कोई चेंज नहीं हो जाता। तो दैट इज़ द इशू। उसकी वजह से मार्केट ने इसको पॉजिटिवली लिया नहीं। गोल्ड में वापस एक फॉल देखने के लिए मिला था। मैंने कल ही बताया था, अगर रेट कट 25 बेसिस पॉइंट से ज़्यादा होगा तभी गोल्ड एक रैली कर सकता है वापस, नहीं तो करेक्शन देखने के लिए वापस मिल जाएगा। तो वापस थोड़ा बहुत प्रॉफिट बुकिंग आ गई मार्केट में। तो वो एक सिनेरियो था। आज की अगर डेटा की बात करें, 12:30 लंदन सेशन की ओपनिंग, फिर शाम को 5:30 न्यूयॉर्क सेशन की ओपनिंग, एंड देन 6 पीएम पे अनएम्प्लॉयमेंट क्लेम्स और फिलाडेल्फिया फेड मैन्युफैक्चरिंग इंडेक्स का डेटा। ये गोल्ड और सिल्वर को इम्पैक्ट करता है। 8 बजे नेचुरल गैस की इन्वेंट्री और 7 बजे यूएस मार्केट की ओपनिंग। फोरकास्ट नेचुरल गैस की इन्वेंट्री का लास्ट टाइम 71 था, इस बार 80 है। लास्ट टाइम से ज़्यादा एक्सपेक्ट कर रहे हैं, तो अगर फोरकास्ट के अकॉर्डिंग 80 बिलियन से ज़्यादा आता है तो इट इज़ नेगेटिव फॉर प्राइस। प्राइस को और गिरना चाहिए। लेट्स सी क्या प्लान कर सकते हैं। कल अच्छा मोमेंटम आया था एक सेलिंग में नेचुरल गैस में, उसके बाद तो क्लोजिंग हो गई थी। तो देखते हैं अभी कुछ ट्रेड बनता है तो इन क्रूड ऑयल एंड नेचुरल गैस। जिन लोगों ने लाइक नहीं किया, डोंट फॉरगेट टू लाइक द स्ट्रीम एज वेल गाइस। फटाफट से लाइक कर सकते हैं। फिर देखते हैं ठीक है क्रूड ऑयल में क्या प्लान है। थोड़ा सा अगर नीचे आता है क्रूड ऑयल, एक प्लान करेंगे, नहीं तो लेट्स सी। बाकी एक्सपायरी हो गई है तो मैं यहाँ पर चार्ट चेंज कर रहा हूँ, तो ध्यान रखना। फ्यूचर की एक्सपायरी नहीं हुई है, ऑप्शन की हो चुकी है, तो अभी करंट मंथ का फ्यूचर ट्रेड करके फ़ायदा नहीं है, क्योंकि मोस्ट ऑफ यू नेक्स्ट मंथ का ही, मोस्ट ऑफ यू क्या, सभी लोग नेक्स्ट मंथ का ही ट्रेड करेंगे प्लान, तो उस वजह से फिर नहीं तो इशू आ जाएगा थोड़ा बहुत। तो हम चेंज कर रहे हैं क्रूड ऑयल का जो चार्ट है वो। अभी तो सितंबर का ही चार्ट चल रहा है, 5620 625 के आसपास है, बट मैं अक्टूबर का लगा रहा हूँ यहाँ पे। ठीक है, अक्टूबर का लगाने के लिए कुछ नहीं करना है। अपने चार्ट में वन को रिमूव करके इसको टू कर दो। ठीक है, चेंज हो जाएगा। या फिर नीचे भी एक ऑप्शन आता है यहाँ पर ये, ठीक है, कॉन्ट्रैक्ट चेंज करने का, वहाँ से भी कर सकते हैं, कोई इशू नहीं है। ठीक है, तो थोड़ा सा आपको अलग प्राइस एक्शन देखने के लिए मिलेगा उस चार्ट में, बट कोई इशू नहीं है। ये अक्टूबर मंथ का चार्ट है क्रूड ऑयल का, तो उसी के बेसिस पे इसमें लेवल मेंशन करेंगे। ठीक है, तो कंफ्यूज मत करना कि लेवल चार्ट अलग क्यों दिख रहा है। अभी वैसे भी अक्टूबर मंथ का ही फ्यूचर ट्रेड हो रहा है। ओके, सो लेट्स सी, क्रूड को ही देख लेते हैं पहले एक बार। ब्रेक डाउन हो जाए तो बेटर है मेरे अकॉर्डिंग। क्रूड ऑयल नीचे 5599 के नीचे, 5006, 5599। यहाँ से बाइंग देखोगे ना, एक बार बाइंग आई थी, हाई बनाया था, फिर दूसरे बार लोअर हाई, फिर से उसी लेवल पे आके रुका हुआ है। ब्रेक डाउन अभी हुआ नहीं है, तो वी नीड, अब ब्रेक डाउन अगर हो जाए तो बेटर रहेगा बिलो 5599। वेट करते हैं, देखते हैं ब्रेक डाउन होता है या नहीं होता है, फिर कोई नया सपोर्ट क्रिएट कर देता है क्रूड। थोड़ा सा वॉल्यूम कम है इस चार्ट में। चार्ट की हालत कुछ खास तो लग नहीं रही है मुझे। ये अभी ब्रेक नहीं हुआ है नेचुरल गैस, सॉरी क्रूड ऑयल। बहुत ही कॉम्पैक्ट रेंज है क्रूड ऑयल में। वैसे देखा जाए तो बड़ी रेंज है बट कॉम्पैक्ट ही कहना पड़ेगा। 90 पॉइंट की रेंज है, मार्केट रेंज बाउंड है इस रेंज पे। ब्रेकडाउन हो जाता तो बेटर है, एक बार ऊपर भी आना तो है। वैसे इसको लगा देते हैं लेवल 12:30 के बाद, देखते हैं क्या मूवमेंट अप करता है या फिर नहीं। यहाँ पर अभी ये है करंटली, वहाँ पर भी सपोर्ट है। सपोर्ट का लोअर एंड अभी ब्रेक नहीं हुआ है, तो जब तक ब्रेक नहीं होगा ब्रेक डाउन भी नहीं मान सकते। कल वैसे ऑलरेडी बाइंग आ गई थी वहाँ से। ठीक है, मैं रेंज कह रहा हूँ तो ये कुछ ये हाल है यहाँ पर अभी। ठीक है, थोड़ा दूर का रेजिस्टेंस है, ये भी ठीक है। बाकी यहाँ से भी करेंगे सेल, बट हायर एंड पे अगर आता है तो। बाकी जिस लेवल पे अभी पड़ा हुआ है वो, इसके नीचे क्लोज कर देता तो ब्रेकडाउन मान लेते, बट वो हो नहीं रहा है अभी भी। तो ये रेंज है, टोटल देखोगे तो 90 पॉइंट मान सकते हो इसको। मॉर्निंग पे ओपन हुआ था, रिजेक्शन लिया, रेजिस्टेंस एरिया से नीचे आया है, लग रहा था ब्रेकडाउन करेगा, नहीं करा है अभी भी नेक्स्ट मंथ के चार्ट में। एक बार सेलिंग यहाँ से आई, दूसरी बार तीसरी बार एक बार ऊपर से भी ले ली इसने सेलिंग। सो क्रूड ऑयल है साइडवेज, थोड़ा ऊपर आएगा तो यहाँ सेल करेंगे हाई लेवल पे, अदरवाइज मत करना। बाकी यहाँ से बाइंग में रिस्क है, जाने को एक बार यहाँ तक जाना है प्राइस को, यहाँ से सेल प्लान करेंगे। यहाँ से बाई करते हो तो वही है, और रिस्की, कल ऑलरेडी बाइंग आ गई है, तो मेरे अकॉर्डिंग तो नहीं करना चाहिए अब। रेंज के अंदर है मार्केट अभी भी, जब तक ब्रेक डाउन नहीं होता। ये कुछ मान लो इसको। नीचे वाला सपोर्ट है, ठीक ठाक रेंज ब्रेक होने के बाद इन क्रूड ऑयल। यहाँ आ जाए तो यहाँ से बाई कर लेंगे, रेंज अगर ब्रेक हो जाती है, क्योंकि बहुत ही स्मॉल रेंज है, फ़ायदा नहीं है यहाँ पर ट्रेड करने का। ओके ठीक है, नीचे आ रहा है क्रूड ऑयल, बढ़िया है। देता है तो रेंज को डाउन साइड वाले लेवल से देखते हैं। कंजस्टेड चार्ट है इसका। अभी भी क्रूड ऑयल ब्रेक डाउन नहीं दे रहा है, देख रहे हो, रेंज को पकड़ के बैठा हुआ है। जो और सपोर्ट है वो इससे भी बड़ा है, वाह। यहाँ पूरा ही सपोर्ट जोन बने हुए हैं, इतना बड़ा। मतलब 5430 के नीचे जाना तो बहुत मुश्किल है प्राइस का। अपर लेवल पे देखें तो ऊपर जाना भी मुश्किल ही लग रहा है, जब तक ब्रेकआउट नहीं होता अपर लेवल पे यहाँ पर 5700 के ऊपर सस्टेन करना। तो इसके बीच में ही घूमना चाहिए इसे मोस्टली। ऊपर जाके सेलिंग आता तो बेटर था। नेचुरल गैस को देख लेते हैं। क्रूड ऑयल तो बहुत ही ज़्यादा बड़ी रेंज के अंदर है, मज़ा नहीं आएगा ट्रेड करने में। ओके, नेचुरल गैस में देखोगे तो ये भी एक लोअर एंड के आसपास एक रेंज के अंदर है। इस रेंज को ब्रेक करेगा तभी थोड़ा सा ऊपर या फिर नीचे ब्रेक डाउन के लिए जा सकता है, अदरवाइज these levels are still good support and resistance in natural gas। बाकी क्रूड ऑयल में कोई ट्रेड नहीं है, रेंज के अंदर चल रहा है, यहाँ पर बाइंग के लिए इंटरेस्टेड नहीं हूँ मैं। ऑलरेडी बाइंग बहुत आ गई है यहाँ से। एक बार ऊपर जाना तो है बट नॉट ओवर हियर। सपोर्ट बनाएगा तो अलग बात है, अदरवाइज नहीं।
News when you want it with Bloomberg News Now. I'm Caroline Hepker.
Federal Reserve Chair Jerome Powell has rallied his committee of policymakers to back the central bank's first interest rate cut of the year. The quarter-point reduction came after a significant slowdown in job growth and an unprecedented push by the White House for much lower rates. But with the effects of tariffs on inflation still uncertain, Powell made clear that Fed officials will face difficult trade-offs in the coming months as they consider whether to keep cutting.
You could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
The decision to cut rates was nearly unanimous, with the lone dissents coming from Fed Governor Stephen Miron, a close ally of Donald Trump, who favored a larger reduction. Fed Governors Christopher Waller and Michelle Bowman, who dissented in July in favor of a rate cut, supported this move.
The Bank of England is expected to rein in its quantitative tightening programme today amid concerns that its gilt sales are worsening volatility in the bond market. Economists and investors are expecting the bank's Monetary Policy Committee to slow the speed at which it reduces its holdings of government bonds to £70 billion per year, down from £100 billion. Officials may also decide to sell fewer long-dated gilts. The bank will announce the changes alongside its interest rate decision today, which is widely expected to see interest rates held at 4% amid continued high inflation.
Britain's King Charles praised U.S. President Donald Trump's efforts to support Ukraine against tyranny after a day of lavish celebrations in honor of the U.S.-UK special relationship. The monarch underlined the strength of the ties between the two countries in his speech at the state banquet.
In 2 world wars, we fought together to defeat the forces of tyranny. Today, as tyranny once again threatens Europe, we and our allies stand together in support of Ukraine to deter aggression and secure peace.
King Charles's comments on Ukraine came after a day of royal spectacle. The two heads of state inspected troops, rode in a horse-drawn carriage, and laid a wreath for the late Queen Elizabeth. This is the response from the U.S. president.
This is truly one of the highest honors of my life. Such respect for you and such respect for your country. For many decades, His Majesty the King has epitomized the fortitude, nobility, and the spirit of the British monarchy and the British people.
Donald Trump speaking at the state banquet in Windsor Castle. In diplomatic talks later today, the Prime Minister Keir Starmer hopes to press Trump on trade terms and the war in Ukraine, although major breakthroughs are not expected. The Prime Minister will do so without his top ambassador, who he fired last week for his ties to the late Jeffrey Epstein. The visit is also a chance to sign investment deals, with the British government announcing American companies were planning £150 billion in investments to coincide with the occasion.
Now, Disney is taking Jimmy Kimmel's talk show off-air indefinitely amid a backlash to remarks that he made about the killing of Republican activist Charlie Kirk. The comments, which focused on the response of the MAGA movement to Kirk's killing, angered many right-wing commentators and brought criticism from members of the Trump administration. Following that, the head of the US broadcast regulator, Brendan Carr, told podcast host Benny Johnson there was a strong case to punish Kimmel and Disney.
From the moment that I have become chairman of the FCC, I want to reinvigorate the public interest in. What people don't understand is that the broadcasters, and you've gotten this right, are entirely different than people that use other forms of communication. They have a license granted by us at the FCC, and that comes with it an obligation to operate in the public interest.
That was FCC Chair Brendan Carr speaking on The Benny Show. Disney's ABC network took Kimmel's show off air after Nexstar Media, which owns dozens of affiliate stations in the US, said that it would pull the programme indefinitely from its schedules over the remarks, which it said were, quote, offensive and insensitive. In a statement, the Writers Guild of America criticised the move, saying, quote, if free speech applied only to ideas we like, we needn't have bothered to write it into the Constitution.
And Meta wants to turn its smart glasses into a must-have product with a new model boasting built-in screens. The social media giant is rebranding the product as AI glasses with a price tag of $799. Meta CEO Mark Zuckerberg says he is bringing superintelligence to consumer electronics.
This is going to be the most important technology in our lifetimes. AI should serve people, not just be something that sits in a data center automating large parts of society. So we design our glasses to be able to empower people with new capabilities as soon as they become possible.
Zuckerberg was speaking at Meta's annual event to showcase new technology. The company is hoping the new display glasses will be a stepping stone to full augmented reality glasses.
That's news when you want it with Bloomberg News Now. I'm Caroline Hepker, and this is Bloomberg.
I got to ask about the handle story that Bloomberg wrote about. The door handles are flat on Teslas and the interior buttons are electric. I was recently stuck in a Corvette, which has the same kind of thing, until somebody at the parking garage pointed out that I could find the emergency latch. You have a similar system. Yes. NHTSA's looking into this now. Apparently Beijing is looking into it. Have you considered a redesign or a fix for these issues?
We actually have a mechanical release that's, basically right at the electronic one too, and we're combining the two. So, in the moment that you're in a panic situation, the muscle memory to go to, what is right there. So you just pull a little bit further on the lever and you have the mechanical release. So that's something that we're working on, yeah. And it's in the cars now.
All right, so if there is then a China ban, you're ready to roll that out so that
we're working on
actually the ban, I guess the Chinese issue is the flat outer door handle. So would you do something? Would you make a change like Ferraris have that little crease you can reach into? Is there some idea about that on the outside?
Yeah, we're working on it right now and just looking at the details of the regulation, if and when that happens, and we'll have a really good solution for that. I'm not worried about that.
It makes sense. I know it's one thing for us adults to know that, but for kids, it's a little bit different to expect a kid to know how to go for a manual release.
Yeah, so the idea of combining the electronic one and the manual one together into one button, I think, makes a lot of sense. It really helps to, the muscle memory of reaching for something every day is there. And so you intuitively just grab the same thing and you're free.
Well, this is all centered on comments made by Kimmel, which focused on the response of the Trump-supporting MAGA movement to political activist Charlie Kirk's killing in Utah. And actually, for Disney, it's not really the first time they've been landed in hot water over this sort of political commentary. Actually, last year, they had to pay $15 million to settle a defamation lawsuit that was brought by President Donald Trump over comments made by their host, George Stephanopoulos. And they made this decision to suspend the show, Jimmy Kimmel Live, just minutes after Nexstar Media Group, which is one of the biggest owners of TV shows in the US, said it would pull the show indefinitely from all of its statements over those remarks that they said were offensive and insensitive. Up until that point, though, sources who spoke to Bloomberg say the show was planned to go ahead and that Kimmel was set to address the backlash on Wednesday's episode, which he had rehearsed that morning. But, I mean, for Disney, this is a big deal. Kimmel is one of their biggest stars. Last month, despite a drop in ratings, his show still attracted over 1.1 million viewers. And for ABC, it's their longest-running late-night talk show. It's been going since 2003, and now it's off the air indefinitely, according to an ABC spokesperson. So a major blow.
Yeah, I mean, Kimmel was effectively trying to say that he thought the Republicans were using the killing to try to bolster their own political case, effectively. What's been the reaction to all of that?
Well, from the broadcast and entertainment industry, the reaction has been quite negative. The BBC is reporting that the Writers Guild of America, Hollywood's labour union, has condemned this decision. They said it's a violation of constitutional free speech rights. And similarly, SAG-AFTRA, another actors union, has said the move was the type of suppression and retaliation that endangers everyone's freedoms. But conversely, the Trump camp, on the other hand, is positive about this move. President Trump saying it's great news for America on social media and congratulating ABC for its courage. I mean, it's definitely an interesting time for late night TV as a whole. This is coming 2 months after the cancellation of Stephen Colbert's show. And also in other posts on social media, President Trump went on to take aim at the rest of the industry, also criticising other late night hosts, Jimmy Fallon and Seth Meyers. So a very interesting and perhaps controversial time for the broader industry.
What about the network ABC? What have they said about all of this?
Well, they have left the suspension open-ended, calling it indefinite through their spokesperson. But apart from that, we don't have much more detail. Actually, Nexstar Media Group, who own a number of their affiliates, have been far more prescriptive in their judgment on the situation. They say they strongly object to the comments and also acknowledge the timing of them, saying they were particularly insensitive at a critical time for national political discourse. So that's what we have at the moment. Questions still around about the future of Jimmy Kimmel at the broadcaster ABC and whether or not his tenure will continue as well as that of his show.
Today, the focus switching from the King, arguably, to the Prime Minister, Keir Starmer, who's going to be spending a lot of time with President Trump, and then there will be the press conference.
Yes, from pageantry to business, Tom. And round that state banquet table, you also had the biggest names of Wall Street and Silicon Valley. And the hope is that now they've been wined and dined, they're going to open their wallets and unleash the investment on the UK. Keir Starmer's administration telling us that they're going to have a record £150 billion worth of investment in the UK unveiled during this visit. That'll create 7,600 jobs. And this really comes at a time when the UK's economic growth needs that sort of investment. Now, also up for discussion will be the terms of the trade deal. You remember Donald Trump, as he was getting on Air Force One, saying that there was a bit of room to negotiate. We'll see what that actually means. And the King there pushing on Ukraine and on the environment as well. What I don't expect to see, though, Tom, are any major breakthroughs when it comes to geopolitics or trade, or to see Keir Starmer pressing on the issue of the Middle East. In fact, the Times of London reporting that he is going to formally recognise Palestine as a state, but not until the weekend. So after Trump has departed, but before the UN General Assembly meeting in New York next week. Clearly the idea being to avoid a diplomatic incident, but it could still dominate the press conference later on. That and the issue of Jeffrey Epstein, of course, the disgraced deceased financier over whom the Prime Minister has lost his UK ambassador to Washington. And if you were to look at the protests outside that were here yesterday, Palestine and Epstein would be the top issues to come up at the press conference.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. The labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. We did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. I think you could think of this in a way as a risk management cut. Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller.
Michael, I always look at the Bloomberg financial conditions chart. You can look at a number of others. Citi has one as well that's popular. But these conditions do not seem restrictive at all. The dip that you see there on that chart is obviously Liberation Day, but we've come bouncing back from that. Does the Fed have to cut, or does the Fed maybe just want to cut?
A great question, and it's great to be on with you guys. Look, I mean, credit markets are extremely bullish at this point. And you could argue that, well, part of that is that we have multiple rate cuts priced in. But if you go back to 1 year ago, when the Fed went into that September meeting and cut by 50 basis points, financial conditions, credit market conditions are actually easier now than they were 1 year ago. And inflation on a 3-month annualized basis was very close to 2% a year ago. Now we're closer to 3%. So you have easier financial conditions and higher inflation today than you did a year ago. And so in my opinion, I actually think the case is less persuasive for the Fed. Certainly 50, I think, would be totally inappropriate, but even 25, I think that they could end up delivering a message today that disappoints markets a bit if they don't flame those expectations, which are for rates to fall 140 basis points or so over the next 12 months. That seems a bit steep considering the financial backdrop here.
Connecting the dot between what's at stake and what is possible.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, Romaine Bostic here with The Close, kicking you off to the closing bells here in New York, just 10 minutes away and just a little more than an hour removed from the U.S. Federal Open Market Committee voting 11-1 to cut the target rate for the federal funds rate by 0.25 percentage point to 4% to 4.25%. This after holding rates steady for 5 straight meetings this year. The initial market reaction to the 2 p.m. Fed statement was a bit of a risk-on rally that briefly pushed the Russell 2000 above an all-time high that it hasn't broken since 2021. Rate-sensitive assets like banks, like home builders, like gold all pushed higher as well, though they did reverse some of those gains, yields, crypto, and the dollar dipping. But once Jay Powell got to the press conference and outlined the potential risk ahead and the tension between its 2 mandates in bolstering the labor market while tamping down inflation, the price action flipped a bit. Jay Powell trying to explain, well, I'll just let him explain it himself.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. The labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. We did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. I think you could think of this in a way as a risk management cut. Inflation, we continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller.
Jay Powell was the man of the hour as we kick you off to the close. Ken Shinoda joins us here in Studio 2, portfolio manager at Double Line Capital. And Ken, I want to focus first on the use of the word risk management, the phrase risk management, as a way to characterize what happened today. What do you think he meant by that?
Yeah, I was really keen on that word because the bulls were hoping for more dovish language out of him. The bears, maybe those who wanted to short bonds, were hoping for some hawkish rhetoric. And I think he picked that risk management word because this is a cut, but we don't know what's going to come as far as the data, and we need to go meeting by meeting and be data dependent. So he's keeping that data dependent way that the Fed has been acting.
Are you surprised by that?
I think that he does not want to make the mistakes that other Fed chairmen have made in the past by cutting too soon. And so he's really keen on keeping rates where they are, staying restrictive until he's really sure that the inflation is contained. But he's definitely concerned about the labor market. We've had some weaker non-farm payrolls, and that's what he was focusing on in that at the end there.
Well, in your role in the money you manage, and more particularly the types of assets you manage, what's more of a concern for you right now, the labor market or inflation?
For credit-sensitive assets, then we're really focused on the labor market if we're heading into a recession. But company earnings are strong. Retail sales came in decent. And so the credit markets aren't really worried about it now. I think I'm more concerned about the long end of the yield curve. It's had a decent rally here. But, if we go back to concerns around too much fiscal stimulus, excess spending by the government, I think that long end could steepen more. So I'm more convinced that if things weaken, the 2-year will fall in yield. Then I'm convinced that the long bond will have a huge rally.
What is that balance right now? Because, he didn't talk a whole lot about that and really wasn't asked about it, to be fair. But there has been this positioning in the market that has pretty much been short duration or at least medium term duration and not a whole lot going on the long end of the curve other than for those institutions that basically have a mandate to buy out there.
Well, it's been a good place to be. T-bill rates have been really high. The 2-year was a few weeks ago closer to 4%. You could buy some credit assets on the front of the curve. So, look, I still like that front end of the curve. We've had a little bit of a rally here that maybe we could see a pullback. I hate to read too much into price action on Fed Day because there's so many people that are changing the positioning. But I think if you get a little bit of a pullback across the curve, it's good time to add. You don't need to add the long bond, but I feel like a broken record. I've been on here for the last couple of years saying that like kind of 2 to 5 year portion of the curve, it's a good place to be.
I am curious what the net effect. Let's assume for a second this is the start of an actual rate cutting cycle and not just a one-off. They've promised, or at least the dot plot promises, 2 more cuts this year, maybe 1 in 2026. With regards to the housing market, we saw housing stocks today get a little bit of a boost. Some bank stocks also getting a bit of a boost. For mortgage bond traders here, is that going to be a net positive, or is this something now that you have to kind of hedge?
Cutting rates is definitely net positive for investors that buy agency mortgage-backed securities. The spread that you get paid is highly correlated with interest rate volatility. So when bond prices are going down, rate volatility is going up. That's a really bad market for agency MBS, and we saw that through kind of like 2021 on through the middle of 2023. But as they cut rates and rate volatility comes down, that's a really good market for government-guaranteed agency mortgage-backed securities. You mentioned the housing market. The challenge the housing market has is, let's just say the neutral rate is 3, and the Fed cuts all the way to that through the end of next year. Will the 10-year, the mortgage rates that you as a borrower get out there in America, it's really tied off the 10-year portion of the curve. Yep. Are we really going to see lower 10-year Treasury yields than 4%? I think you might need to see a recession or a big slowdown in growth to really break down and get down towards that kind of mid-3s.
Are you anticipating that we will see, I guess, if not in a recession, more economic pain in the short run or medium run?
It's hard to say. We're all watching the data. One of the things that we're noodling on, and Jerome mentioned that he's looking at the payroll numbers because they used to come in.
You're on a first-name basis with him?
I hope so.
Okay.
I feel like he's a nice guy. Payroll numbers have been coming in, 100 to 150,000, and now they're coming in, and I think Powell referenced kind of that 0 to 50,000 range, and so people are concerned. Now, things have changed. We've seen a big demographic shift. Baby boomers leaving the workforce. Immigration's down a lot. So maybe a lower non-farm payrolls number, maybe that's the new normal, right? And so really, we should be more keen on the unemployment number as opposed to just focusing on job creation.
Is 3% inflation the new normal as well? Because we've basically been camped out there, at least on the PC.
We're there right now. Goods inflation came up a little bit, and and he even mentioned that he's watching that. But it seems like so far companies have been eating a lot of that inflation and not passing it through. And I don't think if we see it in the next couple of months, I think that tariff inflation isn't going to be as bad as people thought.
Yeah, that seemed to be a big takeaway, and he even addressed that during the press conference. The idea that a lot of that is sort of getting sucked out by the middlemen, and at least for right now, that's good for the economy. Ken, I have to leave it there. Always a pleasure.
All right, thank you.
Ken Shinoda, portfolio manager over at Double Line Capital. As we continue to count you down to the closing bells, a little little bit earlier. We had a pretty strong rally on our hand where it looked like most of the major indices were going to set new record highs. As it stands right now, it looks like we are going to miss that. The Dow Jones Industrial Average up about a half a percentage point on the day, and that is pretty much your outperformer. Everything else either flat or in the red. Yield slightly down, a mixed bag for the dollar and the VIX. The full breakdown of all of today's market action and a push ahead to what to expect next with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here to take you through to the closing bell with the global simulcast. It starts right now. Carol Massar and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms here on a Fed day, Carol and Tim, where we got pretty much exactly what the market had expected, though the market reaction maybe not quite what some were anticipating.
Yeah, we were just spending a lot of time talking about that with Megan Hornerman, Chief Investment Officer at Verdence Capital Advisors. They've got about $4 billion in assets under management. Kind of interesting, and maybe now it's up to the markets. If the Fed is concerned about inflation, then certainly you're going to see that play out in the Treasury trade. She is concerned that the Fed is focusing too much on the labor market versus the inflation pressures that they laid out once again that are still in existence.
You know, the excitement that I think we saw in the markets right when the dot plot came out, right when the rate cut came out, and before we heard from Jay Powell, I think it made sense. But then if you think about it from the perspective of, okay, what has this Fed chair done throughout his 1.5 terms so far? He said, we're data dependent. We're going to go meeting to meeting. Mm-hmm. So, of course, he's not going to be able to be confident about the rate path, when there's so much data that we're going to get even between now and the end of October.
And this has pretty much been in line with the way Jerome Powell has sort of conducted policy pretty much since, we should point out, Trump appointed him way back when. And this sort of methodical, keep an eye on the data. It's a big part of the reason why they paused those rate cuts in January, because they wanted to take a look. He said it specifically at what the impact of tariffs and trade policy and Trump policies would be on the economy. And he addressed that today and basically said, at least for right now, that impact is relatively contained.
Yeah, saying not incredibly obvious what the Fed should do now. So they, too, are in a little bit of a pickle, right?
Interesting day in equity markets. We should point out that when that 2 p.m. statement came out, we did see markets push incredibly higher. The Russell 2000 at one point actually did trade above its record high for the first time since 2021, but it's not going to close anywhere near that. The Dow Jones Industrial Average is going to finish the day in the green, up about 260 points or 0.6%. The S&P down about 0.1%, closing right around that 6,600 level. The NASDAQ Composite and NASDAQ 100 each lower by about 2 to 0.3%. And the Russell 2000 is maintaining some of its gains on the day, higher by 4 points or 0.2%. But we should point out at one point, Carol, it was up a full 2 percentage points.
Got to say, we were thinking about you. We know you like to talk about that index and just kind of watching the move, but, certainly a little bit different by the end of the day. Hey, S&P 500, guys, I know you're going to get into the industry groups there, Romaine, but you did have about 288 names actually gaining on this Fed Wednesday, 213 to the downside, 2 unchanged.
Yeah, and it's kind of interesting, though. I mean, you talk about how do you get 288 names, the majority of the names in the S&P rallying, yet it finishes in the red. Well, a big part of the reason is, tech was pretty much at the bottom of that list. As a sector, it was the worst performing of the 11 sectors out there. Your leaders, though, on the day were a lot of the interest rate sensitive sectors, including financials. They were your gainers here on the day. Utilities also getting a pretty strong bid as well.
Yeah, that's a lot of red there, right? When you really kind of break it down in that way. Hey, listen, let's get to some of the individual gainers. Workday, this was a standout in both the S&P 500 and the NASDAQ 100. At one point, let me just see, up about 10%, almost 10% at its highs of this session, finishing though still with about a gain of about 7.25%. Company's board authorized a buyback of up to an additional $4 billion worth of shares. And also you had Elliott Investment Management unveiling a $2 billion plus investment in the company. The activist investor saying the company's CEO and his team have made substantial progress in recent years, driving growth and customer retention. They put out a statement yesterday. So investors moving into that one.
And did you take a look at just kind of the long-term chart on this? I mean, just really one of the biggest laggards in this space that we've seen.
No, I know. You're right. A long-term perspective always important on this one, but to see some investor momentum at this point, but that's what an activist investor will do. We'll get investors to take a second look. Hey, Baidu, also an outperformer, finishing pretty much at its best levels of the session. I'm looking at the ADRs, ticker BIDU, finishing up more than 11% in today's session. It is China's largest search engine operator. Overnight, I should point out, shares jumped in Asia, the most in over 2 years, and analysts upgrading the company, citing the growth potential for its in-house chip business. So you had a bunch of analysts coming out. Arete Research Services lifted its rating on Baidu's American ADRs to buy from sell. It had held the only sell recommendation on the stock since it downgraded it last May. So this one and a bunch of other analysts coming out and weighing in. Everybody's looking at me. I'm a little nervous. You know,
No, you're good.
Okay.
I just feel bad about Krispy Kreme.
Okay, we're going to get to Krispy Kreme. Let's go there.
By everybody, you meant
this is this is Tim moving me along. Stock was up about 11.5%
That's why I feel bad.
Session.
That's why I feel bad.
Still eking out a gain, but not even a 1 full percentage point.
I'm sorry, Carol.
I
convinced her to do it, Romaine. I said, you got to do.
No, this is
Krispy
a big
Kreme.
story.
I know it was a big story.
Absolutely.
FBI
So what's the deal now? The FBI director, what is he? Is he like taking over Krispy Kreme? What's happening?
No, he's got a day job already, and he's also been pretty busy, answering questions from members of Congress. The FBI director, Kash Patel, questioned by one representative before the House Judiciary Committee about stock purchases from a disclosure form he signed in July. He was asked about the transactions, including one in a national coffee house chain, that would be this one, and also one in a semiconductor company. On Semiconductor was on the move too, but yeah, I thought we'd highlight this one.
And just two quick honorable mentions. Just want to point out PayPal popping about 3% on that partnership with Google. And, of course, Lyft now at its highest level since 2022, Carol, on news here of that partnership with Waymo.
I'm glad you did Lyft, because now I can talk about Uber. It was the second biggest decliner in the S&P 500.
We didn't even plan this out.
We didn't. We didn't. Down 5% today.
You guys were on TV together this earlier. I'm sure you planned a lot of stuff.
As Romaine mentioned, Lyft is partnering with Waymo to offer robotaxi service in Nashville starting next year. It may sound kind of familiar because Uber has a lot of these deals already. This one is the first one between Waymo and Lyft. Waymo is already an established partner with Uber. These two companies have struck multi-year deals. Back in 2023, Uber now offers Waymo trips in Phoenix, Austin, and Atlanta. So Uber declining on the news that Lyft is now playing with Waymo as well. Also, not all IPOs in the last few weeks doing stellar. Look at StubHub today. Actually fell 6.4% in its debut, falling below the IPO after the ticketing platform raised $800 million in its IPO. The company sold 34 million shares at $23.50. And its market value is about $8.5 billion. That's based on the outstanding shares listed in its earlier findings. And finally, General Mills falling today by 0.8%, even though the company reported adjusted earnings per share for the fiscal first quarter that topped estimates.
I just want to point out, you mentioned StubHub falling below its IPO price. We should point out Gemini Space, which went public last week at $28 a share, opened at $37, closing below that $28 price at $24 and change here on this Wednesday afternoon. We are expecting some earnings, I believe, out of Cracker Barrel. They are crossing the wire right now. Let's take a look. Of course, a company that has been in the spotlight mainly for political and cultural war reasons. Well, this is a bottom line story, and the bottom line is a miss. 74 cents a share in the most recent quarter. The street was looking for 76 cents a share, though revenue did come in above estimates at about $868 million. Here's the company's guidance going forward for 2026, which is basically the fiscal year that they are in right now. They say that revenue will be in a range of $3.35 to $3.45 billion. The high end of that range below the average of analyst estimates of $3.52 billion.
All right, I'm looking through the press release, and yes, there is commentary on the logo controversy. It's the first thing and pretty much the only thing that's mentioned at the top. Julie Masino, the company's president and CEO, said, quote, "We thank our guests for sharing their voices and their passion for Cracker Barrel in recent weeks, and we've listened, switching back to our old-timer logo, hitting pause on remodels and placing even bigger emphasis in the kitchen and other areas that enhance the guest experience. Many elements of our plan are working well and delivering results."
Well, I got to say, this is a stock
nightmare is over.
That is heavily shorted. About 25% of the float is shorted. So on any, you'll see some activity maybe coming off of these earnings. That's for sure.
All right. We'll keep an eye on that. We should point out those shares are still slipping here. And really just a reminder, of course, as some of these companies get caught up in the culture wars, we turn back to what's going on in the macro environment. And you're taking a look at yields right now, which are higher across the board. Remember, we came into today with yields moving lower. They actually moved lower on the back of that 2 p.m. announcement by the Fed about cutting rates. But once Jay Powell got to talking and people started assessing what Jay Powell had to say, you did see yields push higher. We should point out, though, at those levels, 3.5 on the 2-year yield and roughly about 4% on the 10-year yield. That's still materially lower than where we were just a few months ago.
Have you ever been to a Cracker Barrel?
Yes.
Oh, okay. A lot?
I've been to them. Yeah, I have no comment.
Okay. Oh, okay.
Yeah.
All right. That feels a little chilly. Okay. All right. We're going to leave it there. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Remain continuing there on the close on Bloomberg Television. Tim and I continuing right here on Bloomberg Business Week Daily.
And our coverage does continue here on Bloomberg Television. A deeper dive into the Fed's decision that just passed, and more importantly, what the path ahead looks like. Alan Blinder are going to be joining us, former vice chair over at the Fed, when we come back. This is The Close on Bloomberg.
The countdown.
Connecting the dot between what's at stake and what is possible.
Is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close here on this September 17th, 2025. It was 1 year ago today, 364 days ago, actually, to be precise, when the Federal Reserve lowered its benchmark interest rate by a half percentage point in what was an aggressive start to what was supposed to be a prolonged policy shift. Jay Powell that day said the decision reflected growing confidence that monetary policy could maintain strength in the labor market while allowing inflation to move sustainably down to 2%. That was a year ago. Core PCE, the Fed's preferred measure of inflation, was hovering around 2.7%. Today, it's higher, hovering around 2.9%. The labor market a year ago was adding about 100,000 jobs each period on a 3-month rolling basis. Today, it's weaker, a trend line of less than 30,000 job additions. When investors questioned back in January why the Fed had paused its rate cuts after just 3 meetings, Powell said the FOMC needed time to evaluate how Trump's policies on immigration, on tariffs, and taxes affected the economy.
I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market.
So here we are, 8 months later. The Fed has ostensibly resumed that rate cutting cycle with a quarter-point cut today and a dot plot that shows 2 more cuts by year end and at least 1 for 2026. That last note on 2026 is a big part of why markets ended where they did. At 2 p.m., we did see a rally in risk assets, but once people started parsing the dot plot and started parsing what Jay Powell had to say, stocks flipped back with the S&P, the NASDAQ ending in the red, and a 2% rally in the Russell being almost entirely erased. Joining us right now to talk a little bit more about the Fed's decision and what the next step is, Alan Blinder joins us right now, Princeton University professor and, of course, the former vice chair over at the Federal Reserve. And, Alan, I do want to go back to the start of this year when the Fed effectively had said it was on pause. It needed time to kind of look at the data, look at the impact of policies coming out of the White House and Congress on the economy. It looks like, as of today, Jay Powell seems to have a better read on that. And it does not seem to suggest some of the worst case scenarios, at least that the market has started to price in earlier this year.
That's right. Well, I don't have to tell you, you know very well that markets tend to exaggerate everything. So most of us economists didn't think the effects of the tariffs would be gigantic, even though we were against them, as I was, and almost all economists were. I don't think it's been tremendously surprising in that regard, although probably slower than a lot of people thought. And the Fed's judgment now, as Powell expressed today in the press conference, is that the risk to maximum employment, that's one part of their dual mandate, look greater than the risk to low inflation, the other part of their mandate. It was a judgment call. You could imagine it going the other way. But by the time we got down to the verge of the FOMC meeting, the markets were completely convinced that it was going to be 25 basis points down. So there was no surprise there.
I am curious, just historically, Alan, I mean, as an economist, we talk about this dual mandate. Is the general sense amongst economists that a weaker labor market is potentially much more damaging to the economy than high inflation, or is it the reverse?
I don't think it's either, actually. I think the notion that there should be a dual mandate in the United States, by the way, this is not normal around the world, but the notion in the United States or among American economists is that both parts of the dual mandate are important. And one of the things that guides the Fed's decision maker is which one looks more in jeopardy at any one moment. Sometimes neither one looks in jeopardy, and the Fed's not going to do anything under those circumstances, which is the way it looked for some months. But sometimes it looks like one is more in jeopardy than the other, then that calls for an action. And that was the Fed's interpretation today, which I agree with, by the way.
You do. Well, what do you think, though, about kind of the projection on the dot plots? I mean, basically telegraphing to the market, at least based on the survey responses, the idea that they are willing to cut at the next two meetings and at some point in early 2026. Based on the data and based on what we know now about the economy, does that seem appropriate?
Well, maybe. Now, you said the next two meetings, but one of those is a coin flip. The markets seem only to want to look at the median, but I think one of them was like 10-9 or something like that. So, yeah, there could be two more cuts this year. There could be only one more. There could be more if things deteriorate in ways that are not now expected. I thought it was notable that Mr. Myron's dot, we assume that's him, was way out of line with everybody else's.
Yeah, well, yeah, and some of us might have actually assumed that. It is kind of interesting, too. I mean, we kind of knew that at least potentially he would be the outlier here. But it also raises the question about what the debate looks like at the next two meetings. It almost seems like today was an easier call. I don't want to say it was easy, but it was certainly easier than maybe what the next couple of meetings are going to look like. And I do want to just focus in on a second, Alan, on where inflation is relative to the 2%-ish target and whether the Fed is maybe just comfortable, at least for right now, in near 3% rate on the core PCE.
Well, that's a good question. They're not talking like they're comfortable. Every time they talk about inflation, they say it's too high. But you could make the case, as I think you just did, that they're acting like they're comfortable. They're not showing any urgency of moving the inflation rate down from nearly 3 to, say, 2. The forecast has it going there in 2 more years. And they seem content with that.
I'm curious, do you have an explanation, just in your own personal view, as to why we didn't see a more meaningful drop in inflation? Like kind of once we got down to that 4%, sub 4% range, it kind of like we just kind of stalled out. And I am curious as to what sort of arrested that decline.
Well, I think so. A couple of things. First of all, the amount of slack in the economy was never that large, and it's slack in the economy that basically pulls the inflation down. Secondly, during the last part of the Biden administration and the first couple of months, I think, if I got the timing right, of the Trump administration, the inflation rate was creeping down slowly, as you'd expect with very little slack, no recession or anything like that. But it was creeping down, and then it stopped creeping down and has now lately been creeping up ever so slightly. Most of us think it's the tariffs. The tariffs are a stagflationary shock. Every sensible person thought they would push up prices, not down. And I think they are pushing up prices. But as I indicated a little while ago, not dramatically. It's not like these tariffs were going to push the inflation rate up to 4, 5, 6%. No sensible person thought that.
Do we need, though, something to break effectively in order to get us back down, meaning that they would have to either reverse this decision today and start raising rates and hurt the economy, or maybe that stagflation scenario does play out? I mean, what traditionally would get us back down to that 2% level?
Yeah, slack. And I think what the Fed is expecting, they didn't quite say this, but it's sort of implicit in what Powell said and in the forecast, that gradually increasing slack in the labor market, which is what they're worried about, is the main way that inflation is going to fall. And so they feel a little more confident that inflation will fall and a little less confident that we're going to maintain an unemployment rate as low as it's been lately.
All right, Alan, really appreciate it, as always. Professor Alan Blinder over at Princeton University and a former vice chair over at the Federal Reserve, as we continue to parse the market moves of the day and look ahead to what comes next. An extraordinary meeting that was kind of, well, overshadowed quite a bit by the potential politics surrounding it. When we come back, we're going to have that discussion as President Trump tries to remake the Fed, and that could be a big story as we head into 2026. Libby Cantrell over at PIMCO, she joins us after the break. This is The Close on Bloomberg. All right, well, there was a lot of intrigue heading into today's Fed meeting, an 11-1 decision to cut interest rates. But all the focus, at least some of the focus, I should say, were on two members of that committee. Trump favorite Stephen Miron, just sworn in just a day ago, was at that meeting. And, of course, he did vote, actually dissenting, I should say, hoping for a 50 basis point cut. Meanwhile, Fed Governor Lisa Cook, who had been on the hot seat for the last few weeks, towing the line pretty much as to where the market expected. A lot of questions, though, going forward about what comes next for the Fed. PIMCO Managing Director and Head of Public Policy, Libby Cantrell, joins us right now. And, Libby, I do want to start off with the reshaping of this. This is going to be a different Fed in a few months' time, one way or the other. We know Powell is going to leave at some point. Trump has got Miron there, and we know that whoever Trump picks next to fill Powell's shoes or any of the other potential open positions, likely, I would assume, would have to be in more of a dovish rate camp.
Yeah, so a couple of things that were surprising to us. And when we actually had expected that this Fed would likely guide to 3 cuts by the end of the year. So that was what we had been telling our clients just based on sort of the payroll data and other economic indicators. But two things that were sort of interesting from this meeting, sort of to your point about personnel. One was, of course, that it was only Miron who dissented. That was, I think, expected that should he get confirmed and sworn in by the time of this meeting, that he would likely dissent and advocate for a bigger rate cut, but also that, Chris Waller and Mickey Bowman did not dissent. They, of course, had dissented back in June. I think the expectation was that they probably would be also advocating for a bigger rate cut. So that was quite interesting. But as it relates to sort of the future composition of the Fed, you were right, of course, that Chair Powell's term is going to be up at the end of May as chairman. Of course, as you know, he can still remain on the Fed, though, until January of 2028, because he can sit there as governor. Yeah. But presumably anybody who's going to be nominated is going to have a more dovish view in terms of getting the nomination for the president. But one really important point here that we've really been emphasizing to clients is that, of course, nomination is the first step, but you also have to get confirmed by the Senate. So that's going to be a balancing act for whomever is actually considered to be the next chair. Yeah, and it's kind of weird you think about it. That's still about 8 months or so away before Powell's term is up. And Powell talked a lot today here about what's next for the Fed and the idea that he wants to be patient, he wants to go slow, he wants to be dependent on the data. Data, as you know, Libby, that's been in question over the last few months, primarily by the Trump administration. Yeah, that's exactly right. I mean, this is also goes back to, the BLS director and the firing of her and who will replace her. Again, that is also a position that is subject to Senate confirmation, and the person that President Trump has sort of envisioned may not actually get confirmed. Our economists always emphasize that while an independent Fed, of course, is critical for the functioning of capital markets and the sort of the general integrity of those markets, independent data is just as critical, if not more so. So, in fact, within the kind of the walls of PIMCO, we put as much emphasis on the importance of an independent Fed as we do of independent BLS. less. And of course, that's a little bit more nuanced, but you're right, that is just critical.
One sort of potential sort of speed bump in all this is, and I was just reminded of this just last week, is apparently we don't have a budget in this country. I don't think we've had really a budget for the most part for the last couple of decades. But this is something, in all seriousness, that the House and the Senate are going to have to address. Otherwise, we're apparently staring at a government shutdown within the next week.
Yeah, and I think this is really important, and it ties back to the Fed outlook for the economy as well, because should the government shut down, and you're right, Congress needs to come together, the House and the Senate needs to come together to pass a funding bill by September 30th. If they fail to do that, the government will shut down. But if the government does shut down, if they fail to reach that consensus, then there could not be a catalyst to reopen the government. And I think that is something that we're considering here, that the longest full government shutdown in history was 16 days. That was back in 2013. There were indications that did impact the real economy. Not only would it impact the real economy, but it also could impact data, to our previous conversation, just in terms of the BLS and the BEA actually being able to conduct their surveys during a government shutdown. So I think this could be sort of a headwind from an economic perspective, and obviously could inform the Fed's decision when they meet back in October.
All right. Well, definitely food for thought there. Libby, always great to have you. Libby Cantrell, PIMCO Managing Director and Head of Public Policy, as we continue to parse what comes next after the Fed rate cut today. We did see a big bid come into bank stocks. In fact, the KBW Bank Index closing at a record high here on the day. Of course, all coming just about a month before we get the next round of earnings out of that cohort. A conversation up ahead with Chris McGrady, Head of U.S. Bank Research over at KBW, and what this rate cut means for the broader banking sector.
The tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. People have to keep in mind, the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that.
The Chairman and CEO of Bank of America, Brian Moynihan, speaking a little bit earlier here on Bloomberg, discussing that tension that the Fed has to deal with. A lot of talk right now about the impact of today's Fed decision and the rate cuts that they're projecting going forward. Joining us right now to talk a little bit about what this means for the banking sector is Chris McGrady, Head of U.S. Bank Research over at KBW, a Stifel company. And Chris, taking today's rate cut, and if you believe what's on the dot plot, potentially by the middle of next year, we'll be at least a full percentage point lower on the Fed's fund rates than where we were just yesterday. Is that going to be a net positive for banks?
Well, thanks for having me back. I think the expectation today versus yesterday, nothing materially has changed. We're still in a pretty healthy economy. Yes, inflation's a little bit above the Fed's targets, but they are concerned about employment. So this dual mandate is a challenging exercise for the Fed to solve. From our seat, the economy is in pretty good shape, right? We think earnings growth for the banks is set to accelerate. These rate cuts, we believe, will continue the positive earnings momentum that's in place for your traditional banks, and it's also going to keep capital markets pretty healthy.
It keeps capital markets pretty healthy. That's something that Brian Moynihan himself talked about. We also heard a little bit earlier today on another news outlet, Jamie Dimon, also talking about the business at J.P. Morgan. The big banks are going to do well, but they've been doing well, Chris. The big question is, what about the rest of the banks out there, the small, the regional banks? What comes of them?
Right. To your point, the largest banks have been winning. We think they'll continue to win. We think the scale and the consistency and the deregulatory narrative that's playing out, there's a lot of momentum there, and we like the universal banks. For the regional banks, for your average bank in America, the earnings profile and the earnings outlook is pretty healthy. Credit costs are pretty contained and benign. We are seeing pockets of loan growth, and we are seeing margin expand. So if rates come down, and if rates come down for the right reason, that's the debate we're having. Are they cutting out of conservatism or optimism? If rates come down for the right reason, you could get a pretty good narrative for the average traditional bank.
And are we talking about sort of a pickup in lending activity? Because we don't hear that a whole lot from those banks, nor even the big money center banks. It's all about trading revenue, investment banking fees, et cetera.
Right. The mainstream bank in America, commercial and industrial lending is really what we're looking for. we're seeing companies put more capital to work. But we have to keep in mind, there was a lot of uncertainty in the beginning of the year with Liberation Day. As the consistency is, the volatility has been pulled out of markets, banks and investors can make decisions for multi-year purposes. And I think what you're seeing is the second quarter was pretty good from a loan growth perspective. We heard updates from the banks last week. That's continuing. It's not robust, but it is moving in the right direction.
So I am curious, just in terms of like your top ideas, Chris. I mean, let's just start with some of those big banks, like a Bank of America, like a JP Morgan, like a Citi. You still favor those as buys?
Those three are three of our top picks. I think they're for different reasons, right? If you go at the far right end of the spectrum, you have JP Morgan. I'd throw in Morgan Stanley as well. Best-in-class returns, most consistent ROEs in the space, and the capital that's being freed up from deregulation is pretty powerful. At the other end of the spectrum, Citi is our deep value idea. It's trading at book value. When you can buy back your stock at book value and really the importance of that can be pretty powerful as the company gets to that 10 to 11% ROE target. And then wedged in the middle is Bank of America. Bank of America trades at 11 times earnings. They're going to produce a 15% return on equity this year. And what we think is interesting for B of A is they've recently announced an investor day in November, and they haven't hosted one in as far as we can go back. We think there's a story to be told there, help recontrol the narrative of that responsible growth strategy that Brian's been talking about.
What about regional banks? Anything you're looking at there?
Sure, I would say we're selectively constructive on the regionals. One name that I think can benefit from the capital markets, but also the loan growth, so you kind of get that dual-pronged approach, is Citizens Financial. Right, Citizens is in the process of a multi-year return on equity improvement to the tune of 300-400 basis points. So simply the passage of time will create much stronger returns for investors. At the same time, loan growth is improving a little bit, and they've also got, with JMP, they've got a capital markets play. So you can kind of play both ends of the thesis with Citizens, and the stock trades for 10 times earnings. We think that's really attractive.
All right, Chris, always great stuff. Chris McGratty, head of U.S. Bank Research at KBW, a Stifel company. Here on this Wednesday afternoon, a focus on the macro, but let's take a look at some of the individual stocks that did post some pretty decent gains during the cash session earlier today. Lyft, one of the biggest gainers out there, up 13% on the back of that partnership with Waymo for autonomous robo-taxis, I should say, in Nashville, Tennessee. Workday getting a nice bid as Elliott takes a stake in that company, and PayPal in partnership with Google, giving that stock a pop of about 3%. Meanwhile, we did see some weakness in the tech space. Broadcom, Nvidia, and some of their other chip stocks moving lower here on the day as a lot of people rotate around the market. And just now here in the after-hour session, we're seeing a little bit of a dip in the steelmaker Nucor, down about 4% in the after-hours trade. The company appears to be making a pre-announcement here on its third quarter earnings. It's scheduled to report earnings until October. It does say that 3Q EPS will be in a range of $2.05 to $2.15 a share. The street was looking for $2.59. The company says it's decreasing its earnings estimates across all three of its operating segments. We're going to have to dive a little bit deeper to get you a reason for that here, but something to keep an eye on. We'll be back. This is The Close on Bloomberg.
For over 147 years, Bgrim has embraced doing business with compassion, always committed to giving back to society. We empower people and strengthen communities for a better future.
All right, with the Fed's interest rates coming down 25 basis points today and maybe even more over the next few months and quarters, a lot of people are taking a look at tech stocks. They're really taking a look at the Mag 7 and saying, is there anything else out there? Well, our next guest says that quietly there has been a group of profitable stocks that have been beating the Mag 7 for quite some time in the Russell 1000, outpacing the Mag 7 in 6 of the past 8 quarters. An eclectic group of names that includes Broadcom, Carvana, Tapestry. Chris Kane joins us right now with that research, quantitative equity strategist over at Bloomberg Intelligence. And Chris, this report you guys did this morning, you and Jillian, really caught my eye because I guess I kind of felt that this was going on, but you really quantified it. So explain exactly what is outperforming.
Sure. So, you always hear this market is just driven by the Mag 7. And of course, that's a big part of it, but the devil's in the details there. So we wanted to see how many stocks of the Russell 1000 have consistently beat the Mag 7 over the last 2 years. So not just total return. We don't just want, one stock that jumped a lot in a day or a week. So we looked at how many stocks have outperformed the Mag 7 in 6 of the last 8 quarters. Only 32 stocks of the 1000 have done that. So it's a pretty exclusive list. Only 6 have done it in 7 of the last 8 quarters, and actually none have done 8 of 8. So, when you look at these stocks, I look at things through a factor lens, and I want to see, what are the common characteristics of these stocks. So some of the commonalities, like you said, high profitability. So I don't mean their stock returned a lot. I mean things like high return on equity, high return on invested capital, high margins, very expensive. A lot of these stocks are very expensive and very high betas or very high sensitivity to the markets. Those are kind of the common factor attributes.
I am curious as when we start to talk about sort of the complexion of those names and what rate cuts or the start of a rate cutting cycle, if this is indeed one, what it means for those names.
Yeah, I think the market generally is just really set up really well here, Romaine. Like I mentioned on Friday, if you remember, stocks do very well in cutting cycles, about 15% annualized when you go back to the 1970s. And if you have a cutting cycle with no recession, which the Fed seems to think we are going to, that jumps to 25%. So, you do see in those rallies a lot of high growth areas, expensive stocks, high beta stocks do very well. Again, those are the commonalities of the stocks that have beat the Mag 7. So I think we can see a continuation of that. It's not the best news for value investors, maybe, but we see a continuation.
Chris Kane, quantitative equity strategist over at Bloomberg Intelligence. Some great research on the Bloomberg terminal, as I think everybody now is trying to figure out what this rate cutting cycle actually means for stocks going forward. We did get a bit of a pullback today, but it's hard to really judge where things go based on the knee-jerk reaction on Fed Day. Our next guest says that, well, this rate cut is the start of another leg to the tech bull cycle. Dan Ives joins us right now, Global Head of Technology Research at Wedbush Securities. Dan, all right, lay it out for us.
It's a bright green light.
Yeah.
For tech, because to me, it's like, think about it, you got AI revolution hitting its next stage of growth. We've seen it with Oracle, NVIDIA, and across the rest of tech. Now you got a cut cycle. In my opinion, this is really going to turbocharge this tech rally. And it's not just about Mag 7.
Yeah.
It's about second, third, fourth derivatives.
Yeah.
I think tech stocks could be up another 10% between now and the rest of the year.
Is that more of a sentiment issue, the idea that with the Fed being more accommodative, or is this really about like cost of capital? Because I would assume a lot of these people in the tech space, these companies in the tech space aren't really borrowing.
Well, I think that's part of it. This is and guess what they're going to spend on? AI, data centers. So it speaks to our view. Like, look, tech's had a strong year so far. But it's get the popcorn out. This is still, we've talked about it, it's only 10:15, 10:30 p.m. in that party that goes to 4 a.m., started at 9 p.m. a year ago. And you look at software, it's chips. You look at now the data center side, the power side, names like GE Vernova and others. That to me is the most exciting. It's about the second, third, fourth derivatives playing out across tech.
And we kind of started to see that, particularly based on what we saw out of this earnings period. Oracle was really kind of, I won't say a surprise, everyone, but it was certainly the punctuation mark and the idea that it is broadening out. We were talking the other day about how Corning was, up for like 11 straight days. And you have all these stocks that were kind of either forgotten or not really considered to be part of that tech AI trade that now are getting a lot more attention.
Well, I think it's a great point because that's now the focus. Because investors, they're looking to see, okay, who now is going to benefit small cap, mid cap, software, across chips, because there's just further validation that this AI revolution is hitting this next stage of growth. Use cases are exploding. Look what's happened on the consumer side as well. CapEx continues to be rock solid. And I think as that plays out in a cut cycle, look, I just think tech, it's in the left lane in a Ferrari going 100 miles an hour. And I think that, look, there's going to be speed bumps along the way.
Yeah.
But just like we saw with NVIDIA, China News, and others, I just view those as bark worse than a bite because this now is the start, I think, the next leg of the bull cycle.
Well, I do want to ask you about that because I think markets did get a little rattled by the news earlier this week about China, potentially, basically saying you can't sell here for right now. And I know there's discussions going on at a high level between the U.S. and China that may resolve that. But when you look at these U.S. companies, what's the valuation look like if China is not a place where they can sell? Because we've all seen NVIDIA's inventory. Sure. They got it. They can sell it if China allows them or the U.S. allows them, but they can't do it right now.
Yeah, and look, I think this is all a game of high-stakes poker, too. Between U.S. and China, what's the biggest poker chip? It's NVIDIA. I think the street is not factoring in full sort of demand cycle into China. So my view is that as this starts to, I think, play out, you will continue to see more and more selling into China. Look, Beijing clearly shots across the bow in terms of how this all plays out, but I don't think that's actually factored in. I just think my view is whenever you have this type of news, it's very easy to kind of yell fire in a crowded theater. I just don't think that's the right way to view it. You got to look at these are the opportunities. I think NVIDIA is a $5 trillion market cap. And there's only one chip in the world fueling the AI revolution. That's NVIDIA.
I am curious about what opportunities they have in overseas sale. Just today, Trump is in the UK. There's been a lot of talk about some potential investments to help build out the Britain's AI infrastructure, which is, a minuscule compared to what we have here in the U.S. And if they want to build it out, they most likely would have to be dependent on U.S. companies.
Yeah, look, it's a land grab. I mean, look what's happened in the Middle East, right? That's why, Jen's when this black leather jacket come. Look at Car Palantir and others, because now you have an arms race playing out. And U.S. recognize, I think Trump administration recognizes this is the opportunity for U.S. tech to get bigger. And that's something, when you talk about what's not factored into numbers, it's about rest of the world. Because remember, we're only 3% through in terms of where this all is trending from an AI perspective. And that's why, look, the bears, when they're in hibernation mode, they can see AI in the spreadsheets.
I'm curious, Dan. I mean, I know I've always been relatively optimistic in this space, at least in this cycle here. I mean, what is the biggest risk, though, that you have sort of just on your radar?
Look, the biggest risk is clearly China, U.S., if that actually goes south. But our view is that's actually getting more and more potentially positive as we see those negotiations. And it's a pay-for-play model. Big tech is adjusting to that. You saw Cook, he's playing nice in the sandbox in
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
News when you want it with Bloomberg News Now. I'm Tom McKenzie.
And I'm Stephen Carroll.
Federal Reserve Chair Jerome Powell has rallied his committee of policymakers to back the central bank's first interest rate cut of the year. The quarter-point reduction came after a significant slowdown in job growth and an unprecedented push by the White House for much lower rates. But with the effects of tariffs on inflation still uncertain, Powell made clear that Fed officials will face difficult trade-offs in the coming months as they consider whether to keep cutting.
You could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
The decision to cut rates was nearly unanimous, with the lone dissent coming from Fed Governor Stephen Miron, a close ally of Donald Trump, who favoured a larger reduction. Fed Governors Chris Waller and Michelle Bowman, who dissented in July in favour of a rate cut, supported this move.
The Bank of England is expected to rein in its quantitative tightening programme today amid concerns that its gilt sales are worsening volatility in the bond market. Economists and investors are expecting the bank's Monetary Policy Committee to slow the speed at which it's reducing its holdings of government bonds to £70 billion a year, down from £100 billion a year. Officials may also decide to sell fewer long-dated gilts. The bank will announce the changes alongside its interest rate decision today, where it's widely expected to hold rates at 4% amid continuing high inflation.
Britain's King Charles praised US President Donald Trump's efforts to support Ukraine against tyranny after a day of lavish celebrations in honour of the US-UK special relationship. The monarch underlined the strength of the ties between the two countries in his speech at the state banquet.
In 2 world wars, we fought together to defeat the forces of tyranny. Today, as tyranny once again threatens Europe, we and our allies stand together in support of Ukraine to deter aggression and secure peace.
King Charles's comments on Ukraine came after a day of royal spectacle. The two heads of state inspected troops, rode in a horse-drawn carriage and laid a wreath for the late Queen Elizabeth. This was the response from the US president.
This is truly one of the highest honours of my life. Such respect for you and such respect for your country. For many decades, His Majesty the King has epitomized the fortitude, nobility, and the spirit of the British monarchy and the British people.
Donald Trump speaking at the state banquet in Windsor Castle. In diplomatic talks later today, the Prime Minister Keir Starmer hopes to press Trump on trade terms and the war in Ukraine. Although major breakthroughs are not expected, the Prime Minister will do so without his top ambassador, who he fired last week for his ties to the late Jeffrey Epstein. The visit is also a chance to sign investment deals, with the British government announcing American companies were planning $150 billion in investments to coincide with the occasion.
Disney is taking Jimmy Kimmel's talk show off air indefinitely amid a backlash to remarks he made about the killing of Republican activist Charlie Kirk. Kimmel, who has been a vocal critic of Trump, accused Republicans of using Kirk's death to criticise their opponents. In his monologue on his Monday night show, he said, "We hit some new lows over the weekend with the MAGA gang trying to characterise this kid who killed Charlie Kirk as anything other than one of them." The comments angered many right-wing commentators and brought criticism from members of the Trump administration. Following that, the head of the US broadcast regulator, Brendan Carr, told podcast host Benny Johnson there was a strong case to punish Kimmel and Disney.
From the moment that I have become chairman of the FCC, I want to reinvigorate the public interest. And what people don't understand is that the broadcasters, and you've gotten this right, are entirely different than people that use other forms of communication. They have a license granted by us at the FCC, and that comes with it an obligation to operate in the public interest.
That was FCC Chair Brendan Carr speaking on The Benny Show. Disney's ABC network took Kimmel's show off air after Nexstar Media, which owns dozens of affiliate stations, said it would pull the programme indefinitely from its schedules over the remarks, which it said were offensive and insensitive. In a statement, the Writers Guild of America criticised the move, saying if free speech applied only to ideas we like, we needn't have bothered to write it into the Constitution.
Meta wants to turn its smart glasses into a must-have product with a new model boasting built-in screens. The social media giant is rebranding the products as AI glasses with a price tag of $799. Meta CEO Mark Zuckerberg says he is bringing super intelligence to consumer electronics.
This is going to be the most important technology in our lifetimes. AI should serve people, not just be something that sits in a data center automating large parts of society. So we design our glasses to be able to empower people with new capabilities as soon as they become possible.
Zuckerberg was speaking at Meta's annual event to showcase new technology. The company is hoping the new display glasses will be a stepping stone to full augmented reality glasses.
Those are your top stories on the markets. The Stock 600 is 0.6% higher. The DAX up by 1%. On Wall Street, S&P E-mini futures are up by 0.6%. The 10-year Treasury yield down 4 basis points to 4.05%. We've had Norway's central bank, the Norges Bank, also making an interest rate decision, talking about it seeing rates reduced further during the course of this year as well. It cut its benchmark interest rate to 4% in that decision.
That's news when you want it with Bloomberg News Now. I'm Tom Mackenzie.
I'm Stephen Carroll, and this is Bloomberg.
When the rest of the markets slow down, the futures market keeps moving.
Connecting the dot between what's at stake and what is possible.
What jumps out to you, sir?
Couple things jump out. Greg's right. One dissent was surprising. We certainly thought there would be 3 pushing for 50 basis point rate cuts and possibly 2 suggesting nothing. And then also the fact that 2 rate cuts were pulled forward into this year. We thought there would just be 1 more for this year. So more or less where we were last time. It tells me that this is a Fed that locked arms, felt this was time to reduce policy from what was surprisingly restrictive to them. They were probably shaken by the labor market revisions and thought, wow, we've kept policy a lot more restrictive than we thought. Let's start getting to neutral and let's do it in unified fashion. I think this is good for the markets.
Bob, good for the markets. Let's talk about which ones. It might be good for risk assets. How much can this keep being supportive for long-term bonds, given that theoretically higher inflation would come on the heels of a prioritization of growth, and typically higher inflation is bad for long-term bonds?
Well, I wonder if the indication of higher inflation is just a suggestion to us not to expect 50 basis point rate cuts in here, but 25 perhaps every meeting for the next few meetings. Maybe they don't get down to 3% right away. They pause somewhere around 3.5 either side of that. I get that. I'm sort of with the Fed. We don't really know the shape of inflation until we see the final shape of tariffs. Right now, the evidence is pretty good. Businesses have absorbed some of it, and the consumer hasn't really pushed back all that much. And there's been signs of disinflation. So I'm not that concerned about inflation.
Connecting the dot between what's at stake and what is possible.
Do you still believe the Fed is bad for America?
I don't think the Fed right now is very good for the American economy. Let's put it that way.
Okay. You don't like that?
But I do think that the Fed made a genuine stand for Fed independence today.
Okay. A lot to unpack there. So wait, do you agree with their decision today?
I think it should have been a 50 basis point rate cut.
Even with inflationary concerns that are out there?
Even with inflationary concerns that are out there. Christopher Waller gave kind of a
He didn't dissent.
He did not dissent. And that
He could have.
That is the biggest news of the day, actually.
Yeah.
Because Waller directed us to what he calls core private sector job creation. What that does is it looks at private sector job creation and it nets out education and healthcare. We've had you guys have had a few really good articles on that since the latest employment report. In any event, when you net out healthcare and education, what we call recession-proof industries, the last time we had a job created in the private sector was April, meaning, according to Waller's benchmark, the Fed should have been lowering rates not just in July, but in June and in May as well, because that's how long we've seen this private sector deterioration. And then we get June, right, which has got a negative number in front of it. The pandemic notwithstanding, we haven't seen a negative print in front of non-farm payrolls in real time, mind you, fairly real time, since September of 2010. So it's been a very long time since we've seen the job market weaken to the extent that it has. And Waller would agree with that, and yet he stood firm with the rest of the committee today.
So onto your statement that the Fed made a good case for its independence today. What was that?
It was that it's exactly what I just described. Waller's own research dictates that we should have been playing catch-ups because we didn't lower in May, we didn't lower in June or July, yet he stood with the rest of the committee. He may well have given up a shot at being chair, and the betting markets had him in the top position going in. Of course, he could not be interviewed these last few days because the Fed was in blackout.
Isn't that a good thing for markets then? Isn't that a good thing for people who are concerned that there is political pressure on this entity?
Yes, because they pushed back against the political pressure. Through that prism and through that prism alone, the right thing was done today. That being said, they really do need to find some time to catch up to the economy, despite what's happening with the potential for tariff pass-through.
So let's talk about that a little bit, because I remember last time you were in here, July 29th, it was the day before the most recent Fed decision before this. You came on and you said the underemployment is such a big issue in this country, and we're not looking at it the right way. What I took away from our conversation was your evidence that there were all these people out there who were essentially doing gig work, who wanted to be working full time, and the effect that that's having on the economy. Does the Fed understand that in your view?
Well, the Fed staff certainly does understand what's happening. We've had more than 1.4 million full-time jobs lost since the beginning of this year. And we had a great big boost to the labor force because the census had us add a couple million people into the population. No, I think the Fed understands, or at least the Fed staff, they've all been given these presentations. They understand the magnitude of what's facing the job market. It's not a lack of understanding. It's a lack of recognition because they're under attack. But the Fed completely understands that incomes are under strain, that the only thing that the class of 2024 can say of college graduates is, at least we're better than the class of 2025. I talk to college-age students all the time. The jobs are just not there. And youth unemployment is at recessionary levels. We have 77% of states in the United States. 77% of the population is in states with falling job openings. I mean, you got to go back to 01 or 09.
What can the Fed do by cutting rates that will? Because what if it is because of AI? Like, what is it if there are structural changes that are going on in the labor market that a rate cut
Congress should change the Federal Reserve Act to no longer have the employment mandate. You cannot ignore a weakening job market.
But again, I would go to, if it's not the Feds, they've got to look at inflation. There's a dual mandate. And inflation, it's sticky. It's been sticky for a while, right?
Inflation has been sticky. It absolutely has.
So,
and yet we're not seeing the fact that, according to Redfin, 80% of the major metropolitan areas in this country have falling home prices. That's not filtering through to the CPI, nor will it yet, because there's typically, according to Fannie Mae, a 6-quarter lag between when you actually start to see home prices falling. We've also seen this in Case-Shiller 4 months in a row now. But once you see that, it's a very long time before you get that deflationary impulse that's evident in the CPI, but it's coming.
But don't you think about, Danielle, I think about this a lot in terms of what's going on in the economy, especially post-pandemic, that there are people who have great jobs or in the market, they're doing okay, and then there's a lot of the economy that isn't. And I don't know if that is the result of Fed policy or more policy that maybe our lawmakers in Congress need to think more broadly, not about political contributions that get them back into office and companies.
Amen to that.
But
Caroline.
rather thinking about all of America.
So, I wrote a whole book about it. I think
I'm going to get off my soapbox.
No, but you're on the right.
But I'm just saying that I don't know if it's the Fed responsibility here.
The inflation.
In fact,
I mean, if you're speaking philosophically, the inflation and employment mandates are inherently conflicting. This was a 1978 tweak to the Federal Reserve Act that completely changed how the Fed operates. Should the Fed go back to being only an entity that fights inflation? Absolutely. We should make that happen yesterday. That, however, is an act of Congress.
So, in other words, and the Fed has done the right thing. They're watching inflation. Inflation is getting
high. Until they're let off the hook, they still have that employment mandate.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends
the president is receiving the news tonight as he continues his state visit to the UK. We'll take you to London. Plus, we'll have fresh reaction to the Fed news from Capitol Hill as the clock ticks now on just 5 working days before a government shutdown. When Minnesota Senator Tina Smith and North Carolina Congressman Greg Murphy join us, both up ahead.
We have our reporters covering it all tonight with Bloomberg's Anne-Marie Hordern with the president in London and our very own Mike McKee right here in our Washington bureau. Plus, Romaine Bostick will be joining us from World Headquarters in New York.
We begin tonight in London with Bloomberg's Anne-Marie Hordern traveling with the president, reporting live now on the visit to the UK. Anne-Marie, no response from the president just yet, unless you've heard something on the Fed decision, but certainly a lot of pomp and circumstance to go around.
Certainly a lot of pomp and circumstance, and it continues even though the press have been sent home. Of course, the president continuing his evening in the castle behind me at this state banquet dinner. We did hear from the president, though, really talking about the special relationship, saying that these two countries, the relationship is even more than the word special. It's 2 notes to 1 chord. And then he went on to bring some politics into it, saying, as he says on a lot of trips, the U.S. is the hottest country right now. And, of course, maybe he is especially feeling that way, given he is sitting next to tech titans, surrounded at this table with UK royalty, who just decided to invest tens of billions of dollars into the UK. Take a little bit of a listen to what the president had to say at the start of this state banquet during the toasts.
We are, as a country, as you know, doing unbelievably well. We had a very sick country 1 year ago, and today I believe we're the hottest country anywhere in the world. In fact, nobody's even questioning it, but we owe so much of that to you and the footing that you gave us when we started.
Now, Joe, the British have really went out of their way to make this incredibly personal for President Trump, including an after-dinner drink with a cognac from 1912, the birth year of President Donald Trump's Scottish-born mother. But when King Charles spoke, he also talked about and alluded to a strong defense of allies for Ukraine and also a defense for the environment, something King Charles is incredibly passionate about when it comes to climate change. So tomorrow, there's going to be a host of issues on display. The theater is really left at the castle gates, and when they move to checkers and the prime minister sits down with President Trump, trade, Ukraine, the Middle East, all of these substantive issues will be on the agenda.
Well, Anne-Marie, talk to us a little bit more about those substantive issues, because that's really where the meat lies, and perhaps these transatlantic alliance and potential cracks that are underneath it. What could be a sticking point ahead of the press conference?
Well, what makes this incredibly awkward is the Prime Minister, Keir Starmer, is really underwater right now in the polls. You had 3 forced defections from his government, individuals that were ousted within 2 weeks or had to resign. So all of this happens at a time when the prime minister is incredibly weak at home, very different from the moment 7 months ago when he extended this invitation for a second state visit. So he doesn't have a ton of leverage. An issue like trade, where the UK government was going to push to try to get the 25% steel tariff level down to 0, as well as trying to get exemption for Scottish whiskey. All of that seems to be off the table and the UK just capitulating. So I think there's going to be a tremendous amount of discussion, but some awkward moments, especially when it comes to one reporter from the Times saying that the UK is prepared this weekend after the president leaves to recognize Palestine as a state, and a number of other issues, as well as Jeffrey Epstein, which had those close ties, of course, to now the former British ambassador to the U.S., Peter Mandelson.
Bloomberg's Anne-Marie Hordern joining us from London, England, following, of course, the president on his state visit. We thank you so much. Let's bring it right back to the conversation here in Washington, and specifically to the Federal Reserve, as the Fed cuts interest rates by a 1/4 point and penciled in 2 more this year. The FOMC voting 11-1 to cut the target range, with the newly minted Fed Governor Stephen Miron dissenting, favoring a larger 1/2 point cut. Fed Chair Jerome Powell commented on the decision during the press conference earlier today.
I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
Joining us now live in our Washington bureau, Bloomberg's Michael McKee, who, of course, was in the room during today's presser, asked a couple of questions to Jay Powell. Mike, he calls this a risk management cut. We know Jay Powell, in Donald Trump's first term, had talked about insurance cuts. Since then, he's talked about bringing the rate right back down to neutral. Is that what this is, just bringing things back to neutral?
Well, that's the direction, but whether they go that far that fast, as the dot plot suggested, was something that perhaps Powell was trying to walk back a little. The idea being that we are seeing inflation still up and not moving any lower, although the Fed thinks maybe it's just going to be this one-time move and it'll stop going up. But the employment situation seems to be deteriorating. And if employment deteriorates and we see the unemployment rate go up, that should bring down inflation as well. So the risk management, the risk is on both sides, he said, but the risk management idea is to treat the employment side of the mandate right now and hope that the inflation mandate doesn't get any worse.
Maybe you just answered this question, but I just love the way you cut through the jargon when you're in that room talking to the chair. Your question today essentially was, if inflation is rising, why are we cutting? So the answer is we're looking at one side of the dual mandate.
Well, they are in tension, is what Powell was saying, and they can't attack both at the same time. So they have to pick one. And the feeling is that the weakness in the labor market is the one that would respond most to what their interest rate is, because they think the rising inflation rate is mostly due to tariffs, and that will be a one-time effect. If that goes away or that passes, then they still need to prop up growth in the U.S. and do that through cutting rates a little bit. But this is going to be a meeting-by-meeting decision. Although the dot plot said 2 cuts, it was basically a tie vote. And so I think you're going to have to watch meeting by meeting whether unemployment goes up or inflation keeps rising to see whether they're actually going to follow through with any of those cuts.
It'll be interesting to watch what Myron does in the future here as well, the newest member. Bloomberg's Michael McKee with us in the Capitol. Thank you so much for your coverage today, Mike. Joining us now with her perspective live from Capitol Hill is Democratic Senator Tina Smith of Minnesota, a member of the Senate Banking and Finance Committees. It's great to have you back, Senator, on Bloomberg TV and radio. I assume you're happy with the move today. Maybe you wanted something bigger. You can tell us. Was President Trump right, though? Was Jay Powell too late?
Well, listen, I really support the action that the Federal Reserve took today. And I think, as Jay Powell said today, they are balancing 2 risks. They're balancing the risks of inflation on the one hand and the risks of declining employment on the other hand. So I don't second guess the decision that the Fed made today. I think that the problem that we all have is that tariffs are really clearly fueling inflation. And as I think Jay has said, we don't really know the full impact of what those across the board, roughly all in 18% tariff impacts are, because we haven't really felt we haven't felt it all yet. And at the same time, we're seeing very low low growth in employment and shortages of workers, as Chair Powell said, fueled in part by the president's immigration policies. So they've got a complex set of risks to manage right now, and I think they're doing a good job.
Well, Senator Smith, I want to come right back to the question around tariff and the pass-through there, because Jay Powell addressed that in his press conference today, actually saying the contrary, saying that tariff inflation pass-through has been slower, has been smaller, and even the job slowdown isn't entirely coming from the tariff story. That's something we've heard, a narrative we've heard coming out of the White House. What are you hearing from your constituents, though, in terms of the reasons behind why the labor market is slowing down?
Well, I think first of all, there's a huge amount of uncertainty in the economy right now, and business investors, capital doesn't like uncertainty. When there's a lot of uncertainty, capital tends to hold back and kind of play a little bit of a wait-and-see game. Simultaneously with tariffs, what we've seen, I'm hearing this from Minnesota companies, is they did their best to buy in as much as they could early, hoping to avoid the impact of tariffs, because they're the ones that are going to end up paying it. And also consumers were, buying that iPhone in February rather than waiting until November, because they thought it was likely that it might cost a lot more. So that creates some distortions in the kind of economy that we haven't felt the full brunt of yet. And then I think there's another thing happening which is quite interesting, which is that American manufacturers are looking at price increases because they don't want to be, they're not going to sit there with a 0% price increase when their foreign competitors are increasing their prices by 10% or 15% to help to cover the cost of these tariffs. And all of that has the impact of driving up the cost of goods, driving up inflation, creating more uncertainty in the capital markets in terms of investment. And what's happening, what I'm hearing in Minnesota is serious problems with the labor shortage, especially in areas like agriculture.
I want to ask you about some of the other news. This came against the backdrop here, Senator, of not only a debate over government funding on Capitol Hill, but also one over political violence. There have been a couple of really interesting conversations and hearings, including one in the Senate today with the FBI Director, Kash Patel. We heard from your colleague, Senator Amy Klobuchar, who talked to him about some of the threats that lawmakers are facing on both sides of the aisle. I just want to have our listeners and viewers hear a piece of that conversation. We'll have you respond. Let's listen.
Last week, Director, your friend Charlie Kirk was gunned down on a college campus. I'm sorry for your loss. In Minnesota, only 2 months ago, a madman took the life of my friends, Melissa and Mark Hortman, shot Senator John Hoffman and his wife Yvette a combined 17 times. I actually don't want to go tit for tat on this, but what I am asking for is that this rhetoric of blaming one side or the other stop, if you could convey that to the president, and that we actually work on things that are solutions. So could you commit to me, Mr. Patel, Director Patel, that you will do that?
Absolutely, Senator.
In light of the recent political violence that we've seen, of course, Charlie Kirk brought this back to the fore as a major conversation in our politics. Your home state of Minnesota, of course, saw some terrible and deadly political violence in Minnesota State Rep Melissa Hortman and her husband being targeted. Just wondering where your head is on this as the president blames the radical left, and we have a lot of finger pointing going on in a very partisan environment here in Washington. Senator, how do we get out of this cycle?
Well, so I start from the place that most Americans, almost all Americans, abhor political violence. And when it happens, it shakes the very foundation of our democratic society, because if we cannot resolve our differences, great though they may be, with words, with arguing, even with passionate disagreement, and people resort to guns, then we have lost something fundamental to our democracy. But in these horrible moments, it is essential that leaders across the board condemn all political violence, and not just the political violence, not just some political violence. And this was brought to the fore yesterday when President Trump was asked about why he had not lowered the flags to half-mast when our friend Melissa Hortman, Speaker Emerita of the Minnesota State House, was shot in her own home. And he acted as if he wasn't even really sure who she was. What we need right now are leaders that stand strong against political violence across the board, regardless of who the targets are of that violence. That's what we need the president to be doing. That's what we need everybody to be doing.
Well, it was noted, of course, that the president did not call Governor Walz after the Minnesota assassination. What do you make of the different reactions that we've seen from the administration to these events?
Well, what I am fearful of is that in this moment, the president and his administration, the vice president, are talking explicitly about how they intend to turn the full force of the federal government against folks that they perceive to be their political enemies, the so-called radical left. And this, again, breaks a fundamental compact in how we think about our government. Free speech should be free for everyone, not just free speech for those that agree with you, those that are your supporters. And so I find the comments of the president and the vice president deeply concerning in this moment when we should have leaders that are trying to bring us together rather than drive us apart.
Well, Senator, speaking of driving apart, I'd like to ask you about the latest negotiations when it comes to the government shutdown that's been looming on the horizon. Are you seeing progress being made when it comes to the asks like the extensions, when it comes to the Obamacare subsidies? Is there progress being made?
I'd like to say I see progress, but I actually don't. What I see is the president who said, I think a couple of days ago, we don't even need to deal with the Democrats on coming up with a budget. And so we sit here, we are ready to talk, we are ready to negotiate. Here's the thing. I would be willing to talk with anybody who wants to work with me about putting together a budget that's going to lower healthcare costs for my constituents. But if there's no conversation, if the Republicans are just saying, we don't need you, then I don't know how we get off of the dime. I don't know how we keep moving. And so we are, it seems to me, kind of, waiting for that outreach. I mean, I've done a lot of work in politics at the state and the local and the federal level, and I've never been in a situation where somebody would expect me to show up and vote for them when they didn't even talk to me about what it is that I need to do to protect my constituents. So that's kind of the situation. It can change. I'm hopeful that it changes because we need the federal government to be there and open and working for Americans for a multitude of reasons.
Senator Tina Smith of Minnesota, we thank you so much for your time, spending a little bit of your evening with us and giving us that update. Coming up on the program, a look into economic implications of today's Fed decision with Jared Bernstein, former chair of the White House Council of Economic Advisors. That conversation coming up ahead. But first, another on a potential government shutdown, as we were just discussing with the senator, this time with Republican Congressman Greg Murphy of North Carolina. That coming up next on Balance of Power, right here on Bloomberg TV and radio.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep, when we make hearts beat faster, and when we make them beat again. When we search for something, and when we find it. When we triumph. Even when we stumble. Iconic. When we get people moving. When we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
They haven't approached me. They haven't approached us. The Republicans who are in charge right now of the House and in charge and have a trifecta have not made any effort to be bipartisan. And so they really need to own this, right? And in the end, I think what they're trying to do is skirt their responsibility to the American people to provide them quality, affordable health care. And so, yeah, the ACA tax credits that would raise premiums significantly for people, that's a high priority for me and for a lot of other Democrats.
Democratic Congressman Suhas Subramaniam of Virginia last night on Balance of Power discussing some of the sticking points he and his party have with the proposed Republican stopgap bill that would help to avert a government shutdown. Joining us now live with his perspective from across the aisle is Republican Congressman Greg Murphy of North Carolina, member of the Ways and Means Committee, and, of course, a medical doctor. Congressman, thank you so much for your time this evening. Let's kick it off with the shutdown conversation. We were just hearing from your Democratic colleague. The speaker's talking about a CR by the end of the week. Is that the same timeline for you?
I think so. You know, we saw this happen multiple times when Democrats had all the different chambers and everything, a clean CR, just trying to keep the government funded. That's what the intention is. I hope the Democrats will understand that this is just how we keep the government funded. Look, in North Carolina, we need Hurricane Helene relief not to be slowed in any form. We need all the government institutions to be funded. And so let's just keep the clean CR and work towards the other things given the time.
With that said, would it include working towards an extension of the Obamacare subsidies that many Democrats are asking for? I was curious to hear the speaker this morning try not to conflate the two. One is a policy matter that is going to expire at the end of the year. We've got a funding matter that's going to expire a lot earlier. I'm just curious where your heart is on this, not only as a congressman, but as a physician. Should Democrats expect a negotiation after Thanksgiving?
Well, I think it's going to end up being one. You look at the premium tax credits that came in as a, quote, COVID era supplement and why that would continue, some debate why it would even continue. But if you looked at what happened during these premium tax credits, they were giving tax credits for people that made $400,000, more than that, just to have a quote afford assurance. That's nonsense. We need to get back to a reasonable number. There were also, and this was what's crazy, there were 30 million individuals enrolled who never filed a single premium. So it begs the question, how many of those were enrolled fraudulently? And, the checks get sent directly to insurance companies. So this has been a great boondoggle for insurance companies, as was the ACA. So any of the rhetoric that comes out of the insurance industry that we're going to raise premiums is really just saying, hey, we want to preserve our profits rather than actually pass down savings to patients. No. So, we're going to have to find somewhere. This thing where you pay no money whatsoever, look, we live in a world where people have to pay for things. It's on a graduated scale, obviously. There's a lot of room to discuss here, but this has nothing to do with the CR as we're moving forward. We just need to fund the government. We can have those discussions in the ensuing months. It doesn't come due until the end of the year.
Well, Congressman, I want to continue to lean on your expertise as a physician and talk about what we heard in terms of the hearing around CDC Director Susan Monteris speaking to senators earlier today. There's a big question in Washington, across the country, about whether we should be trusting the guidance coming out of the CDC. From your perch, what do you say to that?
What happened during the pandemic was tragic. We saw what should be an objective, healthy field where we don't have politics polluting medicine. We've seen this occur over the last 5-8 years, not only in what the CDC has been saying, what NIH was funding, what was happening with medical education. We saw, honestly, progressive politics seep in and pollute what should be an objective science. The CDC is not a pristine organization. They were recommending COVID vaccines for children, infants 6 months and older, when there was absolutely no data to support this. Vaccines are supposed to be for at-risk populations. In fact, the CDC had to recant its mortality data on children from COVID itself when forced to confront with some of this stuff. So, one of the things is we want to believe these institutions, but these institutions are human. They're frail. They have been involved in politics. So a healthy disruption of what's going on, while painful and while really, difficult to see at times, is absolutely needed to restore American public's trust in these institutions.
Congressman, we heard from your fellow physician on Capitol Hill. Senator Bill Cassidy today chairs the Help Committee and was talking with Monteris about the firing that Secretary Kennedy ordered. I just want our viewers and listeners to hear what he said, and we'll have you respond. Here's Senator Cassidy.
If someone is fired 29 days after every Republican votes for her, the Senate confirms her, the Secretary said in her swearing in that she has, quote, unimpeachable scientific credentials, and the President called her an incredible mother and dedicated public servant, like, what happened? Did we fail? Was there something we should have done differently?
We've only got about a minute left, Congressman. How would you answer the senator on that?
Yeah, that's a fair question. I think that's a fair line of reasoning. What happened between her and the head of the agency? There's
Should
a
she
he
have been
said,
fired?
she said kind of things. I don't know. That's a difficult challenge with things, but that when you're putting the head of an agency, you have the ability to hire, you have the ability to fire. This health disruption is painful at times. I would love to know the real, as it comes out, what happened. Those are real good, fair questions to ask. What I want America to be able to trust these institutions again, and I think it's going to take a painful time to be able to get there.
Joining us from his office on Capitol Hill, Republican Congressman Greg Murphy of North Carolina. Doctor, thank you, as always, for being with us. Coming up, Fed Chair Jay Powell says the job market is no longer very solid. After today's rate cut, we'll discuss that with Jared Bernstein, the former chair of the White House Council of Economic Advisors in the Biden administration. It's next on Balance of Power on Blue.
ओए गाइस, ये नेचुरल गैस का जो सेलिंग का ट्रेड है, कॉस्ट टू कॉस्ट पर ही निकल जाओ इसमें से। नेचुरल गैस के ट्रेड से एग्जिट कर लो। ठीक है, ये सेलिंग का जो ट्रेड लगाया है नेचुरल गैस का, एग्जिट एट कॉस्ट टू कॉस्ट। दोबारा बाय मत करना जिन लोगों ने, सॉरी सेल मत करना जिन लोगों ने सेल किया था, एग्जिट कर लेना। कॉस्ट टू कॉस्ट पे आ गया, एग्जिट कर लो इसमें से। ठीक है, भले ही नीचे आ जाए, अब इसमें दोबारा सेल मत करना, और जिन लोगों ने किया है कॉस्ट टू कॉस्ट पे निकल जाओ। हो सकता है थोड़ा नीचे आए बट नॉट इंटरेस्टेड नाउ। निकल जाना इसमें से, सेलिंग के ट्रेड में से, नेचुरल गैस में से, एग्जिट फ्रॉम दिस ट्रेड। ठीक है, जिन लोगों ने सेल किया एग्जिट कर सकते हैं नेचुरल गैस के इस ट्रेड से। क्रूड ऑयल का ट्रेड लगा हुआ है वो बाइंग का छोटा सा, दैट इज स्टिल देयर। इस सेलिंग के ट्रेड से निकल जाना, इसमें दोबारा एंट्री नहीं होगी। थोड़ा और ऊपर आएगा फिर देखते हैं। ठीक है, थोड़ा और ऊपर आएगा तब देखेंगे। इसमें से निकल जाना सेलिंग के ट्रेड से। फिर रिपीट कर रहा हूँ, नेचुरल गैस सेलिंग के ट्रेड से निकल जाना। किसी ने सेल किया था तो कॉस्ट टू कॉस्ट पे, डोंट होल्ड दिस सेलिंग ट्रेड। थोड़ा ऊपर आएगा वहाँ सेल करेंगे। अब यहाँ पर जिन लोगों ने सेल किया है नेचुरल गैस, एग्जिट कॉस्ट पर ही है, निकल जाना। ये बंदो एसएल छोटा ही है 1.5 का, बट डोंट होल्ड। थोड़ा और ऊपर आएगा वहाँ से सेल करेंगे। लास्ट कैंडल को क्लोज नहीं होना चाहिए था ऊपर, वो क्लोज कर गई है, विच इज़ नॉट गुड। प्रसाद सत्या जी, गुड आफ्टरनून। ठीक है, नेचुरल गैस का सेलिंग ट्रेड लगाया था, इसमें निकल जाना कॉस्ट टू कॉस्ट पर। ये दोबारा एंट्री मत करना। जिन लोगों ने सेल किया है, जिन लोगों ने किया है एग्जिट कर लो। फिर रिपीट कर रहा हूँ, नेचुरल गैस सेलिंग के ट्रेड से एग्जिट कर लेना। लास्ट कैंडल अननेसेसरली अब ऊपर क्लोज हो गई, इसको होना नहीं चाहिए था क्लोज लॉजिकली। इसको नीचे ही आना चाहिए था क्लोजिंग बेसिस पे। ब्रेकआउट हो सकता है बट क्लोजिंग बेसिस पे 272.6 के नीचे क्लोजिंग होनी चाहिए थी, जो कि नहीं हुई है। तो मेरे अकॉर्डिंग तो इसमें बिल्कुल भी होल्ड नहीं करना है। ठीक है, अच्छा लेवल था, काफ़ी देर रुका रह गया यहाँ पर। ये ना गलती से कुछ ज़्यादा ही कंसोलिडेशन में चला गया यहाँ पे। ठीक है, कॉस्ट टू कॉस्ट पर ही है, एग्जिट कर सकते हैं। थोड़ा ऊपर आएगा तो ऊपर के लेवल से देखेंगे सेलिंग, एक फ्रेश सेलिंग, यहाँ पर नहीं। सिल्वर MCX का व्यू होल्डिंग अ पुट शॉर्ट पोजीशन। किस लेवल पे लिया था ये पुट ऑप्शन, एक बार बता दो किस लेवल पे लिया था पुट ऑप्शन MCX में? आ गया देखो, कॉस्ट टू कॉस्ट पे निकल जाना इसमें नेचुरल गैस के ट्रेड से। ठीक है, कॉस्ट टू कॉस्ट पे आ गया, एग्जिट कर लो। जिन लोगों ने सेल किया था, फिर रिपीट कर रहा हूँ, एग्जिट कर लेना इसमें से। मैं इसको रिमूव कर रहा हूँ क्योंकि अब ये ट्रेड मैं यहाँ पर इसको कंसिडर नहीं कर रहा हूँ। लास्ट कैंडल ऊपर क्लोज हुई थी, विच इज़ नॉट गुड एज पर माई सेटअप। हो सकता है सेलिंग आ जाए, बट आई एम नॉट इंटरेस्टेड नाउ। तो एग्जिट कर लो जो लोग इसमें सेलिंग में थे, अगर यहाँ सेल कर दिया था। अगर थोड़ा और ऊपर आएगा तो तब सेल करेंगे वापस। ट्वेल्व 1,28,000 पुट ऑप्शन 2,500 के लेवल से शॉर्ट है। नहीं नहीं, ऑप्शन में बताता, ऑप्शन तो मैं देख ही नहीं पाऊंगा अभी चार्ट में। मेरे को MCX का लेवल बता दो, जब सेल किया था MCX कितने पे चल रहा था। ठीक है, थोड़ा ऊपर आएगा नेचुरल केस तब सेल करेंगे। जिन लोगों ने सेल किया था एग्जिट कर लेना, वो कॉस्ट टू कॉस्ट पे आ चुका है। अब होल्ड मत करके बैठ जाना, थोड़ा सा ऊपर जाएगा, अब इस लेवल से सेल प्लान करेंगे। मैंने रीजन बता दिया, लेवल के अकॉर्डिंग वो ऊपर क्लोज हो गई थी कैंडल, जो नहीं होनी चाहिए थी। हो सकता था ये नीचे आता ही नहीं, ऊपर ही जाता चला जाता, ऐसा लेट कर देता, तो उससे बेटर है कॉस्ट टू कॉस्ट पे निकलना। ठीक है, बाकी इस लेवल के आसपास कहीं आएगा तो यहाँ सेल प्लान करेंगे, आएगा तो। नहीं आता है तो कोई बात नहीं, क्लोजिंग नहीं होती तो होल्ड करके बैठ जाते, बट वो लास्ट कैंडल ने फालतू का लेवल के ऊपर ने ब्रेकआउट करा दिया। देख लेते हैं एक बार MCX को, सिल्वर MCX। पुट लेके बैठे हो आप? लाइक 26,600 के लेवल से 1,26,600, 1,26,600 के लेवल से पुट लेके बैठे हो आप। मार्केट तो काफ़ी ऊपर चला गया, 1,26,600। डे हाई से सेल किया था क्या आज? आज ही किया? मॉर्निंग पे किया था तो प्रॉफिट बुक करना चाहिए था, अभी कर दिया मेरे अकॉर्डिंग, मुझे लग रहा है शायद। वो कैंडल देखो जहाँ पर वो आई थी, कैंडल ओपन इक्वल टू लो कैंडल थी, जिसने पहली बार डे हाई को टच किया है 1,26,600 के अराउंड। वो कैंडल का ध्यान रखना चाहिए था, वो ओपन इक्वल टू लो थी, ब्रेकआउट कर दिया डे हाई का, ऊपर से रीटेस्ट भी किया है शायद, आई थिंक। पुट शॉर्ट किया है, अभी तो कह रहे हो पुट लिया था करके। पुट शॉर्ट पोजीशन, अच्छा पुट शॉर्ट किया है, ऐसा बोलो फिर। पुट शॉर्ट किया, पुट शॉर्ट किया तो होल्ड करके बैठ सकते हो। डे हाई का ब्रेकआउट कर चुका है ऑलरेडी, ओपन इक्वल टू लो बनाया था, ब्रेकआउट इज ऑलरेडी डन। हाफ प्रॉफिट बुक करके ट्रेल कर लो। ऊपर एक सपोर्ट था, सीधा ब्रेकडाउन हो गया था, कल रिटेस्ट भी कर ही चुका है। ठीक है, हाफ प्रॉफिट होकर के ट्रेल कर लो। एक सेकंड टारगेट रखना चाह रहे हो तो 1,28,300 का 1,28,300 का रख सकते हो। बुक द हाफ प्रॉफिट एंड ट्रेल, ये एक सपोर्ट है, था मतलब। दो तीन बार यहाँ से सपोर्ट लिया था, कल ब्रेकडाउन कर दिया था इसका शायद 9:15 के अराउंड। कल 17 थे ना, कल ब्रेकडाउन किया था, कल ही रीटेस्ट कर दिया था। आज उसी में सेलिंग आई थी तो दोबारा उसी रीटेस्ट जोन पे हो सकता है रीटेस्ट करके वापस नीचे ना आ जाए। ट्राई कर सकता है एक बार 1,28,300 को टच करने का, वहाँ पर एक गैप भी है। तो हाफ प्रॉफिट बुक करके ट्रेल कर सकते हो। फाइनल टारगेट 1,28,300 का रख लो, एंड ट्रेल कर रहे हो तो रिमेनिंग क्वांटिटी का असल कॉस्ट पे रखे रहो। रूट के रेट का ध्यान रखना, सिर्फ 20 पॉइंट का एसएल है, मिडिल ऑफ द लेवल ट्रेड लगाया है, लेवल पे तो आ ही नहीं रहा। ऊपर रेजिस्टेंस पे थोड़ा सा हाई लेवल का वेट कर रहे थे, वहाँ पहुँचा नहीं, नीचे आएगा तो सपोर्ट पे एग्जैक्टली तब देखेंगे। तो ये छोटा सा एक एसएल है 20 पॉइंट का, नॉट मोर देन दैट। वॉलेटाइल काफ़ी है मॉर्निंग से। ये बाय द वे नेक्स्ट मंथ का फ्यूचर का चार्ट है। एक शार्प सेलिंग आई, फिर एक शार्प बालिंग, अगेन शार्प सेलिंग में है, तो एक रेंज के अंदर है फिलहाल के लिए। गोल्ड फॉरेक्स, गोल्ड भी यार बुलिश ही बना हुआ है वैसे तो। कल जो डेटा आया था इतना था नहीं पॉजिटिव। फेड रेट कट का जो डिसीजन था दैट इज़ नॉट पॉजिटिव फॉर गोल्ड। बेरिस भी नहीं था बट पॉजिटिव जितना एक्सपेक्ट कर रहे थे उतना था नहीं, क्योंकि रेट कट हुआ नहीं जितना एक्सपेक्टेड था, सिर्फ 25 बेसिस पॉइंट। बट अभी रिकवरी आई तो है लोअर एंड से, ऑल टाइम हाई से तो काफ़ी दूर है अभी। अच्छा वो रीटेस्ट वाला रीटेस्ट पे है ना। पुट के ट्रेड का ध्यान रखना, एसएल जाएगा तो होल्ड नहीं करना है। नेक्स्ट सपोर्ट फिर नीचे है, वहां देखेंगे, क्योंकि अगर रेंज पे रहा तो कुछ मिलेगा नहीं, रेंज के अंदर ही है अभी भी मार्केट। वन आवर में अच्छा वो लिक्विडिटी वगैरह पे कम क्वांटिटी में। ओके क्रूड ऑयल का एसएल जाने वाला लग रहा है चल जाएगा तो निकल जाएंगे होल्ड नहीं करेंगे ठीक है यार ये ना ब्रेक डाउन दे रहा है ना ऊपर जा रहा है या तो ऐसा लेट कर देता कि नेचुरल गैस में भी थोड़ा ऊपर आएगा तभी सेल करेंगे, अदरवाइज नहीं करेंगे अभी यहाँ पर। चार पॉइंट और ऊपर चाहिए, समथिंग अराउंड। दिखाओ ब्रो लिक्विडिटी कैसे निकल गई थी, तभी लग रहा था वहां पर से कुछ हो रहा है करके। वो लिक्विडिटी वहां से ले गया बना टाइम फ्रेम पे। Look at the volume profile. यहाँ जाएगा तो लोअर आई, देन लोअर लो। ये देखो, ये क्रूड ऑयल में जिन लोगों ने बाई किया था, ये भी अगर कॉस्ट टू कॉस्ट पे आता है, निकल जाना भाई। ऐसे तो 20 पॉइंट का एसएल है, ठीक है, बट निकल सकते हो इसमें भी, अगर कॉस्ट टू कॉस्ट के आसपास पहुंच रहा है तो निकल जाओ, ठीक है। एसएल जाएगा नहीं तो इसमें मोस्ट प्रोबेबली वेट करना बेवकूफ़ी है, बीच में ट्रेड ही नहीं लेना चाहिए, ठीक है। इसमें भी कॉस्ट टू कॉस्ट के आसपास अगर आ रहा है तो निकल सकते हैं, होल्ड करके मत बैठना, थोड़ा नीचे आएगा तो फिर देखेंगे। बाकी अगर एसएल जा रहा है 20 पॉइंट का, लगा के छोड़ दो, जाएगा तो निकल जाना, बस कॉस्ट टू कॉस्ट पे आया तो निकल जाओ, बेस्ट केस सिनेरियो यही है। इसमें भी वही चीज़ हुई है जो क्रूड ऑयल में हुई है, ये जो कैंडल थी 3 PM वाली, इसको क्लोज नहीं होना चाहिए था नीचे, 5598 को हिट करके ऊपर ही क्लोज करना चाहिए था, वो खुद तो क्लोज हुई हुई दूसरी कैंडल को भी नीचे क्लोज करा दिया, इवन दो अभी एसएल हिट नहीं हुआ है, बट मेरे अकॉर्डिंग ये क्रूड ऑयल में जिन लोगों ने बाई किया उनको निकल जाना चाहिए, कॉस्ट टू कॉस्ट पे निकल जाओ, ठीक है। थोड़ा नीचे आएगा एग्जैक्ट लेवल पे, फिर देखेंगे, अगेन हो सकता है यहीं से नीचे ऊपर चला जाए, बट अगेन एज पर द कंडीशन वो कैंडल क्लोज नहीं होनी चाहिए थी। सेम सिनेरियो नेचुरल गैस का भी था, वो कैंडल ऊपर क्लोज हो गई थी और नीचे नहीं होनी चाहिए थी, इसलिए निकल गए कॉस्ट टू कॉस्ट पे। यहाँ पर भी सेम है, जिन लोगों ने अगर बाई करके रखा है क्रूड ऑयल में, कॉस्ट टू कॉस्ट पे निकल जाओ, मेरे अकॉर्डिंग होल्ड मत करना अब, ठीक है, मौका फिर नहीं देगा, ध्यान रखना। कॉस्ट टू कॉस्ट पे क्रूड ऑयल में जिन लोगों ने बाई किया है एग्जिट कर लो, ठीक है। आ गया कॉस्ट टू कॉस्ट पे, कोई नहीं, वो लिक्विडिटी खराब हो जाएगी नहीं तो पूरे। ट्रेड से एग्जिट कर सकते हैं क्रूड ऑयल में, इट इज़ नाउ रिस्की, इवन दो 20 पॉइंट एसएल है, बट लेना भी क्यों है इतना। बाकी नेचुरल गैस में भी सेल मत कर देना, फिर से थोड़ा ऊपर आएगा तब सेल करेंगे, आएगा तो। बाकी क्रूड ऑयल में भी जिन लोगों ने बाई किया था निकल जाओ, ठीक है। हमेशा मौका नहीं देता मार्केट ऐसे वैसे, कभी कभी रिवर्स आता ही नहीं है, बैक करके पूरा एसेलेट कर देता है, बट अभी अपॉर्चुनिटी मिली है तो निकल जाते हैं, ठीक है। क्रूड ऑयल बाइंग से निकल जाओ, बार बार रिपीट कर रहा हूँ। बाय द वे ये नेक्स्ट मंथ का फ्यूचर का चार्ट है, इसलिए थोड़ा अलग दिख रहा है। लेवल चेंज करने पड़ेंगे इसमें, लिक्विडिटी गायब है। मार्केट भी क्लोज हो गया, थोड़ा वॉल्यूम एक्सपेक्ट करेंगे, ये क्रूड ऑयल में कोई दोबारा बाय मत कर लेना, ठीक है। वही बाइंग का ट्रेड था, उसमें निकल जाओ, अभी फिर से मौका मिला है, एग्जिट कर लेना, डोंट होल्ड, जो लोग बाइंग में गए थे अगर यहाँ पे। रॉयल लेवल को करेक्ट कर देता है, ठीक है। फिर रिपीट कर रहा हूँ, निकल जाना, इसके थोड़े लेवल भी ठीक कर देते हैं। हाँ, ठीक है। वॉल्यूम प्रेशर है वहाँ पे, नहीं, कैंडल पे तो नहीं दिख रहा, वॉल्यूम शिफ्ट हो गया लगता है, चेक कर लेते हैं। प्रोबेबली तो ब्रेक डाउन, नया सपोर्ट नहीं बनता है। फिर रिपीट कर रहा हूँ, क्रूड ऑयल बाइंग के ट्रेड से निकल जाना, कॉस्ट टू कॉस्ट पे आ गया है वापस। थोड़े से लेवल चेंज कर रहा हूँ, क्रूड में भी नेचुरल गैस में भी। वॉल्यूम प्रेशर शिफ्ट हुआ है तो लेवल चेंज करने पड़ेंगे, ठीक है। ये क्रूड के बाइंग के ट्रेड से निकल जाना, कॉस्ट टू कॉस्ट पे आ गया। डोंट होल्ड एंड डोंट बाय अगेन ऑन द सेम लेवल, फिर से बाय मत करना। ठीक है, कॉस्ट टू कॉस्ट पे आ गया है क्रूड ऑयल, एग्जिट कर लेना। फिर रिपीट कर रहा हूँ, बायर्स डोंट होल्ड, हो सकता है रिवर्स कर जाए बट नॉट इंटरेस्टेड एज पर द कंडीशन चार्ट पे वो फुलफिल नहीं हुई है। तो फिर रिपीट कर रहा हूँ, निकल जाना जिन लोगों ने बाई किया था, मेरे अकॉर्डिंग तो निकल जाना। आप कोई होल्ड करना चाह रहा है फिर वो उसकी मर्जी है। कॉस्ट टू कॉस्ट पे है, एग्जिट कर सकते हो। अरे यार, आना नीचे ही है ऐसे। मैं इंटरेस्टेड नहीं हूँ, मैंने बता दिया। क्रूड ऑयल का जो बाइंग का ट्रेड था वो निकल गए हैं कॉस्ट टू कॉस्ट, एग्जिट कर लेना मेरे अकॉर्डिंग। बाकी जो रुकना चाह रहा है वो उसकी मर्जी है भाई। अराउंड हाई लेवल पे लो बना है, एक बार हायर लो, फिर हायर लो, हायर लो, ये ब्रेक हुआ तो फिर काफ़ी बड़ा गिर जाएगा। फाइनल लेवल ऊपर आता है तो सेल ही करते हैं। इसको थोड़ा सा और रिड्यूस कर सकते हैं। 6 मौका मिलेगा तो यहीं से वापस दोबारा सेल करेंगे अब। ठीक है, याद रखना अगर ये मिल जाता है मौका, अगर ये आ जाता है ऊपर तक तो यहाँ से वापस सेल कर सकते हैं। अब हो सकता है यहाँ तक आए ना आए, ये पूरा ही लेवल रेजिस्टेंस का है। लाइक भी करते रहो गाइस जिन लोगों ने लाइक नहीं किया डोंट फॉरगेट टू लाइक द स्ट्रीम
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, we'll have the latest details on President Donald Trump's state visit to the UK in a moment, but we begin this morning with a major move from Walt Disney. Its ABC network is taking Jimmy Kimmel Live off the air indefinitely. That's after the late-night talk show host's comments about the killing of Republican activist Charlie Kirk. We get the latest on that now with Bloomberg's John Tucker. John.
And in his monologue Monday night, Kimmel accused Republicans of using Charlie Kirk's death to criticize their opponents.
We hit some new lows over the weekend with the MAGA gang desperately trying to characterize this kid who murdered Charlie Kirk as anything other than one of them and do everything they can to score political points from it.
That drew an immediate backlash. Nexstar Media Group, which owns dozens of ABC TV affiliates, said it would pull the show indefinitely from its stations over the remarks that were offensive and insensitive. Well, Nexstar has business pending before the FCC, the broadcaster seeking federal approval for a $6.2 billion agreement to acquire another local station owner. It is a treacherous political climate for major media companies, and this is just the latest example of the Trump administration pressuring them to mine their talents' on-air remarks. In July, CBS announced it was ending its late-night show hosted by Stephen Colbert, who's been a critic of Trump. At the time, its parent, Paramount Global, was seeking FCC approval for its takeover by Skydance Media. Well, Disney gave no indication of when or if Kimmel's show might return. On social media, President Trump praised the move and said NBC should fire its late-night hosts. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. Now we want to get to the latest. President Trump's trip to the UK. His state visit now turns from pomp to tougher diplomatic talks on trade and foreign policy. Let's go to London and get the very latest from Bloomberg Daybreak Europe anchor Caroline Hepker. Good morning, Caroline.
Good morning, Karen. The British government will surely be delighted that the showstopper state banquet was such a hit with President Donald Trump. The King's speech was warm, but true to the man and to British concerns. The monarch pressed the need to safeguard the environment, support Ukraine, and to go even further on the recent UK-US trade deal. The president, for his part, lavished praise on the royal family, the shared history of the two countries. Here is a moment from his speech at St George's Hall in Windsor Castle.
This is truly one of the highest honours of my life. Such respect for you and such respect for your country. For many decades, His Majesty the King has epitomised the fortitude, nobility, and the spirit of the British monarchy and the British people.
The president said the word special doesn't do the relationship between the UK and US justice. Does that mean any concessions on security and trade for the Prime Minister Keir Starmer at Chequers today? The government's guiding expectations low and focused on pulling off a perilous joint press conference.
What are we expecting today at Chequers, Caroline?
Well, do the differences between the UK government and the US administration stay behind closed doors or emerge? The UK's got a different view on Israel, wants support in terms of Ukraine, says that the UK's free speech is as robust and not in doubt as ever before. So will the press conference see pointed questions for President Trump in connection to Jeffrey Epstein? The UK's also still got to appoint a new ambassador to Washington. For the moment, Starmer is pointing to this record £150 billion of investment from big US tech firms into the UK, that it will deliver 7,600 jobs here. Protests against Trump in Britain have been fairly muted. Now we await President Trump in his more familiar setting, taking questions in just a matter of hours. Is it fair to say the UK's holding its breath?
Is it? Well, we'll be watching, won't we? Bloomberg Daybreak Europe anchor Caroline Hepker, thank you. Of course, we'll be checking in with you throughout the morning.
And Karen, while the president is in the UK, he appears to have domestic politics in mind. He posted on Truth Social last night that he plans to designate Antifa a major terrorist organization. The president also says he will strongly recommend thorough investigations of groups that fund the organization. The White House has promised to investigate what it calls left-wing extremism in the wake of Charlie Kirk's shooting death. Antifa is a loose collective of far-left militant groups. Authorities have not linked Kirk's killing directly to any political organization.
Well, on Capitol Hill, Nathan, the House has killed a resolution to censure Congresswoman Ilhan Omar over her comments about the conservative activist. The Democrat from Minnesota told a liberal podcaster that Republicans praising Kirk for civil debate were full of it. Republican Congresswoman Nancy Mace proposed the resolution that would have stripped Omar of her committee assignments. 4 Republicans joined Democrats in blocking it.
Turning to Wall Street now, Karen, futures are pointed higher a day after the Federal Reserve slashed interest rates for the first time this year. The quarter-point reduction came after a significant slowdown in job growth and an unprecedented push by the White House for much lower rates. Here's Fed Chair Jay Powell.
You could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit. And inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
The decision from Jay Powell and company to cut rates a quarter point was nearly unanimous. The lone dissent came from Fed Governor Stephen Myron, who favored a larger reduction.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. The latest team to clinch a postseason berth, the Cubs. They'll be at least a wild card in the National League. They'll be their first postseason since 2020. Seattle lost at Kansas City 7-5 to end the Mariners' 10-game winning streak, and when Houston beat Texas 5-2, the Astros moved back into first place by a half game. The NFL game tonight is Miami in Buffalo, where the Dolphins have lost 15 of the last 17. The 49ers say quarterback Brock Purdy may play Sunday. He missed last week with injuries to his toe and shoulder. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity futures.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
What's special about Bloomberg Daybreak is the immediacy of the news we bring you each day in your podcast feed by 6 a.m. Eastern Time.
This isn't a deep dive on yesterday's news. Instead, you get the latest stories with context.
And that's something you don't get from other news podcasts. So join us for the best from Bloomberg's 3,000 journalists and analysts around the world, with reporting backed by data and journalists at the center of the stories we cover.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
Get Fest Go with the new Honda Elevate with bolder looks, new ivory.
Well, this is all centered on comments made by Kimmel, which focused on the response of the Trump-supporting MAGA movement to political activist Charlie Kirk's killing in Utah. And actually, for Disney, it's not really the first time they've been landed in hot water over this sort of political commentary. Actually, last year, they had to pay $15 million to settle a defamation lawsuit that was brought by President Donald Trump over comments made by their host, George Stephanopoulos. And they made this decision to suspend the show, Jimmy Kimmel Live, just minutes after Nexstar Media Group, which is one of the biggest owners of TV shows in the US, said it would pull the show indefinitely from all of its statements over those remarks that they said were offensive and insensitive. Up until that point, though, sources who spoke to Bloomberg say the show was planned to go ahead and that Kimmel was set to address the backlash on Wednesday's episode, which he had rehearsed that morning. But I mean, for Disney, this is a big deal. Kimmel is one of their biggest stars. You know, last month, despite a drop in ratings, his show still attracted over 1.1 million viewers. And for ABC, it's their longest running late night talk show. It's been going since 2003, and now it's off the air indefinitely, according to an ABC spokesperson. So a major blow.
Yeah, I mean, Kimmel was effectively trying to say that he thought the Republicans were using the killing to try to bolster their own political case, effectively. What's been the reaction to all of that?
Well, from the broadcast and entertainment industry, the reaction has been quite negative. The BBC is reporting that the Writers Guild of America, Hollywood's labour union, has condemned this decision. They said it's a violation of constitutional free speech rights. And similarly, SAG-AFTRA, another actors union, has said the move was the type of suppression and retaliation that endangers everyone's freedoms. But conversely, the Trump camp, on the other hand, is positive about this move. President Trump saying it's great news for America on social media and congratulating ABC for its courage. I mean, it's definitely an interesting time for late night TV as a whole. This is coming 2 months after the cancellation of Stephen Colbert's show. And also in other posts on social media, President Trump went on to take aim at the rest of the industry, also criticizing other late night hosts, Jimmy Fallon and Seth Meyers. So a very interesting and perhaps controversial time for the broader industry.
What about the network ABC? What have they said about all of this?
Well, they have left the suspension open-ended, calling it indefinite through their spokesperson. But apart from that, we don't have much more detail. Actually, Nexstar Media Group, who own a number of their affiliates, have been far more prescriptive in their judgment on the situation. They say they strongly object to the comments and also acknowledge the timing of them, saying they were particularly insensitive at a critical time for national political discourse. So that's what we have at the moment. Questions still around about the future of Jimmy Kimmel at the broadcaster ABC and whether or not his tenure will continue as well as that of his show.
I got to ask about the handle story that Bloomberg wrote about. You know, the door handles are flat on Teslas and the interior buttons are electric. I was recently stuck in a Corvette, which has the same kind of thing, until somebody at the parking garage pointed out that I could find the emergency latch. You have a similar system. Yes. NHTSA's looking into this now. Apparently Beijing is looking into it. Have you considered a redesign or a fix for these issues?
We actually have a mechanical release that's, basically right at the electronic one too, and we're combining the two. So, in the moment that you're in a panic situation, the muscle memory to go to, what is right there. So you just pull a little bit further on the lever and you have the mechanical release. So that's something that we're working on, yeah. And it's in the cars now.
All right, so if there is then a China ban, you're ready to roll that out so that
yeah, we're working
well actually the ban I guess the Chinese issue is the flat outer door handle. So yeah, would you do something? Would you make a change like Ferraris have that little crease you can reach into? Is there some idea about that on the outside?
Yeah, we're working on it right now and just looking at the details of the regulation if and when that happens, and we'll have a really good solution for that. I'm not worried about that.
It makes sense. I know it's one thing for us adults to know that, but for kids, it's a little bit different to expect a kid to know how to go for a manual release.
Yeah, so the idea of combining the electronic one and the manual one together into one button, I think, makes a lot of sense. It really helps to, the muscle memory of reaching for something every day is there. And so you intuitively just grab the same thing and you're free.
This year's Global Markets Conference theme is mega, making Europe great again.
Let's talk a little bit about the digital tax issue. Will President Trump now threatening tariffs make it a problem for some of these countries that actually have this levy in place?
So there isn't any EU-wide digital services tax, and as you pointed out, a small number of member states do have such a tax. We have no plans within the European Union to introduce an EU-wide digital services tax. We recently brought forward our proposals for the next 7-year EU budget, the multi-annual financial framework. We have proposed some new revenue sources, our own resources, as we would call them, but a digital services tax is not one of them. It is our view that the global corporate tax landscape is best addressed through multilateralism, and while the OECD reform process has stalled, we do take some comfort from the recent statement by the G7, and it would be our expectation and certainly our hope that by the end of this year negotiations could resume in relation to Pillar 1. So we're not looking too far ahead. Our focus is on a global agreement still. We will work in good faith to achieve an overall balanced and fair outcome, and it's too early to say what the European Union might do in the event that such a global agreement is not reached.
You're of course looking at consumer protections as well, and the EU as a whole, though, still a little bit worried about the safety standards of some of the products coming through e-commerce to the European Union.
Yeah, the overall message there is that if you are selling product into the European Union, you have to respect our consumer protection laws and also our product safety laws. And that is why we are now placing a very significant emphasis through the e-commerce communication we issued back in February on a whole series of reforms. There will be a new EU Customs Authority, a major reform to the EU Customs Code, and we're looking at a number of other changes, including addressing the duty-free threshold, for example. But fundamentally, it is about enforcement. It's about enforcement of existing EU consumer protection and product safety law. A number of actions are underway in relation to some large Chinese platforms in particular, and I will be visiting China in November and engaging directly with the authorities there to emphasise the importance of our consumer protection and product safety laws being fully respected. Unsafe products are not welcome in Europe. If you're selling into Europe, you must respect our product safety and consumer protection laws.
What have been the conversations then, Michael, so far with China on that topic? And as well, how are your issues or the concerns that you're raising there around product safety and quality being addressed? And in addition to that, how are you also planning to work with partners in Japan and also Korea to ensure the safety as well?
Yeah, thank you, Annabelle. And I'm on a mission here to Japan, and I've come from South Korea, and we have excellent relations with both countries on consumer protection issues, also on data protection and data privacy, and also justice cooperation. And those are the areas that are a priority for me on this mission. So we are engaging with both jurisdictions about what more we can do working together to strengthen the dialogue, to strengthen the cooperation, to tackle the shared challenges in relation to the very large volume of e-commerce imports that are coming into our respective jurisdictions. Last year alone, about 12 million small parcels a day were imported into the European Union, with over 90% of them coming from China, and I expect that the numbers this year will be even significantly higher. So you can get a sense of the scale of challenge that this is presenting for our customs authorities, for our market surveillance authorities who are responsible for product safety, and that's why we have to address these issues in a multilateral fashion and engage with our like-minded partners with whom we have so much in common.
So then do you expect the volume of imports or shipments from China to decline if you have that greater emphasis on product safety and quality?
I think we have to address this in a number of ways. We need to step up our bilateral contacts with the Chinese authorities, and we also need to step up our enforcement. And one of the issues that I would like to address in terms of consumer protection and working with colleagues in relation to product safety is the way that we do it within the European Union. Principally, it is a function at member state level. We do provide coordination and support at European Commission level, but I think given the cross-border and inherently transnational nature of this issue, it does make sense for the European Commission centrally to have greater investigative and enforcement powers, and that is a proposal that I'm developing with my team in the European Commission, and we will be bringing that forward over the period ahead. But we are also stepping up the enforcement that I mentioned, and under our Consumer Protection Cooperation Network and indeed under the Digital Services Act, various actions are underway and quite advanced to ensure that these platforms are obeying the EU consumer protection and product safety rules. And I think we can have good cooperation with the Korean authorities, with the Japanese authorities, given it is a shared challenge.
Have the tone of the conversations with Beijing and perhaps with the rest of Asia sort of changed given the tariffs threatened by President Trump and a more protectionist stance coming from the US?
Well, I think it just makes it all the more important that we engage with like-minded partners who are deeply committed to democracy, rule of law, fundamental rights, human rights, and indeed open and free trade. And so we have had a very successful economic partnership agreement with Japan for a number of years now. We want to deepen that relationship. We want to explore further trade opportunities. We have a new digital partnership as well, and of course a security and defence partnership. And at a time when multilateralism in the world is under so much pressure, it is vital that countries that believe in engagement, that believe in tackling global challenges collectively, that we continue to talk and we find new ways and better ways of deepening the engagement and the cooperation. And that's why I'm here in Tokyo, having come from Seoul, because these are two key partners for the European Union in the Indo-Pacific region.
In Japan, you also wanted to develop critical mineral supply chains with the Tokyo government. Have you seen any progress on that field?
So this is an issue that, like many others, would have been highlighted as part of the very successful EU-Japan summit that took place in July. And so we're now working through all of the different action points across a whole range of different areas, including in my own area of data protection, for example, where we are looking to broaden the scope of the two-way flow of personal data that we have, which will help to underpin trade flows between Japan and the European Union. And in Korea, we just concluded a very successful agreement now whereby the Korean authorities are fully recognising the adequacy of the EU data protection system, and that means we will now have mutual two-way safe data flows, which is another workout of
connecting the dot between what's at stake and what is possible.
Any conversation about global trade in 2025 has to begin with tariffs.
China, 66.
This is a real crisis at this moment.
CEO Takaya Soga and CFO Akira Kono are NYK lifers. Both of them started at the company in 1984, and they took their current roles together in 2023. They're used to facing challenges as a team.
Of course, it's a headache for us and for me as well, but I am confident to find such a way of continuing the business itself. I am a kind of the guy, a little bit too much optimistic.
That's a good thing.
No.
That's a good thing. But when you're talking about all of these global headaches that you're facing, how important is it to have really a trusted partner when it comes to the chief financial officer?
Even though I say the very optimistic future or plan, always he is making the very bitter comment on that part. And then it is quite good for me to review quite objectively this issue is okay or not, or this would be okay in 10 years later, or that is quite helping.
だけど来週 IR にまさにニューヨークと今回は I try to be the optimistic as well, but as a CFO, I'm trying to be anxious and prudent. At NYK, the CFO's role is not only for the financial oversight, but also the working together, collaborating with the CEO.
With a diverse portfolio of businesses supported by a fleet of nearly 900 vessels, NYK has a solid foundation for sustained growth, even at a difficult moment for trade. Its CFO plays a critical role in setting a path forward and keeping it on course.
He's a really important partner for me, for management, not only for the financial area, but also looking at the next decade or even the 2 decades, what our company should stand, and also what direction should be most appropriate. Always we are discussing together.
NYK is coming off a strong 2024, with revenues and profits both rising significantly year over year. The company knew tariffs would have an impact in 2025, but how much? Its initial forecast put the hit at anywhere from 0 to 100 billion yen.
It was very much uncertain what happens on our business. We calculated many, cases. Then we set maximum 100 billion Japanese yen. That's negative impact by the U.S. import tariff.
After the first quarter, NYK reset its guidance, predicting the drag from tariffs on recurring profit will be 24 billion yen in 2025. Meanwhile, it's forging ahead with plans to advance its core business. A major investment target is liquefied natural gas, expanding a fleet that's made the company one of the world's leading LNG carriers.
Why is LNG such a key focus for you?
Everybody is looking at energy transformation from the viewpoint of the decarbonization. LNG is very much important for the transition type of the energy. In line with that, inquiries about the new business about the energy transportation is also increasing right now. We received a lot of such a proposal. So from that viewpoint, we need to expand our fleet.
When we talk about global LNG, there has been certain tailwinds because of some factors that are policy driven, as well as some drive towards more reachable goals in the midterm for energy mix in countries like Japan.
Global LNG demand has been steadily rising. Still, Bloomberg New Energy Finance predicts that by 2030, a wave of new supply projects will create a glut and drive down prices. NYK says the stability of LNG contracts shields its business from these shocks.
Of course, we have some cost fluctuation. That's a risk. However, compared with the other shipping business, it's very stable and a long-term contract.
Even if there is let's say, a drop in LNG prices, then we will probably not going to see as much change in LNG import because there is countries like Japan that has significant volume locked into things like Brent oil linked price or Japan crude average.
Its energy business is expected to provide 20% of NYK's recurring profit in 2025 and reach 30% by the end of the decade. The LNG push dovetails with a key pillar of NYK's strategic plan, its Sail Green initiative. While setting a goal to achieve net zero by 2050, Sail Green also pursues growth through investment in decarbonization technology and renewable energy. That portfolio is the responsibility of the CFO.
I'm directly in charge of the sustainability issue, like the ESG. And especially the decarbonization, that's one of the big challenge for the company to achieve the net zero by the 2050.
The fact that we're seeing some sort of backlash globally, especially in the United States, against some of these ESG targets, does that take away the momentum of some of the work that you're doing?
Yes, I feel the situation has been changed slightly, but in the long run, I think decarbonization and climate change is a very, very important issue for the companies and also global.
Despite trade tensions clouding the horizon, Kono is confident he has the resources to steer NYK's finances through any turbulence that results.
During the COVID-19 pandemic, especially the container business and the car carrier business, the supply and demand was very, tight. That's why the rate was going up dramatically and almost a skyrocket. So then, after the COVID-19 pandemic, we have the strong balance sheet and strong liquidity. So we can think about what happens next.
This healthy capital position has given NYK the opportunity to boost shareholder returns. It's seizing the moment, raising the payout ratio and the minimum dividend per share, and introducing a new buyback program.
In order to grow our operation, we need investment. So now it's a kind of a balance. We reserve some portion for the new investment, for the growth. And the other part is we return our profit to our shareholders. And our current market cap is not so satisfactory. So that's one of the points. And we decided to increase the distributions and also the share buyback.
Do you have a target in mind when you think about your market cap?
At the moment, our PBR at below the 1.0. So then I think at least our company's value and enterprise value should be more than 1.0.
There's another reason NYK is paying close attention to investor relations right now. Shareholder activism is on the rise in Japan.
We have seen the increase of numbers of activist campaigns in the last couple of years. And what we have seen is really the evolution of the agenda from a more confrontational approach to engagement-based approach, asking for better capital allocation and then also better communication to the market, which has been, I think, one of the discounting factors for Japanese corporates. The focus has shifted towards a long-term value creation rather than short-term.
Soga and Kono have both been spending time speaking to shareholders and hearing their concerns.
Both of us are doing IR. He is going to the New York, I am going to the London. Like that, actually we are talking always together. And then what point we need to focus in front of our investors.
We have not received the shareholders' proposal at this year's General Assembly meeting. But basically, when I have the IR, Investor Relation meeting, with the Japanese investors or the foreign investors, sometimes they pointing out the low ROE and the return on equity, and also the disclosure on each business sectors.
We are doing a very, very necessary investment on our future growth of our value. At the same time, we also pay the return to the shareholders at the same time.
Does it at the same time also help keep these activist investors who have been very active here in the Japanese market recently at bay?
That is one of the ways of protecting ourselves, I think.
Coming up, a peek at the next generation of NYK vessels that will make shipping greener. CFO Akira Kono takes me aboard the world's first commercially operating ammonia-powered tugboat.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
This is Bloomberg. Akira Kono has spent his entire professional life at the global shipping giant NYK, stepping into his current role as CFO in 2023. When he showed me around the company's container terminal in Tokyo, it was more than a tour, it was a homecoming.
I feel the nostalgia. I joined NYK in 1984, and I started my career from here.
Kono's career path at NYK has taken him to several different parts of the company and several cities around the world.
I worked in London, and at that time I was in charge of the energy sector, and especially the energy business. And before that, I used to work in the States and New York City, and for the car carrier business.
In 2024, the liner and logistics business accounted for almost half of NYK's total revenue.
This is the NYK Venus, 2,000 TEU capacity. And,
that segment includes container shipping, which draws strength from a partnership formed nearly a decade ago.
In 2017, we decided to merge our container business with the other Japan's liner business, like the Mitsui OSK and the K-Line, because at the time our scale was not so big to compete against overseas competitors.
NYK is the primary shareholder in this alliance of Japanese shippers called Ocean Network Express, or ONE. It's now the world's 6th largest container shipping line.
After COVID-19 pandemic, and they generated significant profit. And then they expanded the global network. The efficiency is much more than the one we used to operate alone. That's a big change.
As part of its Sail Green initiative, NYK has committed to expand its fleet of alternative fueled ships. Right now, that's mainly LNG. At the same time, it's developing and testing green ammonia and other next-generation biofuels in an effort to speed up the energy transition. A few miles south of the container terminal at the port of Yokohama, NYK's sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book. The industry is working in partnership with governments to scale up its decarbonization efforts.
Investment in alternative marine fuels have soared extraordinarily. We have seen strategic corporate initiatives multiplied by almost 28-fold, and also venture capital and private equity investors have poured in around $2.2 billion just in the past 4 years alone. The large shipbuilding nations like China, South Korea, and Japan are setting up national programs to support the transition.
This is funded by the NEDO, so-called Japanese agency, and also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting usage of the ammonia as the power-generating fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, and the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. The next year, we expect to have the large-sized ammonia carrier powered by the ammonia, and this is also supported by the GI fund. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
Coming up, Tariffs aren't the only tool the U.S. is using to impose its will on global trade. Shipbuilding is another battleground, and NYK has a stake in helping Japan succeed.
Sometimes we are working together with our customers as a partner, and if they prefer Japanese shipyards, that's good for us because we are the Japanese company and we have the very good relationship with the Japanese shipyards.
This is Bloomberg. The global shipping industry has spent 2025 dealing with escalating trade tensions around the world. Tariffs have gotten by far the most attention, but the U.S. Trade Representative has also announced it will impose port fees on ships linked to fleets with Chinese-built or Chinese-flagged vessels in a bid to diminish China's dominance in shipbuilding. Bloomberg Intelligence estimates these fees could cost container shippers $10 billion annually.
At this moment, almost 8% out of our total fleet is made in Chinese shipyard. So therefore, operationally, it is quite okay for us. We can just have those vessels operated in the other trade. But for future shipbuilding plan, some of the ships like LNG carriers, that is not able to build up in Japan right now. And all those opportunities are given to the China and Korea. And the majority of our fleet of the LNG carriers are made in Korean shipyard, and a quite small number is Chinese shipyard. Basically, we would like to make order to the Japanese shipyard, even from the viewpoint of the national security. But for like LNG ships, which is now only possible to build in Korea and China, we may have a chance to place an order to China.
Our business, sometimes we are working together with our customers as a partner. So then they have their own preference. And then if our customer prefer to have the vessels built in China, then we work for that. And if they prefer Japanese shipyards, that's good for us because we are the Japanese company and we have the very good relationship with the Japanese shipyards.
China's share of new shipbuilding contracts did take a considerable hit in the first half of 2025 after the USTR announced the fees. Goldman Sachs told investors it sees these levies as an opportunity for Japanese manufacturers to gain market share and notes that benefits could carry over to the nation's shipping companies.
Does a thriving shipbuilding industry also mean a thriving NYK shipping transport?
Yes, that's right. Particularly the Japanese shipyard industry is getting weaker and weaker in the last 20 years. So therefore, it is a role, very important role of NYK to support them to revive their industry in Japan more and more.
As NYK navigates challenges and steers through headwinds, it's counting on CFO Akira Kono to keep a steady focus on the future. I asked him what he sees when he looks ahead.
What's the opportunity for NYK that most excites you in the next decade?
We are promoting the decarbonization shipping very much. And now we are having LNG fueled vessels, and that will be increased in the coming years. But beyond that, we need carbon neutral vessels or the zero emission vessels. Then that's additional value for the customers and for the shareholders and stakeholders. That's a big business opportunity for the company, I think.
What's the challenge for NYK in the next decade that you're most concerned about?
One is to expand our core business. And the other point is to explore the new business opportunities like environmental friendly business, like the offshore windmill projects and alternative fuel projects. That's still the challenge we have. So then to allocate our capital to those two business areas with balance. That's one of the challenges, I think. And I believe that we can overcome such challenges, and I believe the company can grow further.
Complete this sentence for me. The hardest part of being a CFO is?
To make the balance between the rigorous financial discipline or the oversight, and also the fostering the new business growth. That's the biggest challenge for me.
You have a friend and they call you and then they say, I got promoted to becoming a chief financial officer. You congratulate them, but then what's the first piece of advice that you would give them?
Probably I would say, and that's a very comprehensive role, not only for the finance, but also the business itself, the inside of the business, working together with the partners and working together with the colleagues and other managements. Communication is very, very key for the role. That's my word for the new guy.
I'm Sherry Yan. This is Bloomberg.
News when you want it with Bloomberg News Now. I'm Karen Moscow. We want to begin with some breaking news. NVIDIA has agreed to invest $5 billion in Intel and said the two will co-develop chips for PCs and data centers, a surprise move to help prop up an ailing arch rival. NVIDIA will buy Intel common stock at $23.28 per share, a 6.5% discount to Wednesday's closing price. Intel will use NVIDIA's graphics technology in upcoming PC chips and also provide its processors for data center products built around NVIDIA hardware. The two companies did not offer a timeline for when the first parts will go on sale and said the announcement does not affect their individual future plans. Intel shares rising on the news, up more than 21% this morning. Also breaking, the Bank of England holding interest rates at 4% and left the prospect of more cuts later this year in doubt after growing concerns over a resurgence in inflation. The Monetary Policy Committee voted 7-2 in favor of keeping rates unchanged. The decision and vote split were expected by economists. It kept guidance warning that future cuts will be gradual and careful and depend on the extent to which underlying disinflationary pressures continue to ease. Now to the latest on Jimmy Kimmel Live, and Walt Disney's ABC network is taking the show off the air indefinitely amid a backlash to remarks the late-night host made about the killing of Republican activist Charlie Kirk. We get the latest with Bloomberg's John Tucker. John, good morning.
And good morning, Karen. Disney announcing the decision minutes after Nexstar Media Group, which owns dozens of ABC TV affiliates, said it would pull the show indefinitely from its stations over remarks that it termed offensive and insensitive. In his Monday monologue, Kimmel said, quote, "We hit some new lows over the weekend with the MAGA gang trying to characterize this kid who killed Charlie Kirk as anything other than one of them." Brendan Carr, the chairman of the Federal Communications Commission, told podcast host Benny Johnson that he had a strong case to punish Kimmel, ABC, and Disney.
Broadcasters, and you've gotten this right, are entirely different than people that use other forms of communication. They have a license granted by us at the FCC, and that comes with it an obligation to operate in the public interest.
Well, Nexstar has business pending before the FCC. The broadcaster is seeking approval for a $6.2 billion agreement to acquire another local station owner and needs Carr's support. It's not the first run-in media companies have had with the Trump administration. You'll recall in July, CBS announced it was ending its late-night show hosted by Stephen Colbert, who's also been a critic of Trump. At the time, CBS parent Paramount Global was seeking FCC approval for its takeover by Skydance Media. Well, in a post on Truth Social, President Trump cheered ABC's decision and then called on NBC to fire its late-night hosts, Jimmy Fallon and Seth Meyers. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. After a day of pomp and pageantry, President Trump's visit to the UK now turns to tougher diplomatic talks on trade and foreign policy with Prime Minister Keir Starmer. Yesterday, the president talked of the two countries' shared destiny and their so-called special relationship.
Seen from American eyes, the word special does not begin to do it justice. We're joined by history and fate, and by love and language, and by transcendent ties of culture, tradition, ancestry, and destiny. We're like two notes in one chord.
And Donald Trump speaking at the state banquet in Windsor Castle. And diplomatic talks later today, the Prime Minister, Keir Starmer, hopes to press Trump on trade terms and the war in Ukraine, although major breakthroughs are not expected. Futures are higher a day after Fed Chair Jay Powell rallied policymakers to back the central bank's first interest rate cut of the year. The quarter-point reduction came after a significant slowdown in job growth and an unprecedented push by the White House for much lower rates. But with the effects of tariffs on inflation still uncertain, Powell made clear the Fed officials will face difficult trade-offs as they consider whether to keep cutting.
While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated.
Jay Powell and the Fed's decision to cut rates was nearly unanimous, the lone dissent coming from Fed Governor Stephen Miron, a close ally of Donald Trump, who favored a larger reduction. And again, NVIDIA has agreed to invest $5 billion in Intel, and Intel shares are rising on the news this morning, up now 28%. Futures are also higher, with S&P futures up 0.9%, Dow futures up 0.7%, NASDAQ futures up 1.2%, and the 10-year Treasury yield at 4.05%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
The firm writing in a statement, quote, Brian, of course, in London, and we're here in New York. You're actually in our home, and we're in yours. So thank you, sir, for making that happen. Brian, let's get to this leadership shake-up, because we've got a lot to talk about. 8 lines of business, 2 very prominent individuals in this bank, at this institution. How do you and the team plan to split up responsibilities?
Well, it's good to talk to you both, and thank you for coming to our great corporate headquarters. Hopefully they're treating you nicely out there. Look, this is a recognition of 3 teammates, Dean and Jim and Alistair, and the contributions they made to our company, and bringing Jim and Dean to help me leverage across the businesses. And there's a lot of initiatives we conduct across the company, our growth work streams, our operational excellence, our AI initiatives and things, and I've asked them to come help me. Meanwhile, it also frees up space for that talent group, and you're talking to a lot of them today, whether it's Lindsay or Eric or Wendy and others that continue to drive those 8 businesses for us and own the business, own the responsibility for P&L, and there's a lot of talent at that level. So the idea is to bring them to help leverage my time, leverage the company's time, leverage the company-wide initiatives, and then let that talent that drives those businesses keep making great progress.
Brian, there is an obvious, perhaps uncomfortable question. Some people might have responded to this and just thought, is Brian setting up for succession? Or is this just about changing how the company's run?
Well, long term, we have one of the duties that I and the whole management team owes the board of directors is a series of candidates that have the experience to run this company over time. I'm not going anywhere in the short term, but in the medium term. But it takes a while to set that up and get people used to the size and scale of this company. So you all report all those ins and outs of succession. But the reality is we're a team and we're driving for it. There's a lot of talented teammates, and the board will have to make a decision someday based on the facts and circumstances at the time.
Brian, you talk about some of the new initiatives and looking forward to the bank, the Dean and the Jim that will be of the future partnering together. I'm wondering what you're hoping they can accomplish, whether it's the AI initiatives or beyond. What kind of projects you're hoping that they will spearhead?
Well, we have a lot of things going. For the last year, we've been working on some work streams to help drive expense efficiency and implementation of new technologies, and at the same time drive growth, how we take risk and continue to look at our risk parameters. And so what I'm asking them is and they've helped drive those while they've been doing their old jobs, and I've said, come do this full time, and that'll give us more leverage across the platform. Our company has a great reach. We have, we're all over the globe, and Bernie Menz and the team here out of London run all the international businesses for us. We're in a lot of countries, a lot of teammates around the world. We just announced 1,000 more teammates that we're building out here in UK, and they can help the company drive that and put the key of the top big company like ours is to work the seams, work the business connections. And so Jimmy and his capabilities as he works with the wealth management group and Lindsay and Eric on the clients that we have, especially in the higher end clients that he has relationships with who are hedge fund operators and things like that. So there's a lot of initiatives, but it's really about revenue growth, organic revenue growth, and expense efficiency, and also thinking through how technology applies. And it just gives me more power at the top of the house to join us, and these teammates have done a great job.
I imagine it's going to be united front at the Investor Day in November, the first one in some 15 years. You mentioned the CFO, now Executive Vice President, Alistair Borthwick, said this: the most important thing from our perspective is we feel like we've got an opportunity to close a relative value gap. Brian, can we talk about that relative value gap? Where do you think that comes from? What is it that you think perhaps investors don't fully understand?
Well, if you look at the company, you have a great organic growth engine. So we'll do 1 million new checking households, and our average checking balances are 3 times, 4 times the industry norm, and we're building that up. What we're trying to showcase is what Bank of America is an organic growth machine on a very steady compounding basis. So if you look at the projections for our earnings growth rates by the street, they're faster than the average company as the balance sheet reprices and things go on. But what we're really trying to showcase is to put on the table basically the metrics that we run this company by across the 8 lines of business and how they work together, and then the international piece, and then AI and some of the other things we work on, the payments business, which is embedded in the lines of business but is a separate business. It really showed 3 things. We have a competitive position that no one else has. We just announced yesterday the largest small business lender. We have a competitive growth rate in the organic growth that's there. And then because of our the dynamics of our NII lift, which it will be growing, as we've told people, 6 to 7% this year, you're going to see the EPS keep kicking in and the operating leverage come into the business, and the return on tangible common equity keeps moving up. And that's what we lay out. But it gears off that good core organic growth with the right risk that we drive this company by.
Brian, as John was just mentioning, this is the first in 15 years. Why now? What changed for you? And is this going to be a new annual thing?
I think we have 35 analysts that cover us. We spend time at all the conferences. We spend time individually. But think about it, putting on the table where the company stands right now as we see after the pandemic and after the interest rate changes and after inflation fights and all that stuff. We see that people putting on the table where we are in organic growth and how it works together is critical. And I think, you should expect us to do it more often. We have a lot of connectivity to the people who actually own our stock and talk to them all the time. But this is a chance to sort of lay it all out so everybody can see it together. And to look at some of these initiatives that are unique, like our employee banking investment initiative, our continuum, our Merrill Edge through Merrill Lynch and the private bank, and the ability for us to take a customer literally from their first bank account their entire life, and no matter what happens to them on an individual side, or a small business forming today that becomes the largest company in the world, or an individual trader that builds up a capability and becomes a hedge fund manager. The idea of these continuums and things like that are really important. And so we hope to put that on the table and make sure people see it, and then we'd annually update it, but sort of put a baseline on the table.
So, Brian, it seems like you're moving toward a greater degree of transparency, or at least availability, at a time where the president is talking about potentially moving from a quarterly reporting system for public companies to a 6-month reporting season. Do you think that would be helpful for you as a business manager if you had to report less frequently in terms of filing?
In the end of the day, we run the company along the principles of responsible growth and how we run it. So it won't change how we run the company. It may change how often we have to talk about it. And inherently, if you do it 2 times a year versus 4 times a year, you'd save some money and some effort. But my guess is our investors are going to demand from us more constant reporting. So we'll see it all play out. It's an initiative that was talked about over the last several years. If it's going to get done, it has to be done the right way. So it remains in place. And we look forward to what comes out of the SEC in the process. But on the other hand, we are very transparent in what we do. We put a lot of information out there, things like our digital capabilities that no one else reports on, quite frankly. And again, with the Investor Day, we'll be able to show that and really challenge people to say, look, if this is what's going on, if you've taken a company that had 300,000 people 15 years ago that has 212,000 people today and applied that technology, just think as we start to apply AI more fully. We already have Erica, 3 billion customer interactions, but as that applies more fully, you'll see the ability for us to continue to manage the headcount in the company well while the revenue keeps growing. And so I think we'll report on that more often than every 6 months is my guess, based on the demand of our investors.
Lisa, I imagine some CEOs might welcome this.
Yes.
Even if some investors don't.
They might welcome this, but will they be allowed to actually follow it by their investors? And that, I think, is what Brian is alluding to.
I think investors will demand much more transparency. Brian, I want to talk about an initiative close to your heart.
It is the first week of September. Our clients are just back from the holidays, and we've gathered over 1,000 of them with us today, and we're going to help them piece together a strategy.
Clients are in the room and they're here to hear more about investment opportunities in Europe, possibly in Japan, in China. We're here to help, and we can help them find those opportunities. We can advise them on how to position their trades, and then we can facilitate and give them access.
The news that we got about 15, 25 minutes ago, that you're increasing the minimum wage to $25 per hour. I remember a very early conversation with you, and this is something you're very proud of. This has gone up from, say, 15 several years ago. Can you talk to us about why you've maintained this commitment to driving the minimum wage higher at Bank of America?
Sure. So let me set two things up. One, over the course of today and tomorrow and yesterday, we've announced a series of initiatives. One is to locate 1,000 new teammates in the UK that will work in our operations group, and that was announced by Bernie and Tom Scrivener. A second one is to recommit to our military hiring at Bank of America, 10,000 military veterans over the next 5 years. We've done this from time. We have about 20,000 working to increase that. Another is to increase 8,000 people from community colleges to present an opportunity at Bank of America to further their career and get into skills-based training. That's a doubling or tripling of what we do today. And then the 75 branches that we're deploying and the teammates there. Then the third piece is the minimum wage. And so we started on a travel a number of years ago with a view that we want teammates to come to Bank of America with a career mindset. So join us. So today we're announcing $25 an hour, which is $50,000 for a starting salary across the country, and higher in some places where the prevailing wages are higher, obviously. But what that gives a teammate a chance to join our company, spend their whole career here, and support their families. So not only is it the $25 an hour minimum starting wage, it's the benefit structure, which is a full 401k match, a full benefit cost that for the teammates in the brackets of $25 an hour, we basically dropped their premium coverage in healthcare in 2012 from $500 a month to $250 a month for family. Have never raised it to provide great health care for them, and then our child care benefits. So it's a package. So where's that payback for the investor? Where that pays back to the investor is the turnover rate when we started this program in the high volume operations groups and the branches was 20%. It's now down to basically 10% or so.
Hey guys, 5:30 होने वाला है लंदन सेशन के बाद न्यूयॉर्क सेशन इज गोइंग टू ओपन. क्रूड ऑयल से कुछ उम्मीद ही नहीं हो रही. क्रूड ऑयल में कुछ मत करना है. अब 5:30 के बाद ही देखते हैं. लगाया जरूर है ट्रेड, लेना मत इसको. रेंज के अंदर रेंज बनाए जा रहे थे. कैंडल क्लोज होगी तो फिर और चला जाएगा ऊपर. लेट्स सी. सेलिंग के ट्रेड को लेना मत. लेट इट गो, जाने दो. कैंडल ही ऊपर निकल रहा लास्ट वाली देखते हैं उसके बाद क्या होता है. उसमें लिक्विडिटी नहीं आ रही है लेवल पे. Yes, that to be difficult. क्रूड ऑयल में सेल मत करना अभी, ठीक है. 5:30 की कैंडल क्लोज होगी फिर देखते हैं. डोंट सेल डायरेक्टली इन क्रूड ऑयल. वेट फॉर द 5:30 कैंडल. बड़ा ही अजीब मार्केट चल रहा है. दोनों साइड मूव कर जा रहा है. एक साइड लिक्विडिटी ग्रैब हो रही है, दूसरी साइड पे निकल जा रहा है. ऑयल में सेल मत करना इस ट्रेड को अभी. 5:30 की कैंडल देखते हैं पहले कैसी बन रही है, फॉर्म हो रही है. डोंट सेल इन क्रूड ऑयल. सेल मत करना क्रूड ऑयल में. 5:30 की कैंडल क्लोज होने दो फिर देखते हैं. ओके 4 मिनट रह गए हैं, देखते हैं कहाँ आती है क्लोजिंग। उसमें आई नहीं लिक्विड, यहाँ पर साइडवेज चला जाएगा नहीं तो पूरा। तो वहाँ सपोर्टिंग है, फिर भी रुक रहा है प्राइस। लॉजिकली तो लिक्विडिटी लेके वहाँ से निकलना चाहिए था, मोमेंटम नहीं आएगा नहीं तो। ठीक है, फिर रिपीट कर रहा हूँ, क्रूड ऑयल पे सेल मत करना अभी। डोंट सेल इन क्रूड ऑयल। ओके, न्यूयॉर्क सेशन इज ओपन। लेट्स सी कैंडल कहाँ क्लोज होती है। नहीं, मैं तो नहीं हूँ। कैंडल क्लोज होने वाली है 4 मिनट में। कैंडल क्लोज होती है और देखते हैं क्रूड ऑयल में। अभी एंट्री मत करना, उसमें सेलिंग की। बहुत ज़्यादा वॉलेटाइल हो रहा है, दोनों ही साइड मूव कर जा रहा है मार्केट। नीचे लग रहा था ऊपर नीचे आएगा, ऊपर जा रहा है, ऐसा लग रहा है नीचे नहीं आएगा। वेरी टफ मार्केट। ठीक है, क्रूड ऑयल में सेल मत करना अभी। नहीं बनेगा ट्रेड तो मत नहीं लेंगे, सिंपल सी बात है। हाँ, ठीक है। वॉल्यूम डिक्रीज हो रहा है इसमें तो। ओके। नेचुरल गैस डायरेक्टिव शुड बी इनिशिएटेड व्हेन नेचुरल गैस एंटर बीजेड। अभी कुछ नहीं बना है नेचुरल गैस में भाई, नेचुरल गैस भी नहीं आ रहा लेवल पे। मॉर्निंग से देखोगे ना, एक रेंज के अंदर ही बना हुआ है। मॉर्निंग पे ओपन हुआ था, ओपन होने के बाद थोड़ा बहुत सेलिंग आई। यही है मॉर्निंग का ही, इसमें क्या ही ट्रेड करें। सब कोई ट्रेड नहीं बना है, ना नेचुरल गैस में बना है ना क्रूड में बना है। यहाँ पर लग रहा था बाइंग के लिए, वो कैंडल ने काम ही खराब कर दिया। इवन तो वापस चला गया ऊपर। अभी सेलिंग का ट्रेड लग रहा था बनेगा, लेकिन वो फिर से लास्ट जो कैंडल है ओपन इक्वल टू लो बना के अननेसेसरी ऊपर क्लोज हो गई है। तो अभी मत लेना, अभी कोई ट्रेड नहीं चल रहा। नो ट्रेड इज रनिंग राइट नाउ। और अगर ये कैंडल भी नीचे नहीं आती है 5650 के नीचे, तो फिर यहाँ पर सेलिंग का ट्रेड क्रूड ऑयल में भी नहीं बनेगा। फिर हम छोड़ देंगे इसको। बाकी ध्यान रखना, ये क्रूड ऑयल का चार्ट नेक्स्ट मंथ का लगाया है मैंने, इसलिए प्राइस थोड़ा सा अलग दिख रहा होगा आप लोगों को, और कोई और रीजन नहीं है। वो फिर काफ़ी दूर है लेवल। ठीक है, कल एक्सपायरी हो गई है ऑप्शन की, इसलिए मैंने चेंज किया हुआ है। ये तो फिर ये भी आ जाएगा इस हिसाब से। वन मिनट। मे बी क्रूड ऑयल इज अंडरगोइंग शॉर्ट कवरिंग। इसका भी हाल बुरा है। पहले सेलिंग आई, फिर फास्ट बाइंग आई, फिर फास्ट सेलिंग, फिर से रिकवर कर गया। ट्रैप करने की कोशिश कर रहा है, तो अननेसेसरी फंसना नहीं है। लास्ट मंथ का ही चार्ट लगाना पड़ेगा। एक तो उसमें पीछे देखोगे ना क्रूड ऑयल के चार्ट में, तो कैंडल ही बहुत ज़्यादा गैप अप गैप डाउन दिख रही है इंट्राडे 15 मिनट की। उसका रीज़न है कि अभी नेक्स्ट मंथ का फ्यूचर चार्ट स्टार्ट हुआ नहीं है। कैंडल नहीं, देखो इसकी भी कैंडल हो गई क्लोज नहीं आई नीचे, कोई ट्रेड नहीं है क्रूड में, अब इसको लेना भी मत, इसको भी हटाओ, बहुत ज़्यादा वॉलेटाइल हो रहा है। ये करंट मंथ का फ्यूचर है जो लगा रखा है अभी। नहीं मेरे साइड से नहीं है, रहने दो, ठीक है, मेरे साइड से कोई ट्रेड नहीं चल रहा अब।
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equityfutures.
News when you want it with Bloomberg News Now. I'm Karen Moscow. We want to begin with some breaking news. NVIDIA has agreed to invest $5 billion in Intel and said the two will co-develop chips for PCs and data centers, a surprise move to help prop up an ailing arch rival. NVIDIA will buy Intel common stock at $23.28 per share, a 6.5% discount to Wednesday's closing price. Intel will use NVIDIA's graphics technology and upcoming PC chips and also provide its processors for data center products built around NVIDIA hardware. The two companies did not offer a timeline for when the first parts will go on sale and said the announcement does not affect their individual future plans. Intel shares rising on the news, up more than 21% this morning. Also breaking, the Bank of England holding interest rates at 4% and left the prospect of more cuts later this year in doubt after growing concerns over a resurgence in inflation. The Monetary Policy Committee voted 7-2 in favor of keeping rates unchanged. The decision and vote split were expected by economists. It kept guidance warning that future cuts will be gradual and careful and depend on the extent to which underlying disinflationary pressures continue to ease. Now to the latest on Jimmy Kimmel Live, and Walt Disney's ABC network is taking the show off the air indefinitely amid a backlash to remarks the late-night host made about the killing of Republican activist Charlie Kirk. We get the latest with Bloomberg's John Tucker. John, good morning.
And good morning, Karen. Disney announcing the decision minutes after Nexstar Media Group, which owns dozens of ABC TV affiliates, said it would pull the show indefinitely from its stations over remarks that it termed offensive and insensitive. In his Monday monologue, Kimmel said, quote, "We hit some new lows over the weekend with the MAGA gang trying to characterize this kid who killed Charlie Kirk as anything other than one of them." Brendan Carr, the chairman of the Federal Communications Commission, told podcast host Benny Johnson that he had a strong case to punish Kimmel, ABC, and Disney.
Broadcasters, and you've gotten this right, are entirely different than people that use other forms of communication. They have a license granted by us at the FCC, and that comes with it an obligation to operate in the public interest.
Well, Nexstar has business pending before the FCC. The broadcaster seeking approval for a $6.2 billion agreement to acquire another local station owner and needs Carr's support. It's not the first run-in media companies have had with the Trump administration. You'll recall in July, CBS announced it was ending its late-night show hosted by Stephen Colbert, who's also been a critic of Trump. At the time, CBS parent Paramount Global was seeking FCC approval for its takeover by Skydance Media. Well, in a post on Truth Social, President Trump cheered ABC's decision and then called on NBC to fire its late-night hosts, Jimmy Fallon and Seth Meyers. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. After a day of pomp and pageantry, President Trump's visit to the UK now turns to tougher diplomatic talks on trade and foreign policy with Prime Minister Keir Starmer. Yesterday, the president talked of the two countries' shared destiny and their so-called special relationship.
Seen from American eyes, the word special does not begin to do it justice. We're joined by history and fate, and by love and language, and by transcendent ties of culture, tradition, ancestry, and destiny. We're like two notes in one chord.
And Donald Trump speaking at the state banquet in Windsor Castle. And diplomatic talks later today, the Prime Minister, Keir Starmer, hopes to press Trump on trade terms and the war in Ukraine, although major breakthroughs are not expected. Futures are higher a day after Fed Chair Jay Powell rallied policymakers to back the central bank's first interest rate cut of the year. The quarter-point reduction came after a significant slowdown in job growth and an unprecedented push by the White House for much lower rates. But with the effects of tariffs on inflation still uncertain, Powell made clear the Fed officials will face difficult trade-offs as they consider whether to keep cutting.
While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated.
Jay Powell and the Fed's decision to cut rates was nearly unanimous, the lone dissent coming from Fed Governor Stephen Miron, a close ally of Donald Trump, who favored a larger reduction. And again, NVIDIA has agreed to invest $5 billion in Intel, and Intel shares are rising on the news this morning, up now 28%. Futures are also higher, with S&P futures up 0.9%, Dow futures up 0.7%, NASDAQ futures up 1.2%, and the 10-year Treasury yield at 4.05%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
What's special about Bloomberg Daybreak is the immediacy of the news we bring you each day in your podcast feed by 6 a.m. Eastern Time.
This isn't a deep dive on yesterday's news. Instead, you get the latest stories with context.
And that's something you don't get from other news podcasts. So join us for the best from Bloomberg's 3,000 journalists and analysts around the world, with reporting backed by data and journalists at the center of the stories we cover.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
which is many, many times what we had last year. And we're only in our just about almost 9th month. It's moving along quickly. It's amazing. I was saying we're in our 3rd month, our 4th month, our 5th month, but we're at, it's going to be over $17 trillion. No country has ever had anything like that, even close. GDP last quarter was 3.3%. Despite all of the things we're doing, one of the things we're doing, which I'm very proud of, is the border. We now have a totally closed border, totally secure for 3 months. 0 people came into our country, bad people. And they come in, but they have to come in legally. We have a great process going. And inflation is virtually non-existent. As you know, we're taking in trillions of dollars from tariffs, and they've been so incredible for our country, so incredible. We're keeping our companies happy. We're keeping them solid and sane, and they're very, very thrilled at what's happened. They can't even believe it. And we've never seen investment like this. Without the tariffs, we would have just a fraction of that. And we're really the only one that can do tariffs. Nobody else is able.
Perfect timing from the president there as he started to reflect on the state of the U.S. economy. That's something we have to do in just a couple of seconds' time. We're about 20 seconds away from jobless claims, so I want to bring it from the UK back here to the United States to focus on that data as it crosses. Going into it, equity futures set up as follows. We're positive by about 0.8% on the S&P. On the Nasdaq 100, higher by 1.2. On the Russell, small caps outperforming by 1.3. In the bond market, yields are a little bit lower across the curve. Yields down by 2 basis points at the front end. With the latest economic data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, we do get a snapback in jobless claims. After the big rise last week, we fall back to 231,000. That's below the estimate. Last week was revised up by 1,000, so it was 264. But remember, this was all in theory because of fraud in Texas. Texas officials say there were a whole lot of illegal filings the week before, and that looks like it is the case. The ongoing claims number is 1,920,000. That falls from 1,927,000. So the jobless claims numbers improve, take a little bit of that edge off in terms of what's happening with the economy. Of course, the Fed sticking with that. Now, Philadelphia Fed is out as well. It jumps to 23.2 from negative 0.3 in terms of the overall number. And the prices paid index drops to 46.8 versus 66.8. So a significant improvement on the inflation side for Philadelphia Fed. Don't have the explanation for that yet, but we'll look into it.
That's the pickup in activity that so many equity market bulls are looking for. Mike, stay close. I want to come back to you on the Federal Reserve in just a moment. I want to break down these numbers with Lisa. So jobless claims come in with a nice downside surprise, 231. As Mike pointed out, in the previous week, had this odd quirk coming out of Texas. A lot of people thought that maybe they were the wrong kind of filings for unemployment benefits. Claims have come back down to 231. Fraudulent filings were the conversation that we were having last week. So the good news is that we've returned back to the 230s on jobless claims. That's taken some heat out of the bond market rally. Yields come back up just a little bit across the curve. Yields were down 2 basis points at the front end, now just about unchanged. With that kind of move, push it through foreign exchange, starting to see the comeback of the US dollar. Just a little bit of dollar strength against the euro. Euro dollar shaping up as follows on my screen on the Bloomberg. 118.06, so slightly negative now on the session. So that's some good news, Bremo. That's the right kind of downside surprise on jobless claims.
And it coheres with what we're hearing from a lot of people, which is, and I'm talking about business leaders who say that the labor market isn't falling off a cliff. And if anything, there is this feeling of reacceleration in the underlying economy. And certainly we've seen that in spending. I just wonder, based on the muted reaction in bond markets, how the 2-year isn't ripping higher. It is a little bit higher. How much this really signifies that the Fed has put a cap on how high those short-term yields could go, regardless of how good that economic data could be.
Mike, I want to build on the data and get your thoughts on the Federal Reserve. You spent time in the news conference, listened to Chairman Powell intently, had your own remarks to make and your own interaction with him. What is anchoring their view of the labour market right now? Is it payrolls? Is it the unemployment rate? Is it claims? What is it?
It is payrolls at this point. They're looking at the drop in the number of people getting hired and starting to worry that means that companies are going to start cutting back on people if their margins are compressed because of tariffs. But we haven't seen a sign of that yet. We're still seeing business leaders say we're sitting on our hands, we're waiting to see what's going to happen. But the Fed sees more danger in that than they do in inflation, which they're describing as a one-off. But of course, Gary Cohn yesterday from IBM saying that this could stretch out. Companies could stretch out the process of raising prices. So it is sort of without a lot of conviction that the Fed is making the choice to focus on employment at this part. And that could change at any time when we get new inflation numbers.
Mike McKee with the latest. Michael, great work yesterday. Thank you, sir. Appreciate it. Neela Richardson of ADP joined us in the studio. Neela, good morning. It's good to see you.
Good morning.
This is a tough one to read. You help us out. Where is this labour market right now? What's happening?
Labor market is strong, actually. It's solid. And I think there is a comment that has to be made. It is weakening, but the labor market is not weak. And if you look at the stock, and that's what a lot of your audience is used to doing, looking at the stock and the flows. If you look at the stock, what you'll see is that the consumer is really smoothing out all the rough edges in the economy. And it's true for the labor market as well. There's very little turnover in this labor market. I was really shocked by that upward surprise in jobless claims last week, and now I know that that was just a mirage. And we're back to historical lows. There's very little flow out, and there's very little flow in. But what that means for the consumer is that they're not defying gravity when you see that pop in retail sales. They are well anchored by a functioning labor market where they are employed and working. And those incomes are fueling spending. And as long as that continues to happen, we can live with the uncertainty of fewer flows and hirings in and out of the labor market if the stock is healthy.
Well, and this raises the point that maybe this is the new norm.
ओके गाइस, इन नेचुरल गैस देखो हल्का सा एक पुल बैक देता है तो इसमें एक यहाँ पर सेलिंग का प्लान करते हैं वापस से नीचे क्लोज तो हो गई है कैंडल एक हल्का सा पुल बैक वापस सेलिंग बहुत ही नैरो रेंज के अंदर ट्रेड कर रहा है एंड सडन मोमेंटम आ रहे हैं नॉट फेवरेबल कह सकते हो और एक क्रूड ऑयल में भी थोड़ा सा अगर ये नीचे आ जाता है यहाँ पर एक बाइंग का प्लान करना छोटा सा ही टारगेट है ऊपर जाएगा तो यहाँ से वापस सेल ही कर देंगे तो इसको टच करके जा ही रहा है ऑलमोस्ट भी आई थी बट वो ऊपर जाके ही मान के चला ना यहाँ पर आया नहीं है तो चांसेस है उधर ही जाएगा इसका टारगेट थोड़ा बड़ा कर दो ऐसे छोटा करके 266 तक पहुंचा रखा है 266 के आसपास तो बड़ा हो सकता है सेम ही है तो एसएल बड़ा कर दो फिर एसएल बड़ा कर देता है टारगेट छोटा कर देता है हाँ इतना ठीक है इससे बड़ा एसएल नहीं इनफ 2 पॉइंट है ना वॉलेटाइल तो काफ़ी है लेकिन नीचे भी होल्ड होना है ठीक है इसे मैं डाल देता हूँ टारगेट डन बड़ा ऐसा मत लेना ओके ठीक है इससे बड़ा ऐसा मत लेना दोनों ही जगह पे ना क्रूड में ना नेचुरल गैस में पॉइंट इनफ है बाकी डेटा एक आने वाला है वो ध्यान रखना 6 PM पे आ चुका है सॉरी अनएम्प्लॉयमेंट क्लेम्स का डेटा 6 PM तो हो गया ऑलरेडी 7 PM पे सीधा यूएस मार्केट ही ओपन होगा तो अनएम्प्लॉयमेंट क्लेम्स और दोनों ही डेटा पॉजिटिव हैं गोल्ड डॉलर के लिए नेगेटिव फॉर गोल्ड एंड सिल्वर एम्प्लॉयमेंट क्लेम्स और फिलाडेल्फिया फेड मैन्युफैक्चरिंग इंडेक्स का डेटा दोनों ही डेटा पॉजिटिव फॉर यूएस डॉलर नेगेटिव फॉर गोल्ड एंड सिल्वर 7 PM यूएस मार्केट और फिर 8 PM नेचुरल गैस की इन्वेंट्री
For the labor market is pretty good. The unemployment rate is below what we've seen historically. But in the future, if these structural changes become live, real-time constraints to the economy, then the Fed has to act and act quickly. And that is the uncertainty that we're all going to be grappling with.
Just a random question from me. How long before college graduates actually get jobs?
Well, my son graduates in 2 years, so I'm hoping for that.
Serious though, when's that going to come back?
I think for early career, we're also seeing a complex relationship, right? Because we're seeing they're entering a jobs market where AI is becoming more and more present in their skill set. And when you think about where AI shows up for these for careers in general, it's showing up according to research done by Stanford using ADP data in early career in AI exposed fields. And that's not just software developers, that's marketing, that's finance, that's anything that you use a spreadsheet or some kind of document to do. So I do think that there is a transition point. The good news is in this very stable labor market, companies are leaning into employee engagement, employee training, employee upskilling in a way that they weren't doing before the pandemic. So there's hope that if the economy stays strong, that this early career population, which is our future, will be trained into those durable jobs.
I share that hope, Nida. I hope you're right. Nida Richardson.
We got
ADP.
2 years.
Thank you. Not just for you.
I've got a little longer, but not much.
For everybody. Bramo, it's a huge issue. And if everyone's right, the equity bulls in this market that come on this programme talking about the re-acceleration into next year, I hope that brings the labour market with it. And that's not the kind of jobless acceleration that you've been talking about.
Yeah, and how much companies, to Neil's point, invest in training. And we were talking to Brian Moynihan yesterday. And the sort of subtext to some of the conversation is that the big banks are training and some of the others are stealing because they don't want to train. And this does take money and it is inefficient. So how do companies have the conviction to do that if they kind of like ChatGPT and think, they can get their own coffee?
Some good news, at least this morning, in the last 10 minutes or so. Jobless claims down to about 231. 231 against an estimate of 240. The previous number, a revised 264. You want some coffee, don't you?
I have.
Yeah, okay.
I have like about a third of a cup. I'll get my own later.
Let's get you an update on stories elsewhere this morning. With your Bloomberg Brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Recapping that data then that we brought you just a few minutes ago. Initial jobless claims dropping by the most in nearly 4 years last week. Claims fell by 33,000 to 231,000. The median forecast in Bloomberg's survey of economists called for 240,000 applications. China's Huawei unveiled a plan to challenge Nvidia's dominance in the AI chip market. The company unveiled its new SuperPod cluster designs that can link more than 15,000 of its Ascend AI chips together to boost computing power. Huawei plans to roll out the new models in 2027 and 2028. Shares of Alphabet rising in the pre-market. The Financial Times reporting China is dropping its antitrust investigation into the dominance of Google's Android. The announcement comes ahead of Friday's scheduled call between President Donald Trump and China's Xi Jinping. And that's your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. Thanks for this morning. Up next on the programme, Adam Heads of Janus Henderson as stocks trade near all-time highs. Plus, Yahira with your morning movers as Intel shares surge following a deal announcement with Nvidia. That stock is up by 30%.
It is the first week of September. Our clients are just back from the holidays, and we've gathered over 1,000 of them with us today, and we're going to help them piece together a strategy.
Clients are in the room and they're here to hear more about investment opportunities in Europe, possibly in Japan, in China. We're here to help, and we can help them find those opportunities. We can advise them on how to position their trades, and then we can facilitate and give them access.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep. When we make hearts beat faster, and when we make them beat again. When we search for something, and when we find it. When we triumph, even when we stumble. Iconic. When we get people moving, when we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France. In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep. When we make hearts beat faster, and when we make them beat again. When we search for something, and when we find it. When we triumph, even when we stumble. Iconic. When we get people moving, when we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
Every month. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day. 1 and 5 Eastern, only on Bloomberg.
News whenever and wherever it happens. I'm Michael McKee in Jackson Hole, Wyoming, and this is Bloomberg.
This is a committee that has to think about the long run, even as they make today's decisions. Not surprising, I think, that you see this kind of dispersion, given the changes going on in the economy. When you see dispersion like this, it tells you that we are looking pretty short term. This idea of meeting to meeting sounds right to me.
There was a lot of dispersion in the forecast from this Federal Reserve just yesterday. That was the former Kansas City Fed President, Esther George. She's seen it all. She's been on the dissenting side of things, and she's seen a lot of those forecasts that looked a little like what we saw yesterday.
You know, she said something interesting. If you dissent and the rest of the committee votes against you, it doesn't mean that your view didn't count. People hear it, and I wonder how much they heard Stephen Myron's vote, even if it was very different from their own.
Pushing for 50, and let's be clear, we did think other people might join him, and they didn't. Governor Waller, Governor Bowman. Didn't happen, but there was a credible case for some people, at least, to make that case.
Yeah, especially before retail sales, and once retail sales came in, maybe not. I will say, I don't know how much consolidation there is around a view of 125 basis at the end of this year, but nonetheless, that is the dot that we saw.
Yeah, I was talking more about the descent for 50 than I was the dot itself.
But maybe that's the reason why there wasn't as much.
I said earlier this morning, stranger things have happened.
Yeah, it's
the
true.
Fed's been very offside at turning points, and if you look at the forecast, my favourite is the SEP from the end of 21. Not that I have a favourite SEP, but that's really sad. If you go to the end of 21 and look at their forecast for the end of 22, they're hundreds and hundreds of basis points off where they ended up. They were looking for 0.9%.
the point here, and I think it is very well taken, it is nice to have contrarian views, and sometimes it's really important to consider alternative scenarios, especially in the times of this much uncertainty.
Equities are higher this morning by 0.7%. What uncertainty? All-time highs potentially at the open about 43 minutes away. With your morning movers, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We are seeing Intel shares absolutely soaring here in the pre-market, up 30%, because as President Trump just said moments ago, it feels like Jensen Huang is taking over the world. NVIDIA is investing $5 billion into Intel, and the rivals will now team up to co-develop chips for PCs and for data centers. And looking at the big picture, it comes after the U.S. government took a 10% stake in Intel, all while China continues to crack down on NVIDIA and prop up its own domestic chip industry. So this just all feels like a bigger chess game being played. And sticking with tech and China, we are seeing shares of Alphabet up more than 1% on a report that Beijing is scrapping its antitrust probe into Android. And the timing does not feel like an accident. It comes just a day before Presidents Trump and Xi Jinping are set to call. So this is being viewed as sort of an olive branch ahead of that highly consequential call. And we end on the consumer with Darden Restaurants down 8%. This is the company behind Olive Garden and Longhorn Steakhouse. Shares are falling after adjusted earnings per share came in below estimates in the latest quarter. And that is because the company, which caters to middle-income consumers, said that it was going to try to limit price hikes to keep diners coming through the door. So that is hitting profits, and its comparable sales outlook did not look good either. John?
Yahara, thank you. Appreciate it. More conflicting signals coming from corporate America.
Yeah, maybe just bad breadsticks. That's what I thought.
Yeah, they've got their own problems.
Yeah, I mean, I'm not
totally
saying
agree with you.
Bad,
I know you're kind of joking, but you're not far off.
I just wonder how much this is consumers being choosier, choiceful, whatever word you want to say, picky, and choosing the ones they like and prioritizing that. And this is really a competitive thing more than it is an economic thing.
Let's cut you down to the opening bell. Let's move on from there. Stocks hovering near all-time highs. Equities up by 0.7% on the S&P 500. Adam Hertz of Janus Henderson writing the following: with so many cuts already priced in, if there is a proper growth scare, there is risk that additional cuts won't mitigate the downside. Adam joins us now for more. Adam, welcome to the program.
Good morning.
That's a really thoughtful statement. I want to give you some time just to build on that a little bit. Are you suggesting that the rate cuts that are already priced, that haven't yet been delivered, are already starting to influence the economy?
There are high expectations right now for more rate cuts, and yesterday helped to affirm that. So the Fed's doing a really good job right now of balancing a wide range of good risks and bad risks, and we think investors should do the same. And portfolios should be balanced right now, which means more of like a 60-40 starting point, and a 60-40 should stay around 60-40. Even though that feels a little bit neutral at the top level, it's not under the hood. If we're talking about a base case of rate cuts with a resilient economy, it's great for growth, it's great for cyclicals, small and mid, it's great for REITs, it's great for international, and that broadening trade should have some room to run.
Why does the bond piece perform in the way you think it should in an environment like this one, when the Federal Reserve is really losing some credibility about its pursuit of 2% on the inflation side? And it's also telling us basically they're willing to underpin the labour market and they're willing to sacrifice things on inflation.
Within that 60-40, that bond piece, right now rates are rallying, and we think investors should extend duration if they haven't already. And if those lower yields across the curve are forcing more of a search for yield in some multi-asset income portfolios, that's where you can look outside the core into the more of the credit, non-investment grade segments. Investors are seeing corporate spreads at all-time tights, nearly that, at least the tightest since the late 90s. This is where you can look outside traditional corporates into securitized. Janus Henderson is a world-class securitized team. We're the second largest active ETF provider with a lot of great securitized offerings there, and we're seeing that go from more of a diversifier to more of a strategic long-term piece of portfolios within the fixed income.
I guess I don't understand why the rate-cutting cycle this time around would give such a boom to bonds, given the ongoing strength in the economy and, to John's point, the inflationary pressures where inflation still hasn't gotten down to 2% for more than 4 years. I just wonder, given the fact that equity valuations, yes, they are elevated, but you're looking at the moonshot in AI, you're looking at profitability other than Darden that has been going up, and you look at the idea that there is a lot of cash that is, I don't want to say on the sidelines, because I don't like that expression, but in money market funds. Why aren't stocks the much better choice right now than bonds?
Well, you're seeing those balanced risks play out, and this goes back to why you'd want to keep more of that 60-40 baseline intact. So part of the concerns here and part of the bearish case is price levels are so high. That goes for valuations, top decile valuations in the S&P. You've got credit spreads near all-time tights. But those high price levels also feed into that bullish case about loose financial conditions, especially once you factor in lower rates in the 10-year and lower vol. So those bearish concerns about price levels also feed in and perpetuate that bullish case, which is why you don't want to be underweight equities right now.
How hard is it to convince customers, clients of yours, that bonds still deserve the same place in the portfolio?
This has been a long-term discussion. We get those questions every day, and this goes back to a decade ago, living through that ultra low-rate environment. That's not where we are right now. When you're looking at bond portfolios, you're looking at flexible, diversified bond portfolios, you're seeing yields still in the mid-single digits. And so that is a great cushion. And in that bad case scenario of rates going higher, there is still a small chance it could be from deficit fiscal concerns with global yield ceilings raising. But right now, if we see the yields go from 4 and you blink and yields hit 450 on the 10-year, right now, if you look at Fed projections, you look at the GDP nowcast with US GDP around 3.4%. Right now, if you're seeing yields rise, that actually could be good for risk assets, and that it might hurt your bond portfolio, but that's great for risk assets because the economy is recovering. So if you have the opposite effect and rates rally from here, that still makes bonds a great diversifier for a portfolio, and you're clipping mid-single digit yields.
Adam, what are you actually expecting for next year? Are you expecting a re-acceleration in growth? Is that the base case?
The base case here is you have to expect, if you're looking at the Fed projections, you're looking at broader consensus, you're having rate cuts into this soft landing kind of resilient growth scenario. There's a wide range of risks around it, but it goes back to that broadening trade. We're seeing a lot of opportunities in the SMID caps, in the cyclicals and international, and valuations have crept up, and you've seen that broadening trade work so far this year. But there's a lot of room to re-rate, and there's a lot of room for earnings expectations to go up from where they are.
Which is why we've seen this big outperformance in smalls, at least over the past, what is it, Bramo? 6 weeks, 7 weeks?
Yeah, what did Alex Altman say? The market
$3 trillion.
$3 trillion. He said, you know, that's smaller than a lot of the mega tech companies in the United States. So hard to really call this a rotation, but it does speak to the idea that there are companies that have been left behind by these all-time highs that we keep talking about every day.
I think he was more comfortable with the word broadening. It's a broadening, not a full rotation.
I think the equal weight is the story that people keep turning to, right? The other 493, and at what point did they outperform given the moonshot of the Magnificent Seven? I just wonder, again, how consistent it is that bonds act as that diversifier. And I think it's really interesting to hear Adam's point, which is it's controversial, and yet the 60-40 coming back as a pitch and just sort of acting as that ballast.
We talked about this. The good news of the last 2 weeks through September is yields on 30s aren't at 5%. They're at 470. 10s aren't at 450. They're closer to 4. That's quite a change. Coming into September, that's not the conversation people were having. In fact, on the fixed income side, there was a real concern. We see a repeat of last year. Federal Reserve would lean into easing, and you'd see a sell-off at the long end. That's not developed this time.
No, and there doesn't seem to be a real significant rise in inflation expectations when you look at break-even rates either. So it seems like people still have faith that the Fed will ultimately rein in inflation should it get too hot, even if it is running above 2%.
Adam, enjoyed this. It's good to see you. Thanks for dropping by. Appreciate it. And for tolerating us. Adam Hetz of Janus Henderson. We appreciate that too. Coming up tomorrow, Marissa Adams of HSBC, the former St. Louis Fed President Jim Bullard, Congressman Jason Smith, Nadia Lovell of UBS. What a week so far. One more trading day still to go. Going into the weekend with equity futures on the S&P 500 up by 0.6%. All-time highs just around the corner. We're almost there, Bramo.
You just said going into the weekend?
Yeah, like one more day after this. One more trading day after this.
Why are you teasing me?
Not there yet.
I know. Well, maybe.
When we wake up Friday, we'll have record highs and, like, you know.
Yeah, we're practicing right now.
I'm wishing it forward.
Thank you.
For over 147 years, Bgrim has embraced doing business with compassion, always committed to giving back to society. We empower people and strengthen communities for a better future.
Connecting the dot between what's at stake and what is possible.
to be a broken market, or the value investing industry, I think, is defeated, so to speak. It used to be that most money was invested by these long-only investors, these big mutual funds and stuff like that. And they had money coming in every day, and they were getting nice fees on all of that money, and they had large research teams. And they would sit around following all of the companies with teams of analysts, and they would say, this company we think is undervalued by 30%. And it might be a growth stock or a value stock, a Magnificent Seven or otherwise, but they would say, I think this is undervalued by 30%, and if I buy it and I hold it, I'll make the S&P plus 30. Now, as we've moved to passive, they've lost their customers, and the remaining customers are paying them lower fees, and they have reduced their research staffs, and they don't have new money coming in to make new investments in any case. And so most of the investing these days is no longer done by people who are buying something because they think it's worth more. They have opinions about price, like what is the price going to be tomorrow? And so the result is most trading that is going on right now has nothing to do with value. So it leaves us sort of as a dinosaur.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
We are off to the races again. Futures pointing to new record highs as the 10-year Treasury comes below 4%. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, a big chip deal. NVIDIA makes a $5 billion bet on Intel. A surprising move to help prop up its ailing arch rival. Intel shares soar on the news.
And that deal helps further a rally in stocks as the Fed delivers its first cut of the year and signals more to come.
This hour, President Trump and UK Prime Minister Keir Starmer hold a joint press conference at which more tech investments may be announced.
Now, we have to start there because the move in Intel, it is a monster one this morning. How many times have we been head faked from Intel? Does it stick this morning? NVIDIA agreeing to invest $5 billion in the company so that the two will co-develop chips for PCs and data centers. NVIDIA's stake in Intel will be just under 5%, so 2.5 rally for NVIDIA. For Intel, it's a 30.3% rally.
Anybody who got on board with Trump after that investment in August is getting paid today. Novo Nordisk's diabetes drug Ozempic beat Eli Lilly's Trulicity in a real-world survey of certain U.S. patients. Participants who took Ozempic were 23% less likely to have a heart attack, stroke, or die than people who took Trulicity. According to Novo Nordisk, you can see Novo shares up 8% this morning in the pre-market. Danny?
All right, let's get back to the big story this morning, and it is the NVIDIA-Intel deal. Bloomberg Tech co-host Caroline Hyde joins us for more on this. Caroline, it's $5 billion. What exactly are they hoping to achieve with this investment?
It's more about integration. It's about the forward-looking focus of Intel and its relevance here in the United States. So it's about not yet its fabrication of chips. Remember, TSMC is a little bit lower, but this isn't like a wipeout in terms of Intel making NVIDIA's chips. This is about NVIDIA and them lining when it
Live from New York City for our audience.
As we wait for the press conference with JP Morgan's Bob Michael, Diane Swank of KPMG, and Deutsche Bank Matthew Lazzetti, and finally breaking it all down. Chair Powell's news conference has already happened, and we will be speaking with former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg.
That is a stacked lineup right there through the next few hours. Joining us around the table, Greg Peters of PGIM Fixed Income. Greg, good afternoon. It's good to see you.
Great to be here.
Can this Fed meet this market?
Doubtful. There's a lot of drama around this current meeting.
A big headline crossing the Bloomberg terminal.
A big headline, quite the headline, John, for two companies that the U.S. government has a vested interest in. In a statement, we heard from the NVIDIA CEO Jensen Huang, who called this a historic collaboration. As part of the deal, Intel is going to use NVIDIA graphic technology in upcoming PC chips, and NVIDIA will use some of Intel's processors in order to meet the demand from AI data centers. The idea here being that they're really going to work together when it comes to some of this chip development. And it follows, of course, a recent push from this administration to bolster the domestic chip supply chain. Of course, last month, President Trump signing that deal that gave the U.S. government a 10% stake in Intel in a bid to sort of repurpose some of the existing CHIPS Act money. And I'll also point out that Japan's SoftBank made a surprise $2 billion investment in the company last month, too, amid this mounting pressure from the administration for this sort of money to be put up in order to clinch these trade deals. Now, I do want to point out one pretty important stat from this story that's now on the terminal. Analysts estimate that at some point next year, NVIDIA will pull in more revenue per quarter than Intel gets in a year. Of course, John, as you well know, this White House, this president has really shored up ties with NVIDIA as the company now finds itself really at the center of some of these sensitive trade negotiations.
Elisa, this is a really important development. You just listened to what Tyler was talking about there and the president's involvement in all of this. What's his objective? Build out domestic foundry capacity. One. What needs to happen after that? Someone needs to use it. And we've been talking about this over the last month. Who would be pushed to use it? This is not about the push anymore. NVIDIA essentially is telling you they're ready to use it. They're ready to partner with Intel to make this happen.
Yeah, and specifically on certain chips for PCs and other devices, the question is whether this is going to be a big effort or whether this is going to be more performative. And this is something that we've asked when it comes to China and the Huawei move earlier, this idea of, is the technology comparable? Or is it going to be tough to move away from, say, TSMC and Taiwan for the U.S. chip manufacturers?
Intel, higher again, up by 18% in the pre-market. Anne-Marie on the ground in the UK. Anne-Marie, I imagine this announcement is music to the ears of the president.
Absolutely. The president has almost become, a co-CEO of Intel, putting a lot of pressure, one can imagine, on a lot of these companies since, as Tyler mentioned, almost 1 month ago to the day, the U.S. government decided to take that 10% stake in Intel. And the question, Jonathan, you, me, and Lisa sat around the table and asked, who is going to be next to either buy these chips from Intel or invest in more money to make sure that Intel could once again become a national champion? So on one front, you once again have what many would maybe call unconventional, what the U.S. government did, but certainly this is going to mean that more support could be flowing into the company like Intel. And then to Lisa's point, what did we hear today out of Huawei, out of Beijing? This highlights a core issue for the United States. Huawei basically announced a multi-year plan to take on the dominance NVIDIA has in the marketplace. Howard Lutnick, the Commerce Secretary, has said time and time again, we have to make these chips in the United States. We have to make sure we are a dominant player in this. We cannot lose to China. Jensen Huang told me himself he doesn't feel like China's behind. They're right up against them in terms of where they are in the market and in AI technology. And the Commerce Secretary has said we have to make these chips in the U.S. We can't rely on Taiwan. So from a national security perspective, this really is in line in something we've seen from this White House. And once again, highlights, I would be absolutely shocked if the president and his team had no influence on this, highlights the heavy hand they are really taking in the semiconductor industry.
Your reputation is bond, so to speak, right? So, I don't think anyone wants to taint their own reputation or really taint the reputation of the Fed itself. So I do think they'll be contained by that. But it is an open question. We don't know. So there is a bias to be more easy, I think. But where neutral is or where, being accommodative is always an open question. And I think we'll test that thesis in 2026 for sure.
This is a compelling point, the idea that the discipline will be imposed by the bond market. And ultimately, the bond vigilantes will come back, particularly at the long end, and will impose a sense of restraint on the Fed and on the administration. Do they still exist if there, say, is yield curve control or, say, some sort of creative balance sheet use?
That's exactly the point. I actually don't think there's such a thing as a bond vigilante. I think that's an artifact from the past. But I think from a bond investing standpoint, it is really difficult to lean in continuously into the steepener view because of that risk, right? That risk of changing the issuance in the back end, doing buybacks, some form of financial repression. And so it's a very, treacherous place to be given that. And that is why the U.S. has kind of outperformed other global markets because of that. They've done a better job on the debt management front, number one. And then number two, investors have a keen eye on changing that dynamic to keep back-end yields down.
The inflation-adjusted rate is a residual. Sometimes it's hard to guess. We've had the 10-year real yield come down. I'm going to call it at the bottom of the range. You're the pro on this. What is the significance of, with the chit-chat today, we get a real yield that really breaks down?
I mean, real yield is an interesting measure, right? One measure, high real yield means like that's a very good growth environment. That's one that you should do well in from a risk standpoint. Post GFC, it was inverted and perverted in a way where negative and low meant it was good for risk taking. So I think we're in a much more kind of normalized zone, which is to say having real yields, kind of the 1% type of zip code is where we're supposed to be. I think that's a truer measure of economic activity than the previous kind of regime.
We've got about 60 seconds left in this segment at least, and we can continue this conversation. How are you thinking about the relationship between the debate at the front end of the curve and the story further out along the curve? Are the two things connected right now? If they drop yields at the front end, what happens to the long end?
Well, they're connected and they're not all at the same time. So the front end of the curve is a much cleaner place to invest, right? Because it is clearly driven by central bank policy. So the closer you get to that central bank policy reaction function, the cleaner it is. As you go out the curve, yes, it's driven by central bank policy action, of course, but it's driven by so many other factors that are beyond your control, right? It has to do with inflation, of course, growth expectations, and this pesky term called risk premium.
Brilliant. John, does Dr. Myron know that?
I think Governor Myron does. I've got some respect for Governor Myron. Going into this meeting, he doesn't strike me as the kind of guy who takes big swings in the meeting. Would he take big swings when it comes to the dissent? I think that's a very, very different question today. I don't think he's going to go in and be rude to people and tell them they're all doing a horrendous job. But he could well be a little bit more aggressive with that dissent if we do indeed get one.
In other words, 100 basis point rate cut. Is that what he thought it was deserved? Is that what we're going to come out and speak to later today? That I think is really
I'm
going to be
not sure how much credible a number closer to 100 would be.
Does that rule him out for any kind of Fed contender?
Greg Peters is going to stick with us. Greg, it's good to have you with us. Up next on the program, Kathy Jones and Subhadra Rajappa.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep, when we make hearts beat faster, and when we make them beat again, when we search for something, and when we find it, when we triumph, even when we stumble. Iconic. When we get people moving, when we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
It does look like the Fed will cut
25 basis points.
a 25 basis point cut.
If they do 25 bips or if they do even 50, the market should be able to take it.
The Fed will still probably be looking for 2 cuts this year.
3 cuts this year and more to come next year.
Somewhere between 5 and 6 25 basis point cuts out to 2026.
If you continue to see this kind of momentum on the labor market, to get several more cuts in the back half of the year.
There are signs that you'll continue to see that weakness in the labor market data.
If you look at the trend, it's weakening.
In the balance, the Federal Reserve will look at the labor market for now, but they have to keep one eye on inflation.
Chair Powell better sound relatively dovish.
He's going to provide very limited guidance.
The decision 15 minutes away. The consensus view, a move of 25 basis points. 2 outliers. SocGen, Standard Chartered, looking for 50 in about 15 minutes' time. The scores into it look like this on the S&P 500, not far off all-time highs. We're down 0.1% this afternoon. In the bond market, 2s, 10s and 30s shaping up as follows. Your bond yield curve looks like this. Yields higher by 4 basis points to the front end, 3.54. We have rallied a lot at both the front and the long end over the past 6 weeks.
Yeah, and we've seen even a rally in credit. Just to give you a sense of just how much 10-year yields have rallied. They are down from 4.37% as of July 30th, the last Fed meeting. They are now at 4.03%, just giving you a sense of that momentum.
A couple days ago, we popped 3.99 in the 10-year, and this morning we made a dash toward just for a cup of Sanka. But the answer is yield space is moving. Greg Peters is exhausted.
Go further out, go to 30s. Only a few weeks back, we're at about 5.
Yeah.
Come all the way back down towards 4.5%. And the way the curve has evolved through August into September, August we had a bull steepener, big rally at the front end. September, it's been completely the opposite. We've had a bull flattener led by the long end.
And the reason for it has been different depending on the person you've spoken to. Some people say it's because of the threat of yield curve control or some sort of machinations in the balance sheet. Other people saying, look, if you have all these people in cash, you cut rates, well, they want to lock in that yield, so they're going to go out the curve. That's a new argument, and we're hearing it more.
Joining us now to discuss, Kathy Jones of Charles Schwab, Greg Peters of PGIM Fixed Income, still with us. Kathy, let's start with expectations.
ओके गाइस यूएस मार्केट ओपन होने वाला है 7 पीएम पे। ये नेचुरल गैस में यहाँ पर प्रॉफिट बुक करना, देखते हैं अगर ये रुकता है थोड़ा सा फिर यहीं से एक बाइंग का प्लान करेंगे, नहीं रुकेगा तो फिर इसके नीचे एक लेवल है यहाँ प्लान किया जाएगा 258 के अराउंड। क्रूड ऑयल के ट्रेड का भी ध्यान रखना यूएस मार्केट से पहले, यूएस मार्केट में कहीं ओपन इक्वल टू हाई कैंडल ना बन जाए दोनों ही जगह पे। एक धन में मैंने पहले भी आप लोगों को बताया था, धन ने अपना एल्गोस इंडेक्ट किए थे, तो आप लोग डायरेक्टली अब एल्गो डिप्लॉय कर सकते हो धन में। बट वो जो एल्गोज है ना वो धन के नहीं है, धन ने स्पेसिफिकली नहीं बनाए हैं, दे आर फ्रॉम स्ट्रेटजी। ठीक है, वेबसाइट है जो बहुत सारी एल्गोज प्रोवाइड करती है, तो ये उनके एल्गोज हैं सारे के सारे। यहाँ पर देखो लिखा भी होगा, देख पा रहे होगे। ठीक है, तो यहाँ पर लिखा है जैसे कोई इंडेक्स स्नाइपर बाय स्ट्रेटजी कंपनी है, वो एल्गो बनाते हैं, तो ये उनकी ओर से दिया गया है एक्चुअली में। सो ये जितने भी एल्गोज हैं सबके सब स्ट्रेटजी के हैं। ठीक है, लिखा होगा अगर किसी और कंपनी के होंगे, फिलहाल मोस्टली तो 99% तो स्ट्रेटजी की है, किसने अपने बना के डिप्लॉय करे हैं तो मुझे नहीं पता, वो यहाँ पर लिखा आएगा नीचे से स्ट्रेटजी। तो इनकी जो एग्जीक्यूशन है, जैसे फॉर एग्जांपल मुझे अभी किसी ने बताया, पहले ही बताया था, जैसे कि इंडेक्स स्नाइपर करके स्ट्रेटजी है। ठीक है, ये ऑप्शन बायर्स के लिए है स्पेशली। ठीक है, जो लोग सिर्फ ऑप्शन बाय करते हैं। तो अब ये किस तरह से काम करती है यहाँ पर मेंशन है, जैसे फॉर एग्जांपल ये एक अनहेज्ड ऑप्शन बाइंग स्ट्रेटजी, इसमें हाई रिस्क है। ठीक है, विथ लो एक्यूरेसी बट गुड रिस्क रिवॉर्ड। तो ऐसा हो सकता है कि आप इसको डिप्लॉय करो और मान लो आपने कोई स्ट्रेटजी ने कोई एक ट्रेड एग्जीक्यूट किया, 25,000 का कॉल ऑप्शन 100 पे बाय कर लिया। ठीक है, और वो 100 से 150 भी चला गया। ठीक है, 100 से 150 भी चला गया, लेकिन एज पर द एल्गो उसने प्रॉफिट हाफ वगैरह बुक नहीं किया और फिर क्लोज होते होते वो लॉस में क्लोज हो गया या लॉस में निकाला। तो वो हुआ क्यों, यहाँ पर एक तरह से लिखा हुआ है, आप क्लियरली मेंशन देख सकते हो कि जो इंडेक्स स्नाइपर स्ट्रेटजी है, इट इज़ अ प्रिसीजन driven index option algorithm designed to seize market opportunity in every morning. It operated with a unique approach, booking partial profit at a single predefined target. ये जो लिखा हुआ है ना, single booking partial profit at a single predefined target. अभी जो predefined target है ये exactly कितना है यहाँ पर ऐसा लिखा नहीं है, ठीक है, कि आपने जो भी अमाउंट वहाँ पर यूज़ हुआ है उसका रेट ऑफ इंटरेस्ट के अकॉर्डिंग वो कितना है, क्योंकि जैसे मैंने बताया ना 100 का आपने प्रीमियम लिया वो 50 चला गया, तो 50 पॉइंट का तो आपको प्रॉफिट एटलीस्ट बुक कर लेना चाहिए, स्पेशली एक्सपायरी वाले दिन पे। तो अब ये उसने 100 से 150 चला गया, बुक क्यों नहीं किया? इसका रीज़न क्या हो सकता है कि जैसा यहाँ पे स्टार्टिंग में लिखा हुआ है, इट इज़ अनहेज्ड ऑप्शन बाइंग हाई रिस्क एल्गो विथ लो एक्यूरेसी बट गुड रिस्क रिवॉर्ड। तो रिस्क रिवॉर्ड अगर अच्छा रख रहे हैं तो हाफ प्रॉफिट ये लोग जो बुक करते हैं, ठीक है, इट मीन्स कहीं ना कहीं हाई लेवल पे करते हैं, हाई लेवल इन द सेंस ऑफ अच्छे खासे रिस्क रिवॉर्ड पे करते हैं, सो दैट रिमेनिंग क्वांटिटी को ट्रेल कर सके। अदरवाइज हो सकता है जैसे मैंने बताया 100 से 150 या 160 चला जाए, लेकिन अल्टीमेटली आप जब शाम को देखो जब वो एग्जिट हुआ होगा तो लॉस में हुआ होगा। तो याद रखना ये जो प्री डिफाइंड टारगेट है ये कितना है यहाँ पे मेंशन नहीं है, बट एज पर जितना मुझे लग रहा है गुड रिस्क रिवॉर्ड अच्छा है, एक्यूरेसी भली ही कम है, रिस्क रिवॉर्ड अच्छा है, तो मुझे नहीं लगता कि आपने 100 पे बाई किया है तो वो 10 20 30 पॉइंट लेके निकाल देगा, क्योंकि एल्गो इज नॉट वर्किंग लाइक दैट, राइट? वहाँ पर इमोशंस नहीं है कि 10 पॉइंट है एक्सपायरी वाले दिन निकाल के निकल देते हैं, ऐसा नहीं होता, वो तो फिर मैनुअली करना पड़ेगा। समझ में आ रहा है ना? जो लोग स्ट्रेटजीज को डिप्लॉय करके ट्रेड करते हैं तो उनको ये पता होना चाहिए, क्योंकि कई बार ऐसा हो सकता है कि आप देख रहे हो कि आपका ट्रेड एग्जीक्यूट हो गया, अच्छा खासा प्रॉफिट चला गया, 100 का प्रीमियम 200 चला गया, प्रॉफिट बुक नहीं किया मार्केट में उस एल्गो ने, और शाम होते होते नेगेटिव में क्लोज हो रहा है, तो इसका मतलब ये नहीं कि एल्गो बेकार है, उस एल्गो का वर्किंग का मैकेनिज्म ही वैसा है। तो प्लीज़ एक बार उसका ओवरव्यू जरूर पढ़ लेना कि वो ओवरव्यू में क्या कह रहा है, कि कित प्रॉफिट आगा आधा कहाँ पर बुक होगा, ठीक है, कितना इन्वेस्टमेंट होगा एंड रिस्क क्या है, रिस्क रिवॉर्ड क्या है। जैसे इसमें कंप्लीटली लिखा हुआ है, इट इज़ अनहेज्ड ऑप्शन बाइंग हाई रिस्क एल्गो विथ लो एक्यूरेसी बट गुड रिस्क रिवॉर्ड। और इसमें क्या होता है, एक पार्शियल प्रॉफिट बुक करते हैं एक सिंगल प्री डिफाइंड टारगेट। नाउ डजंट मेंशन कि वो एग्जैक्टली प्री डिफाइंड टारगेट क्या है, बट एज पर द गुड रिस्क रिवॉर्ड वो ज़्यादा ही होगा, तभी वो बुक नहीं करते, ठीक है। एंड यहाँ पर देख पा रहे होगे स्ट्रेटेजिकली होल्डिंग द रिमेनिंग पोजीशन अंटिल द एंड ऑफ द ट्रेडिंग डे। इसका क्या मतलब, लाइक एक प्री डिफाइंड टारगेट है वो अचीव होगा, उसके बाद रिमेनिंग क्वांटिटी को दिन के लास्ट तक होल्ड करेंगे, कॉस्ट टू कॉस्ट कैसल के साथ, अगर वो निकलता है तो फिर उसको निकाल देंगे, ठीक है। दिस हाई रिस्क हाई रिवॉर्ड algo tailored for seasonal investor comfortable with market volatility ensures you can sustain risk dynamic. We recommend a minimum portfolio size of 1 lakh like this, ठीक है। तो इस चीज़ का ध्यान रखना कि जो एल्गो वर्क कर रहा है उसका काम क्या है, ठीक है, क्योंकि ऐसा हो सकता है कि आपको दिखे कि वो काम ही नहीं कर रहा है। अब जैसे यहाँ से देखोगे मार्केट एग्जांपल के लिए, ये एक बैक टेस्ट है, एग्जांपल नहीं है तो रियल मार्केट का एग्जांपल है, इस स्ट्रेटजी की अगर अकॉर्डिंग में बात करूँ तो जैसे किसी ने 20 अगस्त को इसको डिप्लॉय किया होगा, 1,25,000 का मिनिमम अमाउंट डिप्लॉय किया होगा, तो 8 तारीख को उसी दिन 20 से 21 तारीख को वो अमाउंट घट के 1,09,163, मतलब उस दिन कहीं ना कहीं एसएल गया ही होगा डेफिनेटली। उसके अगले दिन सेम अमाउंट था 1,09,163, मिनिमम अमाउंट 1 लाख चाहिए, तो तीसरे दिन 21 22 23 को मार्केट बंद था, 25 को नेक्स्ट ट्रेड बना है, 21 को जो ट्रेड बना था मतलब उसका रिजल्ट 25 को, तो वो अमाउंट 1,09,000 से 1,15,000 आया, मतलब वहाँ प्रॉफिट हुआ है। अगेन फिर उस दिन दोबारा एग्जीक्यूट हुआ होगा कोई ना कोई ट्रेड, ठीक है, अगेन वहाँ पर फिर से लॉस हुआ है, 1,05,655 पहुँच गया, फिर उसके बाद एक प्रॉफिट हुआ है 1,07,596 हो गया, उसके बाद एक और प्रॉफिट हुआ है, तो उसके बाद वो 1,07,000 टर्न्स इनटू 1,9 से लेकर 2,9 एक दिन के अंदर 2,60,000, मतलब ऑलमोस्ट डबल हो गया वैसा। तो इसको देख के मुझे साफ साफ लग रहा है कि ये स्ट्रेटजी ऐसा नहीं है, ठीक है, क्योंकि बहुत सारे लोग ऑप्शन बाय करते हैं, मैं उनके लिए स्पेसिफिकली बता रहा हूँ। इसका मतलब ये स्ट्रेटजी बिल्कुल क्लियर है, क्योंकि यहाँ पर लिखा नहीं है ना प्री डिफाइंड टारगेट कितना है, या तो मेंशन होता तो मैं आपको बताया था, वहाँ पर लिखा नहीं है कि प्री डिफाइंड टारगेट कितना है, तो देयर इज अ वेरी हाई पॉसिबिलिटी कि जिस तरह के इसमें प्रॉफिट मिल रहे हैं, ठीक है, और जो छोटे छोटे लॉस हो रहे हैं, तो ये अपना पार्शियल प्रॉफिट छोटे अमाउंट में बुक नहीं कर रहा है। देयर इज अ वेरी हाई प्रोबेबिलिटी, जो इन्होंने यहाँ पर मेंशन लिखा हुआ है कि ये जो पार्शियल प्रॉफिट बुक कर रहे हैं सिंगल प्री डिफाइंड टारगेट पे, ये बहुत बड़ा रहने वाला है, तभी इसमें सर्वाइव करके बैठे, अदरवाइज मुझे नहीं लगता इसमें सर्वाइव करके बैठेंगे। तो ऐसा हो सकता है कि आपका अच्छा खासा प्रॉफिट चल रहा हो, लेकिन जब वो अपनी पोजीशन एंड कर रहे हो डे एंड पे, तो वहाँ पर फिर आपको दिख रहा हो कि लॉस में है। एंड यहाँ पर फ्रीक्वेंसी भी देखोगे तो 1 ट्रेड पर डे है, सिर्फ एक ट्रेड एक दिन में है। रिस्क रिवॉर्ड और ड्रॉ डाउन मैक्सिमम इतना हो सकता है 27%। तो दिख तो रहा है 1 मंथ का ROI कितना है, 81%। 81% मंथ ऑन मंथ का ROI। बट अब किसी ने ये डिप्लॉय किया है लाइक 2 सितंबर को, तो उस समय अगर उसने एक अमाउंट यहाँ पर डिप्लॉय किया है 2,60,723, तो वो तो अभी 2,26,000 में पहुँच गया। ठीक है, आप कैलकुलेट करोगे तो कितने का लॉस हो गया सीधा सीधा। इफ़ यू जस्ट कैलकुलेट 2,60,723, तब से जितने भी ट्रेड लिए हैं, अगर मान लो किसी ने यहाँ पर डिप्लॉय किया होता, तो अभी आते आते लुक एट दिस 226,392। ठीक है, तो टोटल उसको अभी तक 34,000 का वो लॉस में है। कब से? 2 सितंबर से। आज कितना हो गया? 18 सितंबर। तो मतलब 18 दिन से वो लॉस में ही है। तो अब इसका मतलब ये थोड़ी ना कि वो जो एल्गो है वो बेकार है, बट जब से उसने डिप्लॉय किया होगा तब से उसको लॉस हो रहा होगा। ठीक है, अब यहाँ से देखोगे कंटिन्यूसली मार्केट में कुछ प्रॉफिट कभी नहीं हो रहा है, ऑलमोस्ट हर दिन एक दिन प्रॉफिट हो रहा है, 3-4 दिन लॉस हो रहा है। ठीक है, तो एक चीज़ का ध्यान रखना कि जब भी आप उस स्ट्रेटजी को डिप्लॉय कर रहे हो तो उसमें उसका ओवरव्यू क्या है वो मेंशन करके लिखो, क्योंकि ये किसी इमोशंस बेस पे तो चल नहीं रहा है कि एक्सपायरी है 30 पॉइंट मिल गए बुक करके निकल जाओ। ठीक है, वो करना है तो फिर हमें मैनुअली करना पड़ेगा, वो तो मैनुअली कर सकते हैं। इसमें जो लिखा है वो लिखा है, उसके अकॉर्डिंग जो इन्होंने इसके अंदर एल्गो के अंदर जो मैकेनिज्म डाला होगा कि इस लेवल पे आने के बाद ही 1:2 1:3 आने के बाद ही हम प्रॉफिट बुकिंग करेंगे हाफ, और उसके बाद फिर रिमेनिंग क्वांटिटी को ट्रेल करेंगे। तो इसका मतलब वो प्री डिफाइंड टारगेट जब तक नहीं आएगा, भले ही वो आपको दिखाई कितना ही प्रॉफिट, वो बुक नहीं करेगा। ठीक है, तो इस चीज़ को ध्यान रखना, और इसमें सिर्फ इसके लिए नहीं बता रहा हूँ, ये सबके लिए है। ठीक है, अब जैसे ये देख लो, ये तो मैंने 1 मंथ का दिखाया, उतना क्लियरिटी नहीं दिख रहा है। 3 मंथ्स का चार्ट है। अब 3 मंथ्स पहले किसी ने अगर डिप्लॉय किया होता 1,25,000, तो 1,25,000 से ये नीचे 1,02,000 भी आया है, उसके बाद फिर 2,20,000 भी गया है। ठीक है, उसके बाद फिर 1,60,000 भी आया है। तो यहाँ से देखोगे स्टॉप से किसने अगर यहाँ डिप्लॉय किया होता 9/7 को, 2,30,000 के अराउंड का अमाउंट होता, तो 1,61,000 भी तो आया है, भले उसके बाद वापस चला गया। तो जितना मुझे दिख रहा है ये ऑप्शन बाइंग वाले, क्योंकि बहुत हाई रिस्क वाला एल्गो है, प्रॉफिट आपको बहुत अच्छा दिख रहा होगा यहाँ पर, लेकिन जितना मैं समझ पाया हूँ इस को बैक टेस्ट में, जितना मैंने रिजल्ट देखा है, दिस अ वेरी हाई प्रोबेबिलिटी कि इसमें जब प्रॉफिट होता है तो बहुत बड़ा होता है, बहुत बड़ा प्रॉफिट होता है जिस दिन भी होगा, और वो 1-2 दिन ही होता है। बाकी दिन इसमें कंटिन्यूसली थोड़े बहुत छोटा प्रॉफिट थोड़ा लॉस ऐसा चलता रहता है, और मैक्सिमम टाइम लॉस ही होता है। तो इसमें स्ट्रेट कर्व नहीं दिखेगा कि ये बिल्कुल ऊपर जा रहा है। तो ये एक स्पाइक मारता है ऊपर की ओर, लुक एट दिस, एक स्पाइक, फिर धीरे 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 काफ़ी दिनों तक लॉस, फिर एक स्पाइक, फिर धीरे 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 लॉस कंटिन्यूसली, फिर एक स्पाइक, फिर धीरे धीरे लॉस। अब जिस दिन भी स्पाइक मारेगा, देयर इज अ वेरी हाई पॉसिबिलिटी कि फिर प्राइस ऊपर की ओर चला जाएगा। तो इस चीज़ का ध्यान रखना कि किस दिन देखो, ये अब मैंने 1 मंथ का दिखाया है, सेम है, अभी लॉस में चल रहा है। जिस दिन स्पाइक मारेगा बहुत बड़ा ऊपर की ओर आपको दिखेगा प्रॉफिट जनरेट होता हुआ। तो अब कौन टॉप पे बाई कर रहा है, कौन बॉटम पे बाई कर रहा है, इफ यू डोंट नो, राइट। ठीक है, वो तो आप कहाँ पर लगा रहे हो एल्गो, उस पर डिपेंड करता है। 3 मंथ्स में भी देखोगे सेम चार्ट चल रहा है, 6 मंथ में भी सेम ही चार्ट है, सेम ही चार्ट है, कोई डिफरेंस नहीं है। एंड मैक्स भी आप देखोगे सेम ही चार्ट है। अब देखो यहाँ से ये 17/12/2024 से लेकर 13/2/2025, मतलब कितना टाइम हो गया ये टॉप बनाया ना इसने, 17/12 से लेकर 12/2, ऑलमोस्ट 2 महीने, 2-2.5 महीने मार्केट में अगर किसी ने एल्गो डिप्लॉय करके रखा होगा तो उसको लॉस ही हुआ होगा। 2,24,000 टर्न्स इनटू 77,000। आप समझ रहे हो ना? लुक एट दिस, किसी ने यहाँ पर भी तो ये डिप्लॉय किया होगा ना, ऐसा थोड़ी ना कि हर किसी ने बॉटम पे बाई किया, किसको पता बॉटम कहाँ बना है, वी डोंट नो। सो लुक एट दिस ओवर हियर, किसी ने यहाँ अगर डिप्लॉय किया है उसका अमाउंट बिल्कुल 17/12 को स्ट्रैटेजी डिप्लॉय की होती, 230, 128, और 2.5 महीने तक उसको लॉस ही था बिल्कुल, और उसका अमाउंट 12/2 को कितना हो गया था, 77,507। सो ऑलमोस्ट ही लॉस 1,50,000 इन 2 मंथ्स। अब किसी ने यहाँ पर भी डिप्लॉय किया होगा 77,500 पे, तो उसका रिटर्न देखोगे तो यहाँ से लेकर यहाँ तक कितना हो गया होगा, यू कैन इमेजिन। तो कोई भी स्ट्रैटेजी है वो ऐसा नहीं है कि बस लीनियर वे में आपको प्रॉफिट देगी, वो तो फिर मैनुअली होता है। ठीक है, समझ रहे हो ना, वो फिर मैनुअली ही कर सकते हो आप उसको। आप लाइक कि एक्सपायरी वाला दिन है तो 5 पॉइंट लेके निकल जाएगा, ऐसा पॉसिबल नहीं है। ठीक है, ऐसा पॉसिबल ही नहीं है कि एक्सपायरी वाला दिन है, एक झटका आया 5 पॉइंट निकल गए, या तुम्हारा 100 का प्रीमियम 150 पहुंच गया, 50 पॉइंट का प्रॉफिट चल रहा है। 50 पॉइंट का बोल रहा हूँ, क्वांटिटी जितनी ली होगी उसको मल्टीप्लाई कर लो, तो उस हिसाब से तो 50 पॉइंट बुक कर लेने चाहिए, बट वो एल्गो वैसे काम नहीं करता है। ठीक है, अब उसके लिए आपको वैसा एल्गो चाहिए तो फिर उसके लिए आप दूसरा एल्गो देखो। ठीक है, देयर इज़ अ वेरी हाई पॉसिबिलिटी ये एल्गो काम नहीं करेगा उसमें। ठीक है, तो जितना मैंने इसको देखा है, जैसा मैंने बताया, इंडेक्स स्नैपर ऑप्शन बाइंग वाली जो स्ट्रेटजी है, ठीक है, इसमें मैक्सिमम टाइम एक स्पाइक आता है, उसी स्पाइक में मैक्सिमम प्रॉफिट है, फिर कंटिन्यूसली काफ़ी टाइम तक लॉस चलता है, फिर एक स्पाइक आता है, फिर कंटिन्यूसली लॉस चलता है, फिर एक स्पाइक आता है, फिर लॉस, या फिर मार्केट स्टेबल कर देता है, फिर एक स्पाइक आता है, फिर लॉस चलता है, फिर स्पाइक आता है, फिर लॉस चलता है, फिर एक स्पाइक, फिर लॉस, फिर एक स्पाइक। अब ये देखो, ये लास्ट स्पाइक यहाँ पर आ चुका है ऑलरेडी, जितना मुझे दिख रहा है 1/9 को काफ़ी बड़ा मोमेंटम कर चुका है ये। ठीक है, तो अब वेरी हाई चांसेस कि ये थोड़ा बहुत तो लॉस देगा ही देगा कंटिन्यूसली। ठीक है, अब एक ना एक दिन आके वापस एक बड़ी देखना अपसाइड विक बनाएगा। अब बॉटम कहाँ बनेगा वी डोंट नो, बट आप डिप्लॉय कर रहे हो वहाँ पर एक सफिशिएंट अमाउंट जितना आप लॉस करने के लिए रेडी हो, तो वेरी हाई चांसेस कि वो प्रॉफिट मिल जाएगा। ठीक है, तो इस चीज़ का ध्यान रखो जब भी आप कोई स्ट्रैटेजी को डिप्लॉय कर रहे हो अगर एल्गो में धन के थ्रू, तो आपको ये पता होना चाहिए कि वो मैनुअली कोई बैठ के वहाँ पर टाइप नहीं कर रहा है, ऑर्डर्स को पंच नहीं कर रहा है कि 50 पॉइंट दिखे प्रॉफिट बुक कर लिया। समझ रहे हो ना, एल्गोज यूज़ कर रहे हैं धन के थ्रू, स्ट्रैटेजी के एल्गोज, उनको मैं ये कहूँगा कि जो भी एल्गो आपने लगा रखे हैं या लगा रहे हो, तो उसमें जो उसका ओवरव्यू है उसको देख के लगाओ, सिर्फ रिटर्न देख के मत लगाओ कि इसने एक महीने में इतना रिटर्न दिया है तो हर महीने उतना ही रिटर्न देगा, ऐसा नहीं होता है। फिर आपको मैनुअली ही करना पड़ेगा और कोई ऑप्शन नहीं है। एल्गो का मतलब सिर्फ इतना है कि आपकी इमोशन इन्वॉल्व नहीं है, आपका टाइम इन्वॉल्व नहीं है, पास एक फंड है आपने लगा के छोड़ दिया, फिर वो धीरे धीरे करके ग्रो करता रहेगा। उसमें ड्रॉ डाउन बहुत ज़्यादा लग रहा है आपको, 28% बहुत ज़्यादा ड्रॉ डाउन है, तो फिर आप किसी और स्ट्रैटेजी में जाओ जहाँ पर ड्रॉ डाउन कम हो, सो एटलीस्ट आपका जो अमाउंट है आपको लॉस रोज के कम देखने के लिए मिले, क्योंकि लॉस तो होंगे। ठीक है, क्योंकि एल्गो ऐसा नहीं है कि लॉस हो रहा है 5 पॉइंट का, क्योंकि उसका एक एसएल है, अगर 40 पॉइंट का उसने एसएल रख रखा है अपने सिस्टम पे तो उतना ही जाएगा। ठीक है, ऐसा नहीं कि आपको लगे यार 5 पॉइंट का लॉस हो गया निकल जाते हैं, नहीं, फिर पूरा लॉस होगा तभी निकलेगा मार्केट, नहीं तो निकलेगा ही नहीं। तो प्लीज़ इस चीज़ का भी ध्यान रखना। ओके, यूएस मार्केट इज़ ओपन नाउ, लेट्स सी क्या मूव करता है। ओपन इक्वल टू हाई ना बनाए क्रूड ऑयल, बस ओपन इक्वल टू हाई बनाया तो फिर नीचे तक ही आ जाएगा पूरा। एक तो बड़ा ही वॉलेटाइल हो रखा है क्रूड ऑयल भी आज। ठीक है, यूएस मार्केट इज़ ओपन। एंट्री भी है, ध्यान रखना आज नेचुरल गैस की 8 PM पे।
Relative to where we were in June for this year. At the same time, they've upgraded growth, kept unemployment basically unchanged, and basically projecting CPI to be sticky and close to 3%.
And saying in their statement that inflation has moved up and remains somewhat elevated, as their SEP, their Statement of Economic Projections, suggests. So then why is the bond market rallying? Why are yields down, even at the long end, if this is basically the projection that inflation will remain high and they will cut into that inflation? And what this hints at, and this I think is really going to be interesting, is this clear desire by the Federal Reserve to overweight the economy, even allowing inflation to run hot, and they will keep cutting despite that inflation. That is what is getting translated into this market.
I want to cross back over to Mike McKee if he's still with us and hasn't run off to the news conference just yet. Is Mike there? Good. Mike, I want to come back to you. How original is to see this, to see a rate cut, to see the projection of more to come, at the same time all these other things are happening with the forecast? How can you explain that?
Well, I think there's two possibilities, and they both center around the new members on the board, Anna Paulson from the Philadelphia Fed, and most probably Stephen Myron. When you look at the range of the forecasts for GDP, they moved up the bottom range and the top range, and the same is true with the unemployment rate. It didn't move at all, but inflation didn't move. And it seems that Myron probably put in stronger growth, lower unemployment, and at least unchanged or lower inflation going forward. And that probably accounts for the changes in the forecast. What's really interesting is the wide dispersion in 2026 dots. There's clearly no consensus yet on how many rate cuts they're going to want to see, except Mr. Myron thinks rates will go down to the 2.5% to 2% range.
Mike, I know you've got to run, but when you go into that news conference, you're starting to think about questions already. What do you want to know from Chairman Powell?
Well, I think you guys were phrasing it well there in your reaction. If inflation isn't going down, then why are you cutting rates is sort of a basic fundamental question here.
Mike McKee with the latest. You get ahead to that news conference. It starts in about 25 minutes' time. So we got 25. The Federal Reserve ultimately met the market for 2025. 2026 is a little bit more interesting because this market, Bramo, as you know, is much more aggressive on rate cuts for next year than this Federal Reserve based on the median dot in the Federal Reserve's projection, because as Mike McKee just indicated, the dispersion, which is something you talked about, the spread of the dots for next year is incredibly wide.
And it makes one wonder if a certain dot has a greater weight than other dots, given the fact that the market is moving on the idea of more cuts, even though some of the other dots suggested only 2 cuts this year and relatively few next year. And the Statement of Economic Projections talks about a Fed funds rate that ends next year well above 3%. We are now below that in the futures market.
Something you're interesting, you got a median, you got a central tendency, you got a home in the range and all that. Guess what? There's not a median statistic here above 2%. Is sub 2% economic growth politically acceptable coming up on an election in 2026? I don't think so.
The answer to that is no.
No,
which is why
this
the
is the edge of Europe, is what I'm looking at.
To your point, TK, which is why this administration would like this Federal Reserve to be a lot more aggressive than these dots would imply.
Which is the reason why the market is hearing exactly what you're pointing out, that is not an acceptable kind of reality. And that's why I think it'll be very interesting to see how Fed Chair Powell really gets behind this.
Greg Peters, you're following the story as it evolves. What's your initial takeaway?
Yeah, so the initial takeaway is definitely prioritizing growth. Not surprised that Myron was far afield. I am surprised by only one dissent, though. But I think most people thought, myself included, you'd have 3. But I think the question that we're not asking is inflation itself. So is embedded in that forecast, is it still I'm sorry to say, transitory inflation component driven by tariffs that roll off over time? And so if indeed that is factoring in to the Fed, forward thinking, then that does mean there's more room for cuts because they're not as worried about that inflation component. So I would just be hesitant to look at the inflation number in abstract. I think what's driving it underneath is the key.
To your point, there is a very clean, dare I say, convenient glide path back down to 2% in the forecast from 3.1 to this year, 2.6 for next, 2.1 after that, down to 2 for core PCE.
Yeah, there's a big rebuttal on that, and that is in the dollar. And you mentioned this earlier. And the idea that long-term bonds yields are falling, you're seeing a rally across the board in everything but the dollar, which just hit the lowest levels going back for the entirety of this year. That is speaking volumes about exactly what you just pointed to.
We just took out 119 on euro dollar. Let's head over to Europe and catch up with Bob Michael at JP Morgan in the heart of foreign exchange in the city of London. Bob, great to get your thoughts. You've had about 8 minutes to go over this one. What jumps out to you, sir?
Couple things jump out. Greg's right. One dissent was surprising. We certainly thought there would be 3 pushing for 50 basis point rate cuts and possibly 2, suggesting nothing. And then also the fact that 2 rate cuts were pulled forward into this year. We thought there would just be 1 more for this year. So more or less where we were last time. It tells me that this is a Fed that locked arms, felt this was time to reduce policy from what was surprisingly restrictive to them. They were probably shaken by the labor market revisions. and thought, wow, we've kept policy a lot more restrictive than we thought. Let's start getting to neutral, and let's do it in unified fashion. I think this is good for the markets.
Bob, good for the markets. Let's talk about which ones. It might be good for risk assets. How much can this keep being supportive for long-term bonds, given that theoretically higher inflation would come on the heels of a prioritization of growth, and typically higher inflation is bad for long-term bonds?
Well, I wonder if the indication of higher inflation is just a suggestion to us not to expect 50 basis point rate cuts in here, but 25 perhaps every meeting for the next few meetings. Maybe they don't get down to 3% right away. They pause somewhere around 3.5 either side of that. I get that. I'm sort of with the Fed. We don't really know the shape of inflation until we see the final shape of tariffs. Right now, the evidence is pretty good. Businesses have absorbed some of it, and the consumer hasn't really pushed back all that much. And there's been signs of disinflation. So I'm not that concerned about inflation.
Bob, your colleague Michael Feroli made global headlines a long time ago talking about a sub 2% potential GDP. Without COVID, tri-stimulus, and all the rest and the legislation, these median growth estimates today, do we have to get used to this? Sub 2% real GDP?
It doesn't feel like we're going to have to get used to it. It feels like we live in a world where policy will be generous on the accommodative side, both fiscal and monetary. We're looking at dots now, but we also haven't weighed in. Forget about tariffs. The One Big Beautiful Bill Act, that starts to hit in earnest in the first quarter. So I wouldn't be surprised to see GDP estimates go up next year.
For those of you just tuning in, about 10 minutes ago, 11 minutes ago, the Federal Reserve made the decision to cut interest rates by 25 basis points. There was one dissent, an individual looking for a 50 basis point cut. That was the newly minted Governor Myron, sent over from the White House.
Does he have a business card
at the Federal
yet?
Reserve. I want to get to something, TK. Check this out. Go to the dot plot and the projections. And if you go to the dot plot and you look at 2025, there is a very lonely dot at the very bottom of the screen, and it's sub 3%. Not for next year, but for this year. There is a dot there just below 3% for 2025. Now, we were all asking, and of course, when you follow those things, there are no names on the dots. You don't know who they belong to, but I think we've got a pretty good idea who this might have come from. We've been asking how aggressive Governor Myron might be. The dissent is one story. The push for a whole lot more for the year ahead.
You mean 125 basis points of rate cuts by the end of this year seems a little bit aggressive? Look, to me, that is notable, and it might be exceptional for people to hear that, and absurd if you think about the growth in the economy. And yet, how much is the market trading off this? And I wonder, how much does this have disproportionate weight in the market? Because this is someone who really is coming with the backing of the president and could be some sort of signification of who he might pick next year.
I can see this picture at the corner of my eye. So let's take this picture. And for our audience at home, I'm just going to articulate what we see on the screen right now. So you've got this lonely dot for 2025. And then in 2026, you've got this additional story to think about. This massive spread in expectations from individual policymakers at the Federal Reserve. Lisa, they have got absolutely no idea what 26 brings, what 27 brings.
Correct.
This is a low-conviction Federal Reserve, and you've got to bear that in mind when you go into this news conference. These guys are not gods. They haven't got crystal balls. They are clueless going into next year.
We're all clueless. And when we were speaking today to some of the heads of retail banking, what we have seen is retailers themselves don't know how much they can pass along inflation, how much there will be this elasticity in terms of demand.
Greg Peters is not clueless. I'm looking at the Bloomberg Total Return Corporate Index, and it is a miracle price up and yield down. Do you predict that we will see these acclaimed indices, the Lehman, Barclays, et cetera, now the Bloomberg Total Return Index, they're going to break through and go through the highs of pre-COVID? I mean, we can have a new low-yield regime that we just didn't think would occur.
I don't think so. I think that's heroic. I think the world has changed post-COVID. I think the environment of zero interest rates, negative interest rates will continue to be looked back on as a bad idea. That drove those rates to those levels. So
but can we go on the edge of Myron? I guess that's the question. Can we find that dot?
I don't think you can get there without a recession, honestly. And I think it's important to remember, the starting place is above neutral, right? So we're not even at the top of neutral yet.
Yeah.
So The Fed still has room. They still can get to 4%, and they're neutral, right? And so we have a long way to go. As you get much lower, though, that's where things become really quite accommodative, and I think that's a different question. So I think we're all kind of hot and bothered by this move, but the truth of the matter is we're not in neutral territory yet.
In some ways, this was the easy decision, and every decision after this gets a little bit harder. In equities right now this afternoon, equities rolling over on the S&P 500, so negative now by about 0.25%. Check out the Russell, up by 1.24%. The rally for small caps continues. Bond yield still a little bit lower at the front end, lower at the long end. 30s are down by 3 basis points. 2s are down by almost 2 basis points. We've got Bob Michael at JP Morgan still with us. Bob, I want to come back to you. You've just heard from the Federal Reserve. And I don't know what we get in the news conference, but let's just go with what they've told us so far. They're telling us we can upgrade growth, not bring down the projections for inflation, and ultimately offer you more rate cuts. How bullish does that make you as a bond investor?
Aren't they magical? It's all dependent on their policy. If they bring rates down to where they say they're going, they think they are going to cause greater growth and maintain stable inflation. Look, I think there are so many policies in flux on the fiscal side that we don't know yet. I think what we do know is that the labor market was starting to struggle by a greater degree than we all had thought. And we saw that revision and went, and it's time to start relieving some of the pressure on corporate America now.
John, it's 2:16. We've yet to mention tariffs. I find that extraordinary.
So I'm pleased you've brought this up, TK, because I think still a lot of people are talking about the tariffs of April as an event and not a process. And I think it's far more important to be open-minded about the process and the potential of pass-through still to come. We know based on the data so far that we aren't seeing the exporters drop prices aggressively. You can see that in import prices. We know based on the data so far that a lot of companies domestically are absorbing this on margin.
Right.
What we don't know is whether they pass on those costs in the next several months and change this inflation picture entirely.
Exactly. And when I look at the Excel spreadsheet from the Fed here and the sub 2% growth, my question is, are we seeing a decline in purchasing power? And that's why you see, the curve coming down and yields coming down right now.
I think what we've seen, Tom, without a doubt, is that we've seen a massive step down in payrolls growth. That has clearly spooked some members of this Federal Reserve. But Lisa, I think it's key to point out, not all members of this Federal Reserve, that some members of this Fed will still be anchoring their labour market view around what's happening with unemployment, which has been pretty stable through all of this, through the whole of this summer. And look at the forecast from the Fed. They're still forecasting pretty stable unemployment, around 4.5%.
Yeah, which is the dispersion. And going back to that is the reason why I'm struggling to interpret the move in markets right now. Because is the market taking their guidance on Myron or on the idea that there are Fed officials who are pushing back and saying, actually, we need to be tighter? Right now, is this a trial balloon for what it would be if there was a Fed that was being more aggressive? Or are we not there yet? I mean, that I think is going to be a tell in terms of, does the bond market behave if it believes that a Fed is willing to really prioritize growth in a significant way over inflation?
Hey, Bob, good to catch up as always. Bob Michael there of JP Morgan. Lisa, let's turn to Diane Swong of KPMG. She's standing by. Dan, welcome to the programme. So much to process here going into this news conference in about 12 minutes' time. What's your number one issue going into the presser?
Well, first of all, it's really clear that Powell corralled the cats, and I assume that Waller and Bowman did not dissent in part because of the strong retail sales data, which also revealed inequality and something else that's going on out there, and that is that spending on restaurants went up after adjusting for inflation. Spending at grocery stores actually fell after adjusting for inflation and the retail sales numbers. And so you've got this sort of, the K-shaped economy we keep talking about, the bifurcation, but that masking the underlying weakness in lower and middle income households. So this was clearly an acknowledgement that, yes, the labor market has weakened and they want to shore up the labor market. What surprised me as well was that we had heard the Fed talk about a reduction in what they thought the neutral rate was. Powell had referred to that there had been some discussion about that in previous meetings. That did not show up in the forecast. And I think that's important as well because they're removing restriction now. It's not just calibrating down because the neutral rate has moved down. They're trying to say, listen, we're removing some restriction, acknowledging the weakness in the labor market, want to shore up the labor market. But if you really do read this sort of through to next year with a major change in leadership at the Fed, you could have a situation where you overstimulate and get a more pernicious and self-fulfilling prophecy on the fact that consumers and firms now expect inflation to be higher. And I think what the Fed is struggling with is that consumers are also telling them in their own surveys that the job market's the worst it's been on record since 2013. That's something that has got to have startled the Fed as well.
Diane, this is without a doubt a very confusing economic time. It's also a very confusing time when it comes to the Fed's reaction function. Do you have a clear sense of how the Fed is going to prioritize incoming data, whether it's retail sales or jobless claims or whether it's the payrolls report, and decide how much to ease?
It's really hard. This is, it's one thing for the Fed to have forecast the stagflationary, mild bout of stagflation that they did since March, that's gotten more stagflationary over time. That was hard to forecast. It's another thing to live it in real time. And that's what we're doing. And unfortunately, it is very hard to not, you have to shore up the labor market a bit. That said, right. You don't want to remove so much accommodation that you allow these waves, as we heard earlier. I mean, the idea that these are an uneven rollout of tariffs, so it's not just one and done. And Powell was careful in his Jackson Hole remarks on that, too. It's not all at once. It's coming in waves. That reinforces the idea that we're going to normalize inflation, which becomes its own self-fulfilling prophecy. And the Fed really has to be quite cognizant of that.
And Diane, in the study of Michigan, Chicago, and down south down the Mississippi River, the mail I get is people are flat on their back in this K-shaped economy. How does Jerome Powell address the have-nots of America? They don't have AI. They didn't buy NVIDIA like John 3 years ago. What do we do with the people that aren't participating in the system?
Well, it's really the inequality is getting worse. We know that. Actually, Moody's just came out with an updated estimate on some of the inequality. And, the top 3.3% of households are really doing really, really well. The top 20%, a little bit better in terms of gaining spending since 21 relative to inflation. The rest of the economy, the bottom 80%, pretty much flatlining it since after adjusting for inflation on their spending patterns. That's a really tough position to be in, and it gets to the heart of what we're still dealing with is the embers of the pandemic inflation were still smoldering when you added on the tariff-induced increases in prices. And that's what's really tough for the Fed to deal with and for the average American, because remember, even when the labor market was much more robust, when inflation flared, the majority of Americans believed we were in a recession because their purchasing power was eroding and they were losing ground. And I think that's very important because it really gets to the corrosive nature of inflation. And at the end of the day, you cannot get full employment sustained unless you really derail inflation. What we don't know is if this will just be a couple steps up and then just come off, or if it will be more persistent. And that's what he's going to have to emphasize at the press conference today, is that they're going to be mindful to watch what's coming on in terms of how persistent the inflation becomes and how much inflation expectations, to get jargony, get unmoored.
NVIDIA, that's my biggest position, TK, at Hindsight Capital.
You killed it.
I wish.
You just killed it.
Diane Swank of KPMG. Diane, thank you. Appreciate it. Matt Lazzetti of Deutsche Bank standing by. Matt, welcome to the program. What an interesting forecast mix. More rate cuts in our future. Growth apparently okay. Unemployment not a problem. Explain that one, Matt.
Yes, I think for the near term, it's pretty clear. They talked about increased downside risk to the labor market. And so this is all about risk management. It's not about modal forecasts at all. As you noted, growth is stronger, the unemployment rate unchanged for this year, inflation unchanged for this year. You can see it at the back of the SCP, their forecast. There was a little bit of a shift in the distribution of risks. Those officials that are more worried about downside risk to the labor market, less officials that are more worried about upside risk to inflation. It's basically in line with what we were anticipating. The Fed shifting in a little bit more dovish direction today. Close call on the 2 versus 3 dots. I think the key question for Chair Powell is how much does he lean into the near-term signal of cutting at each meeting this year?
Do you get a sense, Matt, of how much the reaction function has shifted? John's done a really great job of talking about how from July to August, there seemed to be a shift from the unemployment rate to the headlines, payrolls report. Do you have a sense of just how tolerant this Fed is going to be of inflation well above 2% for years on end and keep cutting?
Look, I think they're showing us that they're pretty tolerant above target inflation. In fact, if you look at their forecast for next year, they actually raised their inflation forecast by 0.2. They raised their growth forecast. They lowered their unemployment rate forecast, and yet we see a lower Fed funds rate. I think the reality is we are now projecting at 5+ years of inflation being at least 50 basis points above their target, and yet they are cutting rates into that environment. So I think it's a Fed where, as long as there are no worries about the labor market, they can be hyper-focused on inflation. But once some of those concerns about the labor market really manifest, you see a pretty dovish shift. And I think that's what we saw from Chair Powell at Jackson Hole, and we're seeing it manifested now through the dot plot.
Matt Lazzetti, Diane Swonk brought it up, and many others have as well. We're all focused on tariffs and substitution. Are we seeing a decline in purchasing power here? Is there an income effect from tariffs that the Fed has to fold in? And what is this, John? 50 more beeps they're going to do by the end of the year?
Potentially, yeah. Widespread of estimates, though, TK.
Win one of them.
125.
TK, Spurs are doing all right.
Yeah, they are. Matt, purchasing power here. This is a huge issue for Americans, isn't it?
It is, no doubt. But, I think the main area where you would first see that is through consumer spending data. And I take Diane's point and the points earlier that there's great dispersion around that data, with that being driven by higher income households. At the same time, GDP growth is tracking above 3% in Q3. It was above 3% in Q2. Retail sales are robust. CapEx growth was strong. So I think it's a Fed where, even if you are seeing it eat into disposable income growth, consumer spending growth in the aggregate is strong, and monetary policy has one blunt tool, which is the Fed funds rate. So really, they're not apt or really able to get at a lot of those distributional issues. I think Chair Powell and the Fed would probably tell you that is more up to fiscal policy, tax and spending policies that we would see from the administration. So I don't think that this is really about trying to alleviate some of those distributional concerns. I think it's concerns about the aggregate labor market, which is not being manifested in strong growth at this point in time, and them just trying to get ahead of it and taking out some insurance against that.
Matt Lazzetti, appreciate it. One of the best, Matt. Thank you, sir. Matt Lazzetti there of Deutsche Bank. The news conference a few minutes away. We often hear people come on the programme and say, I expect it to be dovish. And really the response to that should always be dovish to what? Relevant to what? Relative to who and what and where? Relative to the market, this isn't dovish. Of course, we were looking for really bullish expectations for rate cuts in the next 12 months or so. But it's their own forecasts that make this dovish. The fact that the Federal Reserve is coming out and telling you, you know what, Lisa, next year, I expect a better picture for growth. I expect a slightly higher inflation print than we did a few months ago. But you know what? I give you some rate cuts to the mix as well. That's basically what the Federal Reserve has communicated in these forecasts today.
Yeah, the currency markets are hearing that loud and clear. And I think that is the biggest tell. And I keep going back to that with the Bloomberg Dollar Spot Index now at a new post-2022 low. We have seen it completely weaken, fall versus some of its counterparts. Why? Because of this prioritization of growth over inflation by the FOMC and a reiteration of that in this SEP.
Greg, I got to ask you a basic question. You've been doing this for a few years. When you read sell-side literature right now, economic think tank literature, can you trust the forecasts?
Well, yes. I mean, I think forecasts are always fraught. The dot plot is no different than a sell-side forecast. It's not like they come with any additional information. But I think in this particular period, when there's so much going on, and I hate the word uncertainty, but it is the right word. I mean, we've been talking about tariffs as an example. We have a Supreme Court decision coming. We don't know what the shape of tariffs is going to look like after that, just as one example. So, so it's a really difficult environment. So you should expect to see more dispersion. What the markets are trying to suss out, what I'm trying to suss out is what's real and what's political. And I think that's an open question, and time will tell on that front.
Is the political real?
Well, the political is driving the real.
They're going to be the same thing next year, aren't they?
Yeah, no, absolutely. And I think this is the world, or this is the investment realm that we have to deal with. And so it's not going to change anytime soon. But this was an incredibly dovish SEP and dot plot, and the markets are responding in kind.
We don't know for sure who that dot actually belongs to. at the Federal Reserve? You can have a decent guess.
Come on.
Sure. They're not going to tell us. But here's my point.
I bet you $10.
It would be a mistake, I think, to say, that's Governor Myron, it does not matter. Isn't that a hint, a flavour of what could be coming further down the line in 2026? Isn't that ultimately what the Fed share doc could look like in the next 12 months?
This is the reason why I do believe, based on the market activity, people are putting a disproportionate amount of weight on that dot and on the view, on the dissent, because it is a flavor of who that new Fed chair could be.
We're close
exactly
to Powell coming out as quick as I can. The markets will police the politicians in Washington.
TK, you say that. Look at what this Fed's just done. It's revised higher its inflation forecast and just cut rates.
But we are, as he correctly said, Greg said, we're above the neutral rate substantially. They got wiggle room here.
This decision is the easier decision. Without a doubt, we're on the same page on that front. But if anything, you could talk about this Federal Reserve falling into the hands of political actors. This Federal Reserve hasn't hit its inflation mark for years, led by the chairman of the Federal Reserve, Jay Powell, who stepped into the room. Let's take a listen to the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today, the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank
you. You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of does it help or hurt this political party, this politician. That's the framework. And I think people find it hard to believe that that's just that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having really a great discussion around these challenging issues. So.
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data; it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minorities. Unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut. But the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along.
गाइस इन्वेंट्री आने वाली है नेचुरल गैस की किसी का कोई ट्रेड चल रहा है तो भैया एसएल कॉस्ट पे रख लो फिर देखते हैं इन्वेंट्री को फोरकास्ट देखोगे बाकी क्रूड ऑयल में भी हाफ प्रॉफिट बुक कर लेना यार और ट्रेल कर लो बहुत ही स्लो जा रहा है टारगेट यहाँ तक रख सकते हो बुक द हाफ प्रॉफिट एंड ट्रेल नीचे आएगा तो अब यहाँ से बाई करेंगे काफ़ी देर हो गई बहुत स्लो जा रहा है ठीक है हाफ प्रॉफिट बुक करके ट्रेल कर सकते हो क्रूड ऑयल में बाकी इन्वेंट्री आने वाली है तो देख लेते हैं क्या इम्पैक्ट डालता है ठीक है फोरकास्ट देखोगे नेचुरल गैस इन्वेंट्री का लास्ट टाइम 71 बुलियन था इस बार 80 बुलियन है लास्ट टाइम से ज़्यादा एक्सपेक्ट कर रहे हैं तो अगर 80 बुलियन से ज़्यादा कुछ भी आता है इट इज़ बेयरिश फॉर नेचुरल गैस प्राइस अगर 80 बुलियन से कम आ गया तो इट इज़ बुलिश फॉर नेचुरल गैस प्राइस तो फोरकास्ट तो बेयरिश है देखते हैं फोरकास्ट के अकॉर्डिंग आता है नहीं आता है डेटा ओके आ चुका है गैप डाउन ओपनिंग हुई है बेयरिश ही लग रहा है शायद ज़्यादा ही आया है इसका मतलब नीचे एक सपोर्ट भी है देखते हैं ये ब्रेक होता है नहीं होता यस बेयरिश ही है 80 बुलियन से ज़्यादा आया है 90 बुलियन तो नेचुरल गैस इन्वेंट्री इज़ बेयरिश फॉर नेचुरल गैस प्राइस नेचुरल गैस की जो इन्वेंट्री है बेयरिश है नेचुरल गैस के प्राइस के लिए प्राइस को डाउन जाना चाहिए एज पर द इन्वेंट्री ठीक है हो गया यही इन्वेंट्री थी अब कोई इन्वेंट्री नहीं है ग्रेट ठीक है यहाँ पर एक सपोर्ट है यहाँ पर एक बाइंग का प्लान रखना एक्सपेक्टेड है एक बाइंग इस पूरे जोन में कहीं भी बाइंग आ सकती है क्योंकि ये सिर्फ फोर्क क्या कहेंगे इसको न्यूज़ बेस सेल ऑफ है नीचे सपोर्ट है तो ये पूरे सपोर्ट जोन में से कहीं से भी बाइंग आ सकती है वैसे तो यहीं से आ जानी चाहिए थी बट वो न्यूज़ की वजह से गिर रहा है तो पॉसिबिलिटी है यहाँ से प्राइस वापस ऊपर जाना चाहिए ठीक है तो बाइंग प्लान कर सकते हो यहाँ से इस पूरे जोन से कहीं पर भी लाइक भी करते रहो गाइस जिन लोगों ने लाइक नहीं किया स्ट्रीम को डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल सब्सक्राइब करना भी ना भूलें चैनल को Rarely stalls has jobless claims dent rate cut outlook. US government Intel stake worth 14 billion after Nvidia deal. यहाँ नीचे आएगा तो एक बाइंग का प्लान रखना। क्रूड ऑयल ने भी हाफ प्रॉफिट बुक करके ट्रेल कर लो, बहुत देर से रुक रहा है। थोड़ा और ऊपर आ जाता तो बेटर था, नहीं आ रहा है। दोबारा बाई मत करना लेवल से, बिकॉज ऑलरेडी डीप लेवल से बाइंग करके गया है प्राइस। जाना है तो एक बार में ही चला जाना चाहिए नेचुरल क्रूड ऑयल को भी।
Supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. You know, we endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labour market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected, what we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up the median for growth for this year. Actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates. And that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
You know, forecasting is very difficult even in placid times. And as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. You know, the level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, I'm wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. But as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
That wraps up the news conference with Chairman Powell down in Washington, D.C. Here in New York City, we're reacting to a 25 basis point rate cut from the Federal Reserve, a dissent pushing for 50 basis points, and a huge debate about the future. Anna Wong of Bloomberg Economics with this to say: I have not seen a meeting with so many contradictions. This is a low-conviction Federal Reserve with limited visibility and a very wide range of views on the future. And this is why this market is so confused, captured by this move in the equity market on the S&P 500. Move lower, move higher, all over the place. This market is somewhat shaken. Bramo, this Federal Reserve has no idea what 2026 is going to bring, and this chairman did his best to articulate that.
And I don't know that he sent a clear message because it's not possible to send a clear message. That sound you hear, that's the idea of forward guidance dying. Because ultimately, how can a Federal Reserve with this level of dispersion in views really give any sense of their reaction function? And to me, the idea that he said there wasn't widespread support at all for a 50 basis point rate cut, and talking about this as a risk management rate cut, flew in the face of the hopes and dreams of markets that were hoping for a bit more.
And that's brilliant about forward guidance just evaporating. And John, it goes back to when you looked into the other room here, the south wing of our studios, and you looked at the dot plot, and the dispersion looked like a B-52 bomber's wingspan.
Massive spread.
Massive.
We can talk about it right now, TK. At the very bottom of that spread is a dot that's basically projecting a massive amount of rate cuts for the year ahead.
It's a political dot.
A sub 3% dot. Tom, look above it. You've also got a dot there that's looking for a Federal Reserve that could be hiking interest rates over the next several meetings. These dots are all over the place, and Bramo, you nailed it. A risk management rate cut, two-sided risk, no risk-free path in a meeting-by-meeting situation. I think the chairman did his best here to form a consensus that probably didn't exist on the committee when they got together for the first day just yesterday.
Yeah, I think that that's well said. He even talked about the labor market, that clearly you can no longer say it's very solid. But then he went on to say that any kind of headline disappointment was due to the immigration picture, probably in a significant part. This is the reason why it is a Federal Reserve that is unable to really present forward guidance, because ultimately we don't even know who will be doing the guiding and who will be doing the decision-making coming next year. And that is the reason why there's so many questions about that outlier. Tom called it a political dot. That political dot potentially has quite a bit of weight.
It might be a flavour of things to come in 26 and beyond. Joining us now to discuss, the former New York Fed President, Bill Dudley. Bill, welcome to the programme, sir. A lot to process here, many contradictions. Is that a fair way of describing this meeting?
I think there's a lot of tension between the inflation outlook and the labor market outlook, but I think Powell said it pretty well. I mean, he said basically we think that the risks on the unemployment side have risen more than the risks on the inflation side. And so given that, we should be less restrictive. And so we're taking out essentially a risk management cut to reflect the fact that the risks on the labor market seem to be a little bit higher. After that, there's a lot of uncertainty about, how that's going to evolve in 2026 and 2027. And the committee, is split about what to do going forward. I think it's interesting. The market reaction initially was like, oh, gee, 2 more rate cuts this year. And then I think people parsed the summary of economic projections a little bit more and realized that it was actually 9 to 9 plus Murrin. So 9 people wanted either no more cuts or 1 more cut. And 9 wanted 2 more cuts, and then there was Steve Murrin, who I'm absolutely confident that's his dot.
Well, Bill, I think a lot of people would agree with you. I just wonder going forward how much you are satisfied by Fed Chair Powell's response to why they're upgrading their expectation for inflation, why they always put the idea of 2% 2 years out, and why they are still cutting even though they have not achieved that in more than 5 years.
Well, if he didn't think policy was restrictive today, then they certainly wouldn't have cut. But he's starting with the premise that policy is restrictive. It's exerting downward restraint on the economy, and basically, given that the balance of the risk have shifted towards greater risks to the downside on the labor market side, he wants policy to be somewhat less restrictive. So this is a very modest adjustment, and I don't think there's a lot of I don't think there's forward guidance at this point really that's meaningful, because it really is going to depend on how the market. The economy evolves. I mean, look at the data just over the last couple of months. We have weakness in the labor market, and then we seem to have strength in terms of GDP and spending. So the Atlanta Fed GDP now forecast for the third quarter is at 3.4%. So there's a lot of uncertainty on the outlook. But this is an insurance rate cut. That's all it is, and it doesn't really foreshadow what's going to happen going forward.
Bill Dudley, you're one of our best at dovetailing the dynamics of market economics into our academics. I think of Robert Hall, who was at Berkeley, and he went over to a school across the bay. I can't remember the name of it right now. Bill, I look at the inflation. Let's take East Hampton, Massachusetts, where when you were a kid, you were in school there. Sewage rates are up 33% in the last 24 months. Is this a Fed looking at a purchasing power crisis for too many Americans out to the December 10th meeting and into next year?
Well, there's definitely a squeeze on low-income households. They don't benefit by the rise in the stock market. They don't benefit by the fact that they're locked. They hold 3% mortgages. They're hurt by the higher tariffs. They're hurt by the weaker labor market, and so it's really a tale of two economies in terms of the outlook. Monetary policy is a very blunt instrument, and unfortunately, the Fed can't calibrate monetary policy to sort of equally help everybody in the current environment.
So who do they do it for, John? Global Wall Street? Is that the mandate?
You know what I was thinking back to, TK? My days back at school when I was a kid. If I kept telling my mum, in 2 years I'll do better, in 2 years I'll do better, I'm sure my mum at some point would lose patience. Bill, should we lose patience with this Federal Reserve? What is this? In 2 years' time, we'll hit our inflation target. In 2 years' time, we'll hit our inflation target. Mike McKee addressed this in the news conference, and I actually think it's a really important moment. How credible is this pursuit of 2%?
Well, I think it's a fair point that, it's always 2 years later we're going to finally achieve our inflation objective. The Fed's basically trying to, as Chair Powell made it very clear, they're trying to balance the fact that the two goals are in tension. And so if they just focused on driving immediately to the 2% inflation goal, that would lead to much higher unemployment. And so they want to balance those two risks. But, the risk to the Fed is that every year you continue to go with inflation above 2%. The risk is that inflation expectations finally become unanchored. And the attacks on the Fed's independence obviously increase that risk.
Bill Dudley with the latest. Thank you, sir. Appreciate your reaction. Brilliant. Thanks for standing by. The former New York Fed president, Mike McKee, was in that news conference. It was an important moment, I think, and Mike McKee joins us now for more. Mike, first of all, your assessment of the last 60 minutes or so, and what did you make of that exchange you had with the Fed chair?
Well, in the last 60 minutes or so, I think Jay Powell was trying to walk a very fine line because he's got a very divided committee. Nobody is sure what's going to happen going forward except for Stephen Myron, who thinks that things are going to be absolutely rosy and we need to cut rates a lot. Everyone else is uncertain, and the dot plot median shows 2 rate cuts this year, but when you look at the dot plot itself, it's so narrowly divided that you really can't take any signal from it, as Bill Dudley was saying. So Powell is trying to tell people that we really don't know without saying we really don't know, and as Bill said, trying to make this an insurance cut. The 2% thing, I think, is a real question for them, and he didn't really give a good answer to my question. It's not just that that inflation expectations become unanchored, but that higher expectations can become embedded, and people don't think you're going to get it down farther. And so then how do you fight that going forward if you can't make any progress or can't be seen to be making any progress towards your target?
Mike, while you're down there, since you are in the room, it sounded like Fed press conference language. We did get a statement. We did get a rate decision. But can you tell us and just describe to us how different this Fed meeting felt, what it looked like, what kind of changes were made?
Well, I'll tell you, there's a lot more press here than usual. That's one thing that it looked like. The changes are the kind of things that you would see in the statement when they're changing policy, which they did. The dot plot may be a little bit more confusing, less guidance in it than we had seen before, and there was obviously some tension between what the rate cut medians were with what the economic projection medians were. But overall, it went off pretty much as they usually do. The Fed's statement wasn't that unusual. There obviously was the big elephant in the room of Stephen Myron that the chairman declined to comment on. He also declined to comment on Lisa Cook. He tried to keep it just to the Fed. So it really wasn't a hugely different dynamic, except that there were a lot more moving parts than we often see, or at least than we've seen in a number of years.
Mike, just before you go, there was a moment there where I do think he addressed the Governor Myron question, the importance of one individual on the committee and how much sway they have on the FOMC, how they've got to persuade the other individuals in the room. And Mike, I think it begs the question, if that Stephen Myron dot, that Governor Myron dot, sub 3%, is a flavour of things to come, Mike, to what extent this committee will push back?
Well, clearly the committee pushed back today, and we didn't see a dissent from Mickey Bowman or Chris Waller. So they seem to be satisfied with where they are at the moment. And that suggests that Stephen Myron is not going to have a lot of influence. Nobody really expected him to. It does raise the question, though, John, as you sort of imply there, that if the president gets more people on the board, where do we go from here? And the Myron dot is a sign that the president's people would definitely try to push rates lower, whether or not the economy justifies it.
Mike McKee with the latest. Mike, a clinic as always. You're one of the very best. Appreciate your time. I think it would be a massive mistake just to say that's all political. We had this conversation with Greg Peters of PGIM right before the news conference. He said what's political and what's real. Whatever you think is political right now might be real next year. And that might be a flavour of what's still to come from the incoming chairman for 2026. And it's not just about being able to persuade the rest of the committee. It's a question about how credible it will be with fixed income and broader markets.
And right now, it seems like it was credible to the extent that it's not causing some sort of massive sell-off in long-term yields. I do think it's notable that there was only one dissent about a 50 basis point rate cut. And I think we have to keep going back to that Stephen Myron was alone. He didn't get a sort of concurrent opinion from Mickey Bowman or Chris Waller.
We're going to get to Jeff Rosenberg, but John, I was going to go to Mike on this. So let me just bring it up. April 29 next year, June 17th next year, July 29. I think there's an election just after the October 28 meeting. When does House politics or even Senate politics come into this discussion with a vengeance? I don't know when it is.
I think we're right there right now.
Yeah.
You know, before this decision, Tom, we sat around the table and I said this is the last set of forecasts you'll get from Chairman Powell without knowing who the incoming Fed chair is going to be. Yeah. And I think we can say that. By the time we get to December, we'll know who the Fed chair is. We expect to know who the Fed chair is. And you're also going to know what they think about where policy should be. in 2026. And that's going to bring a very different flavour to the meeting at the end of this year. Chairman Powell did the best job he could possibly do in that news conference, given all the contradictions of this moment. Not just about the contradictions within the committee, the contradictions almost all over the place. The fact we've had the step down in payrolls growth that we've had, and unemployment has been super stable over that period. The fact we're looking for a better growth profile for 26, yet at the same time we're talking about more rate cuts, not less. It's a very unusual environment, and I think the chairman did the best he could do, given the circumstances, to communicate that.
Yeah, and I think that if he did sound a little bit like word salad occasionally, it probably was to be forgiven, just based on the fact that there aren't good answers to any of these things, especially given the dissent that you're getting on the committee.
Jeff Rosenberg of BlackRock joins us now for more. Jeff, welcome to the programme. We often say, you and I, the first move isn't always the right move, and we'll see if it sticks in financial markets. But what do you make of this move in response to some of the contradictions we've heard over the last 90 minutes?
Yeah, you guys have covered a lot of it. I'd say, the three big takeaways for me, number one, it's the validation of the Waller-Bowman critique from the summer. It's not unexpected, but it's important to recognize, that was the first thing that the markets reacted to, the change in language in the statement. And it clearly was echoed by Powell in the press conference, that the impact of the revisions on the data, he kind of focused on it and then said, well, it's not just that, but then he went back to it again and again. And so that was the first takeaway, is this labor market slowdown has clearly resonated. It's shifted the balance of risks. And that was the initial market reaction. Rates went lower and they were a bit positive on that. But when we got into the press conference, it became a little bit less focus on that and more about the forward 2026, 2027 outlook. And that's where my second point is kind of a big takeaway here, is that the bond market and the year-end 25 outlook are basically aligned. It's when you look further out into those projections relative to where the bond market is pricing where there's a lot of disagreement. And it gets to this notion of the spread that you were talking about before in the dots as you look at the dispersion there. And finally here, I think you mentioned it before, going into the meeting, there was a lot of, uncertainty about whether you'd get more than one dissent, whether Waller and Bowman would advocate for a faster move. They didn't. They were kind of on board with this adoption of the balance of risk shifting. And I think that's important in terms of validating that earlier point I just made, that, bond markets for the end of this year are kind of right on line where the Fed is. I think the disconnect into next year is interesting, and that's going to have to be resolved.
I guess, Jeff, how much does this increase the weight of just how many seats the president has to fill, given the fact that, as John and Tom were talking about, we did see pushback from the other members from going 50 basis points? We didn't see that coalescing around that view.
Yeah, that's going to be a big issue. And I think that's part of what you're seeing in terms of the disconnect between the dots today and the bond market expectations for the path of policy rates in 2026, because the path of actual policy rates is what the bond market is pricing. And the path that's written down today is based on the current makeup. Right. And so that's where you see effectively a disconnect in the bond market, incorporating the possibility of a different makeup of the FOMC underlying the expectations or the distribution of outcomes for where policy rates evolve beyond the near term, where you see really clear alignment.
Jeff Rosenberg, I assume you survived probability and statistics at Tepper at Carnegie Mellon. What's the standard error these fancy guys at the Fed are working with? How certain can we be of the path forward? Or are they really making it up meeting to meeting as they go?
Yeah, it gets to this dispersion within the dots, and it gets to something Powell he mentioned a couple of times, which I think is a really important way of thinking about and framing this moment in time for the bond market and for how the bond market follows what the Fed does. And he said there is no risk-free path. And that's a really important concept. And what he means by no risk-free path is that there's risks to erring on the dual mandate. A little question about the third mandate in there later. But there's a risk to the dual mandate if you pursue the maximum employment and you put the inflation at risk, and vice versa. If you focus on inflation, you put the employment at risk. And that's a very uncomfortable and unfamiliar spot. We called it, before we got into the post-COVID environment of too much inflation, we called it divine coincidence of monetary policy. The policy mandates were aligned. They never faced that conflict. And so bond markets never faced the uncertainty that the dispersion in the dots is reflecting. And there's really no resolution of that. It's going to be the data and what is the marginal change in data that the market's focused on, that the Fed's focused on. And the marginal change is that employment has been the big downward revision. Inflation has kind of been persistently above target, as we talked about, going on 5 years in the projections, but it's not accelerating. And that's the key. It's what's the rate of change between the dual mandate. Right now, it's all on the labor markets, and that's going to keep its focus. That may change, and as that changes, so
absolutely
will the market,
brilliant. John,
pricing.
what this amounts to is it a new data dependency?
They've made a choice. And I think we should respect that fact. Jeff, you can always fall into the trap of suggesting what the Fed should do, what it shouldn't do. Jeff, the chairman's saying there's no risk-free path, but the committee's made a choice to cut interest rates, to signal more to come. If there is a consensus, it's to cut again, and cut again. Now, Jeff, as a market participant, you've got to respect that the Federal Reserve has made a choice to take that risk. And I want to understand from your perspective how credible you think the pursuit of 2% actually is. And as a bond investor, how your approach to a market should change given the information that you've had this afternoon.
Well, and it was in your conversation with Mike McGee and his question, the risk is they lose credibility on the 2% number. Now, you can get stable prices at 3%. As long as it's not accelerating, but you're not reaching your target. So it's shifting the target and you lose the credibility and the anchoring to a 2% level. What does that mean? It means a higher level of long-term interest rates. It means a higher level of term premium. And to the extent that you get more variability as a result of not only hitting 2%, but being persistently above it, you get a higher inflation risk premium. And all those things factor into how we price in term premium, the value of the long end of the curve, the value of inflation and inflation protection. And the longer you go on above that 2% target, the more and more we start to price those things in. But my earlier comments is right now everybody's focused on the labor markets. And the key here, the key presumption that we're going to test is that inflation that's still coming down the pipe in terms of the tariff pass-through, is that one-off? Everyone's pricing it in to be one-off. Hopefully that's correct. But the data and the evolution of the data and the relative change between the inflation and the labor market data is going to shift that focus. Right now, the back end's pretty contained because the inflation data isn't accelerating at the same time as the labor market is decelerating.
Yeah, but Jeff, to build on what John's talking about, if this is essentially a central bank that has chosen, and they chose the labor market over inflation, then you would expect there to be a much bigger risk premium on some of the long-term bond yields. It's come off. And I just wonder if, let's say, President Trump selects Chris Waller to be the next Fed chair, how much does that risk premium come back because it takes off the prospect of more aggressive yield curve control? In other words, how much is this sort of subdued reaction in long-term bonds sort of predicated on this idea that this will be a very creative Federal Reserve and a very creative Treasury Department?
I mean, I think on the prospects of innovation and a change in policy, I think a lot of it will have to be the actual actions as opposed to the potential for those actions. Very hard for the bond market to price in those changes in policy until the likelihood of those other scenarios in terms of policy innovation are more clearly identifiable in terms of the probabilities. Right now, they remain kind of in the realm of possibility, but as long as they're in the realm and not in the likelihood, it's hard to price those things in. I think the second piece around it is really going to be how the data evolves to inform both those policy choices and the relative trade-off between this lack of risk-free path. If inflation is accelerating and the labor markets are not decelerating, then the shift in the focus can flip to inflation. How do policymakers react to that? And is that reaction consistent with how the bond market is pricing? I think that's how we'll evolve as we see these changes in in policy, alongside the changes in data.
If we get Chair Rick Reader, I'm loading up on bonds. Okay, Jeff? I'm going to let you go. You don't have to respond to that. Don't get in trouble.
Thank you very much.
You run. Jeff Rosenberg of BlackRock. Thank you, sir. Governor Myron, what are the odds he becomes Chairman Myron? What are the odds that someone like him joins the committee? And what would that do to the perception of this Federal Reserve? And how would it change financial markets? That dot there is really, really important for 2026 and how we should be thinking about this institution and what their approach will be, how it will change, how persuasive, how credible it might be. We've got to ask some big, big questions about next year for monetary policy and financial markets.
Yeah, and the difficulty in understanding whether the market is actually responding to that dot, right? Are we getting a sense of what the market's reaction would be to that type of approach to monetary policy, or are people dismissing it? This is not somebody who was able to get some of the other members to come on board with him. And so it is just one person on a committee.
More than ages, years, I'm looking meeting to meeting to meeting. It's a Fed that's going to be overcome by events.
Will you wake up a little bit earlier and join us tomorrow? Do you fancy that?
I can
Are you
do
going
it.
to stay in bed?
Come in. No,
What do we have to pay TK to make you wake up earlier in the morning?
I got the Bentley. It's getting the car down Fifth Avenue is really difficult.
It's difficult.
But if you want,
you know, they talk about the haves and the have-nots.
Talk to my people.
This right here.
Just buy a Bentley.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
News when you want it with Bloomberg News Now. I'm Nathan Hager. Democratic leaders on Capitol Hill are calling on Federal Communications Chair Brendan Carr to resign. That's after the ABC network announced it is pulling Jimmy Kimmel Live off the air indefinitely following this comment in his opening monologue this week.
We hit some new lows over the weekend with the MAGA gang desperately trying to characterize this kid who murdered Charlie Kirk as anything other than one of them and do everything they can to score political points from it.
In their statement, Democrats, including House Minority Leader Hakeem Jeffries, accused Carr of forcing ABC to, quote, bend the knee to the Trump administration. Carr posted on X that he's glad broadcasters are responding to their viewers. He says Kimmel appeared to mislead the public. Shares of ABC parent company Walt Disney right now are down nearly 1%. President Donald Trump is wrapping up his state visit to the UK with a focus on big tech. He signed a new tech partnership with Prime Minister Keir Starmer that he says will create new cooperation in artificial intelligence, and he singled out one AI executive in particular.
You're taking over the world, Jensen. I don't know what you're doing here. I hope you're right. All I can say is we both hope you're right.
President Trump pointed to NVIDIA CEO Jensen Huang at the Business Roundtable. Now, President Trump and Prime Minister Starmer are holding a joint news conference where the UK leader is putting a focus on geopolitics.
Security remains the cornerstone of this special relationship.
And Bloomberg's Anne-Marie Hordern is traveling with the president. She says some tense issues could come up.
The UK was set to ask the United States about the steel tariff at 25%, if that could be brought down to zero, as well as exemptions from some products like Scottish whiskey. Second, the Times is reporting, the Times in London, that this weekend, after the departure of the U.S. administration and President Donald Trump, Keir Starmer is set to formally recognize the state of Palestine. Now, of course, the United States has said that by doing that can actually impact and hurt negotiations between Hamas and Israel, because they say that the United States says that this is just going to embolden Hamas.
Bloomberg's Anne-Marie Hordern reporting from Windsor Castle. At the news conference at Chequers, President Trump is talking about the war in Ukraine. He says Russian President Vladimir Putin let him down. Tomorrow, President Trump speaks with another major foreign leader. A U.S. official says his call with Chinese President Xi Jinping will be held at 9 a.m. tomorrow morning, Wall Street time. It'll be the first direct engagement between the leaders of the world's two biggest economies since June. The future of TikTok and a trade truce are high on the agenda. NVIDIA made some big news of its own this morning, announcing a $5 billion investment in Intel just a month after the U.S. government took its own roughly 10% stake in the once dominant chip maker. Bloomberg Intelligence senior tech analyst Mandeep Singh says someone was going to invest in Intel.
I thought it would be one of the hyperscalers, because if you go back 1 year, Amazon had announced a partnership with Intel to use their foundry. Obviously, that didn't help turn around the foundry business in a big way. But clearly, you had some sort of a sentiment that, one of the hyperscalers would step in.
Mandeep Singh with Bloomberg Intelligence. And now that NVIDIA stepped in with this investment and a promise to co-develop PC and data center chips with Intel, shares of Intel are soaring. They are up nearly 26% right now, and NVIDIA's on the rise as well, up about 3%. Less than 2 weeks until a possible government shutdown, Democrats have released a counteroffer to Republicans' stopgap spending bill that includes health provisions that were left out of Republicans' big tax and spending cut law. More from Bloomberg's David Gura.
They want to see Medicaid cuts repealed that were put in place recently, an extension of the Obamacare tax subsidies. Republicans say that's a non-starter. We're really talking about a period of days here to get to a stopgap resolution.
Bloomberg's David Gura reports the shutdown deadline is October 1st. Shutdown worries aren't phasing Wall Street. Stocks are rising a day after the Fed's quarter-point rate cut. The newest Fed governor, White House economic advisor Stephen Myron, voted for a half-point move, but fellow White House advisor Kevin Hassett says he's comfortable with the Fed's call.
I know that my colleague Stephen wanted to go to 50, but I think 25 is a pretty broad consensus, and I think that's a good first step in the right direction of much lower rates.
White House economic advisor Kevin Hassett spoke on CNBC. Hassett is in the running to succeed Jay Powell as Fed chair next year. Right now, the S&P 500, following that decision, is up 0.8%. The Dow Jones Industrial Average is up 0.6, and the tech-heavy NASDAQ Composite is soaring up 1.2%. And that's news when you want it with Bloomberg News Now. I'm Nathan Hager. This is Bloomberg.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
What's special about Bloomberg Daybreak is the immediacy of the news we bring you each day in your podcast feed by 6 a.m. Eastern Time.
This isn't a deep dive on yesterday's news. Instead, you get the latest stories with context.
And that's something you don't get from other news podcasts. So join us for the best from Bloomberg's 3,000 journalists and analysts around the world, with reporting backed by data and journalists at the center of the stories we cover.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
I have no doubt the president's happy with this move. Not on Nvidia, but on Intel. Yeah. Higher by almost 30% in the pre-market. Your first reaction to that deal?
Well, I mean, look, from an Nvidia perspective, I don't see a big strategic rationale, given Intel has been such a big competitor over the years, except for the fact that Nvidia has a very healthy balance sheet, and it's been making investments, in CoreWeave and some other cloud providers. So $5 billion is not a big amount for them, given their balance sheet. And co-developing chips, to my mind, Intel's kind of ecosystem revolves around x86, and they dominate in the PC world. So that's where NVIDIA can use their distribution. But the fact that they are not using them in Foundry, I mean, that just goes to show that they don't want to touch that TSMC ecosystem where they dominate. And so it's more of, you have to convince the government that you're doing something about it. I mean, clearly, government has a 10% stake in Intel now. And, this was probably the best way to go about it.
What do you think NVIDIA might get in return? Have you given that some thought?
Well, the PC refresh cycle, we have been waiting for that for a while.
I'm thinking more of what the president might be able to give them. Access to China, selling their high-end chips.
That's definitely on the cards. And look, getting to a monopoly position is never a good thing for a company. That's what we have learned from Google, because, once you get to a monopoly position, it attracts so much attention. So to my mind, NVIDIA wants to keep competitors who are distant, third or second. And so from that perspective, it's good that Intel will be a competitor. But at the same time, NVIDIA still maintains the lead and they don't get classified as a monopoly.
Dan out of Wedbush is standing by, wants to jump on. He calls the deal a huge game changer for Intel. Dan, good morning and welcome to the program. Why do you believe this is such a huge game changer?
Pop the champagne. I mean, for Intel. Now you have NVIDIA, godfather of AI, doubling down. And this follows, obviously, U.S. government investment. I mean, what this essentially does, it brings Intel into the AI game. You think from a stock perspective, that changes the multiple. And, clearly, this is also going to be viewed very positively in D.C. I think that's something that could definitely help Jensen and others when it comes to China.
Dan, I do wonder, though, about Mandeep's point, this idea that this isn't NVIDIA going all in and developing their chips for the big semiconductors, the big hyperscalers at the Intel foundry. This is simply a $5 billion side project about PCs. How much is this essentially just an olive branch to the president and not an actual move of NVIDIA to try to fortify Intel's plans to become the foundry?
Yeah, look, Mandeep brings up great points as always. But look, this is also, it's a doubling down on investment in the U.S. I mean, that's also what it is. Now, clearly, that obviously olive branch to Trump administration and others. But what they're also doing is when it comes to PC upgrade cycle, x86, I mean, this does give them another potential growth lever. And look, NVIDIA right now, it's NVIDIA's world, everyone else is paying rent. And they know that they're in a massive position of strength. But for Intel, I mean, think about it, you went from, call it a month ago, some worries about, in terms of the CEO potentially out. Now you get the investment from government and you have Intel, now again, NVIDIA. I mean, that is a Goldilocks scenario for Intel.
This is coming at a time when China is trying to emphasize domestic production of their own technology and really trying to create national champions there that can rival NVIDIA and other U.S. tech giants. I just wonder whether it is possible to continue for the likes of NVIDIA trying to push into China, trying to sell more advanced chips into that country while at the same time playing with this idea of U.S. independence from China.
Look, it's a tight wire act, but the reality is that there's one chip in the world fueling the AI revolution, and that's led by godfather of AI, Jensen, NVIDIA. And that's why in China, look, they could tell Chinese big tech in Beijing, don't buy NVIDIA chip. That's like telling a kid, okay, don't eat the candy that's on the table. So that's the reality, because they're years ahead of when you look at Huawei and others. But at the same time, I mean, Trump administration recognizes they have to strengthen AI infrastructure, AI chip making. And you look at Intel, I mean, they've gone obviously from a huge laggard. I mean, Intel, all the red tape, all the sort of black eye moments, you finally have some positives at Intel.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, China's internet watchdog tells Alibaba, ByteDance and others to terminate orders for an NVIDIA AI chip.
Plus, Microsoft OpenAI among the tech giants announcing plans to spend tens of billions on AI infrastructure in the UK amid President Trump's visit this week.
And ticket reseller StubHub begins trading publicly today. We'll be joined by its CEO, Eric Baker, live from the NYSE.
Meanwhile, let's get to the rest of the public markets. Ed, we're in wait-and-see mode, maybe a bit of profit-taking after what's been a significant run-up in the Nasdaq of late. We're down about 0.5% on the Nasdaq 100 as we anticipate a Fed rate cut that is being priced in by the market. But what does it signal for the rest of the year? That's a key question. On the macro side, what have you got on the micro?
Well, a big part of the drag at the index level is Nvidia. We are down almost 3% on a $4 trillion market cap company, down for a third straight session. $200 billion of market cap loss. The headline's really simple. The FT reporting that China's internet regulator is saying to big Chinese tech companies, cancel orders for the latest D-powered variant of Nvidia's AI chip for that market. At the same time, Jensen Huang's in London with the President of the United States in the UK on that state visit. There's a lot of focus on this name right now.
There certainly is. Let's get to it over in Washington. Our tech editor is with us, Mike Shepard. Look, this is going to be a key conversation that Jensen Huang is likely to be having with the President of the United States, because once again, another chip designed for China being pushed back by the country itself.
Well, that's right, Caro. And Jensen Huang has been having those kinds of conversations with President Donald Trump since he took office in January. Jensen has been trying to reshape the picture when it comes to export controls in a way that's a little bit more advantageous for NVIDIA. Over the past several years, we've seen the U.S. tighten China's access to NVIDIA's most advanced AI chips, and they just won back permission to sell the H20 in China, although now we are seeing China balk at that. This latest turn of events, though, signals an escalating pressure campaign by China, and they feel like they have some leverage there because the local companies in China making semiconductors can now compete with some of those lower grade, lower performance AI chips from NVIDIA. And now NVIDIA would like to leapfrog that and sell something perhaps a little more advanced. But they would need President Donald Trump to get aboard with that. So we'll have to be watching not only for whatever conversation takes place between Jensen Huang and President Trump, but the more important conversation on Friday, Caro, between Trump and his Chinese counterpart, Xi Jinping, to resolve a host of issues. We know about TikTok, but now NVIDIA is really emerging on the screen as a topic that they will discuss. China has expressed a lot of chagrin over export controls, and this would be a moment to settle it all, including for NVIDIA.
And to be clear, the chip in question here is RTX Pro 6000D, not H20, which is largely Blackwell architecture related and doesn't use HBM. And we're trying to get more on that story. Bloomberg's Mike Shepard, thank you very much. Microsoft, OpenAI, and other American companies announced plans to spend tens of billions of dollars on tech infrastructure in the UK, from AI to quantum computing. Other announcements include investments from companies like NVIDIA, CoreWeave, Salesforce, and Google. This comes as President Trump is in the UK this week. Bloomberg Surveillance's Anne-Marie Horder joins us from Windsor. The headlines are really clear. Capital commitments from the biggest technology names, but they are like attending this state visit with Trump almost in parallel, AMH. What do we need to know, and what happens in the next couple of days?
Well, it's tens of billions of dollars, as you've said, when it comes to a massive dump of capital from these U.S. tech firms into the United Kingdom. Massive win for the Prime Minister, Keir Starmer, especially at a time when he's dealing with a lot of political fallout here in the United Kingdom, really drowning in the polls and has been on thin ice. We've seen a number of individuals resigned or ousted from his government, most notably Lord Mandelson, after revelations of his close relationship with Jeffrey Epstein in Bloomberg News reporting. So this idea that UK tech firms want to make sure that they are in the United Kingdom and building the United Kingdom is definitely a win for the Prime Minister. You have to think, though, that given all of this money that is coming from the United States, regarding artificial intelligence, regarding cloud computing and quantum computing into the United Kingdom, that might give the president some wiggle room and leverage to feel emboldened to bring up once again at the negotiating table the digital services tax, which more than 20 Republicans in Washington are really urging the White House to do on this trip. So there's a lot of tech deals to be had, and this evening the president at a banquet is going to be flanked by Jensen Huang, who was, of course, with him as well on the Middle East trip. Sam Altman of Altman AI, Satya Nadella of Microsoft. And also, I think the name to watch, of course, is Apple's Tim Cook, because notably, that was the individual that was missing in the Middle East that the president continuously wanted to remind everyone he was absent. He's joining him on this state visit to the United Kingdom.
Bloomberg's Anne-Marie Horden, we thank you so much from Windsor Castle. Let's talk more about TikTok now, because its US operations would be acquired by a consortium that includes Oracle, Andreessen Horowitz, and a private equity firm, Silver Lake, under a deal President Trump is set to discuss with Chinese President Xi Jinping this week. This framework agreement would create a US-based version of the popular social media app. Let's bring in Bloomberg social media reporter Alexandra Levine. I mean, this whole segment is about how technology is at the heart of geopolitics. TikTok has been throughout many a year. Does it feel like we're getting some semblance of that framework that still might not actually occur?
Well, look, the issue has never been, can the U.S. come up with buyers that China likes? The issue has really been, can China part with the algorithm, which is the secret sauce of TikTok, which is what makes it so popular with half of the country. And so even though we now know that Oracle and Silver Lake and Andreessen are sort of potentially at the finish line with this, there's very little detail about how ByteDance will be involved in this potential U.S. app that might be that U.S. users might be asked to migrate to. And so without knowing the details around the algorithm and also ByteDance's involvement, we really don't know if what we will end up seeing with this framework will even be compliant with the law.
Exactly so. Everything we're discussing is according to Bloomberg reporting and Bloomberg sources. And when we did speak to a White House official, they basically said that any details of this framework are speculation until such time that the White House confirms them. However, based on the reporting, Alex, something Caroline and I were discussing this morning is that the consumer, the TikTok user, will face a choice. Go to a new app, stay or not, and just explain the kind of no man's land and confusion there is out there right now for TikTok as a platform.
Well, look, I think that TikTok users have proven that they are an extremely loyal base. We saw that earlier this year when TikTok was on the verge, or last year when TikTok was on the verge of being banned, and TikTokers called their members of Congress and deluged them with messages saying, keep the app, don't ban the app. But I think one thing that'll be really important to watch is just the limbo that the people working at the company will be in, and also a lot can change between now and Friday. As we know, there's a lot going on with NVIDIA right now. There's sort of other players that are percolating in the background that could completely change things between now and Friday, and then a lot could change between Friday and the middle of December when this next phase of the extension will expire.
Bloomberg's Alexandra Levine, thank you very much. Now, coming up on Bloomberg Tech, shares of the ticket reseller StubHub begin trading today. Stick with us for a front row seat to a conversation with CEO Eric Baker. No ticket required. That's next. This is Bloomberg Tech.
For over 147 years, Bgrim has embraced doing business with compassion, always committed to giving back to society. We empower people and strengthen communities for a better future.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself,
It is the first week of September. Our clients are just back from the holidays, and we've gathered over 1,000 of them with us today, and we're going to help them piece together a strategy.
Clients are in the room and they're here to hear more about investment opportunities in Europe, possibly in Japan, in China. We're here to help, and we can help them find those opportunities. We can advise them on how to position their trades, and then we can facilitate and give them access.
Shares of StubHub will start trading today, with the shares having been priced at $23.50. That values the company at around $8.6 billion. The ticket reseller is the latest company to go public in a US IPO market experienced a bit of a hot streak. Let's speak with StubHub CEO Eric Baker, who joins us now from the NYSE. Eric, the history. You set up this company in the year 2000, you sold it to eBay, bought it back, amalgamated with a European giant you had already built, and now it goes public. How does it feel?
It's tremendous. A lot of gratitude to reach this milestone for the company. It's certainly been a long journey, as you say, from 2000, but now we're really focused on the next 25 years and the bright future ahead.
Take us to the next 25 years, because there are regulatory headwinds. There are people worrying about bots. There are a way in which you can beef up this business to add more things in secondary market ticket sales. Where do you go? Where do you focus?
Yeah, so our focus really is we've always wanted to make it easier for people to access live events. And so what we started with is, as you noted many years ago, was to make the resale market safe and secure and easy for people to access tickets. What we're focused on now is we realize consumers don't care whether it's a primary ticket or a secondary ticket. They just want to access the live events that they want to go to and discover easily, safely, and so forth. And that system's been pretty broken for a long time, how those tickets are originally distributed. So we're really working on creating a better experience, and we've already had exciting partners like the Yankees and Major League Baseball who have started selling tickets directly in this open distribution network.
You looked at going public in a time where Taylor Swift had gone through the Eras Tour. There was a lot of hype and momentum, and you hit pause. You're doing it now, and I think a big question everyone's got for you, Eric, whether they're a consumer or not, is what happens next with a regulatory crackdown. The practices of your industry are very much under the microscope at the moment.
Well, I think, first of all, we're always excited to be at the intersection of technology and live events because we're very bullish on the future of live events, and we think that doesn't change. To your question about regulatory focus, I think two of the things really people have looked at, one was transparency in pricing. That we at StubHub have always advocated for. And that all-in pricing that we lobbied for passed at the federal level in May. And that's just a better experience for consumers. And the key is it's now a level playing field for everyone in the market. I think the second real regulatory focus, quite frankly, has been what the Justice Department is looking at with the primary issuance of tickets and making sure that networks are open and fan-friendly. And that is something we certainly applaud because we're on the side of the fan.
Eric, is artificial intelligence a headwind or a tailwind for the secondary ticketing market?
Yeah, we see it as a tremendous opportunity, a tremendous tailwind. And I think if you think about it, again, we're a technology and product company. And I think Alex Karp at Palantir, I don't want to misattribute, put it really well that he said the artificial intelligence technology for companies that have tremendous data allows you to provide a better product while increasing your revenue tremendously and reducing costs so that everyone wins. And we're seeing that across the board, how we deal with customer service, how we're releasing new features in the product to make it easier for people to locate the tickets they want. So we're very excited about it. And again, with the leadership position we have and the scaled proprietary data we have, we think the sky's the limit.
We are speaking with Eric Baker, founder, CEO of StubHub, to our radio and TV audiences. You say AI could help drive revenue tremendously. Let's talk about your revenue thus far, because in the first half of the year, it's about 3% growth. That is significantly slower than the previous. Now, we know that maybe we haven't had Taylor Swift on tour this year. But, Eric, are you seeing a slowdown in demand?
Yeah, so thank you. No, we're really seeing people continuing to buy tickets and growth. I think it's important to note two of the things that happened that are unique this year. One is Taylor Swift. And her tour is behind us. And there is only one Taylor Swift. So I think she's so tremendous, we even broke her out in the S1. So it's great to be that popular. Second is, as I mentioned, all-in pricing passed in May. And when we lobbied for it, we knew that creates a one-time hit to the market as consumers just adjust. We've seen that already in states like New York that had passed it before. So when you look through those headwinds, the business is growing extremely nicely, north of 20%.
I'm interested, though, on your profitability or lack thereof, Eric, because it's interesting you've gone public without that story to tell. When will it become the story you can tell?
Yeah, no, I think what you're referring to is by the accounting metrics like net income that it shows a loss. But I think when we went on the roadshow and when investors look, they really look at EBITDA, which is your earnings before interest, tax, depreciation, amortization, as well as your cash flow. And on that dimension, we've been profitable for a long time and generating hundreds of millions of dollars. That's the way we've been able to service the debt that we've had. And obviously now that we're deleveraging and taking the debt down, our cash flow will even go up further. So I think that's one of the many reasons that our story was very well received when we went out on the roadshow and by our new partners.
Eric, Bloomberg did some deep reporting on the FTC looking at Ticketmaster arrival on the issue of bots hoovering up tickets for resale and their inaction. Have you discussed that issue with the regulator, and how are you addressing the problem?
Yes, we've always, and bots, and it's interesting as you note, is really about how these tickets are distributed in the first place. And so one of the things we've always lobbied for is enforcement of the Bots Act. And that's really because we believe that these tickets need to be distributed in a way that's safe, secure, democratic, through open channels. As you mentioned, they're looking at, I believe, Ticketmaster and others who are handling the primary issuance of the tickets. And they really need to make sure that their technology and safeguards are in place to make sure this doesn't happen. But again, it's something that we're very pro-consumer. That's how we win. So we hope that all that stuff gets cleaned up.
Eric, very quickly, next year's soccer or football World Cup, how big an opportunity is that for StubHub?
Look, we love the World Cup. It's been a phenomenal event because think about it. We run the largest global platform in the world for ticket exchange for all kinds of events. And if you had to say what is the largest global event in the world, I think you can honestly say it's the World Cup. It's people from all over the world traveling to come see events. It's going to be in North America. It's extremely exciting. And we're excited to hopefully help as many fans as possible make their dreams come true to access getting to the World Cup. So we're all football fans, so to speak, in 2026.
We're football fans here too. Eric Baker, founder and CEO of StubHub Holdings. Great to have you on the program. Thank you. Now, coming up, we're going to be joined by Grok CEO, that's Grok with a Q, Jonathan Ross, on the company's new funding and its plans to expand data center capacity. This is Bloomberg Tech.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep. When we make hearts beat faster, and when we make them beat again. When we search for something, and when we find it. When we triumph. Even when we stumble. Iconic. When we get people moving. When we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
Connecting the dot between what's at stake and what is possible.
Compute provider Grok's just closed a new $750 million funding round, valuing the company at $6.9 billion, highlighting investor interest in companies seeking to alleviate a shortage of chips and computing power for AI workloads. Grok CEO Jonathan Ross is with us. And I always like to go back to basics with you, Jonathan. Like, Grok stacks up against NVIDIA and Google's TPU, and we're largely focused on inference. Why did you raise this round in that context? What is it going to allow you to do to be more competitive against those two giants?
Well, the bottom line is that the demand for inference is insatiable. The total amount of capacity that people are trying to deploy is mind-boggling, the numbers that people are putting up, and that's only growing. And in our case, we don't feel that we're competitive, we feel that we're differentiated. If you're not differentiated, there's no point. And in our case, what we're able to do is we're able to provide price performance. So when you're training these models, you don't need the chips to run particularly fast, you just need them to have a lot of throughput. In our case, we're able to provide both speed and throughput, lowering the cost. And when you're spending money on every single query, the difference in that cost can be the difference between profitability and losing money.
Inference meaning running the models as opposed to training. Have you done the math on that, Jonathan? How much inference does the world need?
It's insatiable for the reason that, unlike with the industrial age, where as you're producing oil, and compute is the new oil, let's be clear about that, you could only consume as much oil as you had hardware built that could consume it. In the generative age, every model that you train, you can scale it up to the amount of compute that you have available. As such, people are scaling as much as they can possibly get compute.
And so that compute needs data center capacity. Where do you add that? How much? Is it the US or internationally focused, Jonathan?
Actually, that's one of our primary advantages. So the GPUs that are being deployed today often need liquid cooling, and those are new data centers. In our case, we're deployed in North America, so the United States, Canada. We've deployed in Europe. We've deployed in the Middle East. Our first deployment in Europe was actually an air-cooled data center that one of the hyperscalers was moving out of because they couldn't put GPUs into it. Because we use so much less energy for our chips, because we produce so much less heat, we're able to take that data center on. And so that gives us this ability to get access to data center capacity in a very competitive way.
So the language processing unit, the LPU that you offer, I mean, you're taking on the TPU that you helped design over at Google, we understand, and indeed NVIDIA. Technically speaking, how is it achieving this, the run rate that you can get at a lower temperature point?
Yeah, so the architecture is very different. And I took a page out of what I learned at Google with respect to distributed systems. Everyone knows that Moore's law means that the number of transistors doubles roughly every 18 to 24 months. What I think not so many people have noticed is that the number of chips is more than doubling every 18 to 24 months. So we asked ourselves, if we were going to be increasing the number of chips, was there an architectural change that we could do? And the answer was yes. And so without getting into the technical detail, what we do is we take the models, the AI models, and we spread them out across a large number of chips. And that allows us to operate much like an automotive factory. And the more chips that we use, the cheaper it gets, the faster it gets. And our advantage is how many chips we can bring to bear on an inference problem. Now, typically, when you're talking about a training cluster, you'll talk about 16,000, 32,000, 64,000 GPUs. And the more GPUs that you can bring to bear, the better. That hasn't been the case in inference. Typically, you'll see 8 GPUs. And it's just a technological limitation that prevents you from bringing more. In our case, we're running some models for inference with 4,000 or more chips. And the more chips that we can bring to bear, the faster and the cheaper it gets.
Jonathan, has Grok signed any deals that would see you benefit from the commitments we've had in the last 24 hours in the United Kingdom at the hyperscaler level, and also some of the AI names that have committed tens of billions of capital to that market?
Yeah, so Grok has deployed some large clusters around the world. As an example, in the Middle East. And so we worked with Commerce to be able to get that deployment done, and they were very helpful, and we appreciate that. And also in Finland. Of course, we're looking at the UK very closely, and I'll actually be there in less than a week.
The world right now is GPUs and XPUs, or in your case, LPUs. Why do we need both?
The architectures are quite different, and they have different bottlenecks. No architecture is perfect. Right? This is why we don't use CPUs anymore for AI. We use predominantly GPUs and now LPUs. The difference between the two is that GPUs are very good at parallel processing. That is, if there's no sequential component to it. But when you're talking about language or other reasoning or logic problems, you can't produce what's called a token. You can't produce the 100th token until you've produced the 99th, or you can't produce the 100th word until you've produced the 99th. And that brings in a sequential component. Yeah. Now, CPUs have been good at sequential, but these problems also have a parallel component at the same time. What the LPU does is it's really good when you have both a lot of parallel and a lot of sequential components to the problem. And that allows us to output tokens at a very fast rate. And the experience difference, it's the difference between broadband and dial-up, but at the much lower cost than you would expect given the speed.
Jonathan Ross, CEO and founder of Grok, on their latest fundraise. We thank you for joining us today. Meanwhile, coming up, what to anticipate from this year's Meta Connect event, kicking off later today. From New York, from San Francisco, this is Bloomberg Tech.
In the last few months, there has been a lot of uncertainty, both on the geopolitical and obviously for the economy with the tariff. There's been a silver lining, especially in this region, around these events. Currency and bonds have been attracting a lot of attention in terms of performance. In general, it's been a pretty good performance for equities. And going forward, I will definitely remain positive around the Asian assets.
Welcome back to Bloomberg Tech. I'm going back to semiconductors. We talked in the show about how Nvidia shares are under pressure. Well, at the index level, they're putting a drag on the SOX, or Philadelphia Semiconductor Index. Over the course of 10 sessions, you're up 8.2%. But actually, as of last night's close, the SOX had its best streak of gains since 2017. As it stands, that streak's over. We're down 0.4% in the session. So we've gone from a story where we had AI-fueled growth on chips. Now we're getting concerned about China in particular, and over the next few days we should hear more because Jensen Huang, the CEO of Nvidia, is in the United Kingdom with President Trump, and Nvidia is at the heart of these negotiations between the US and China. It's an index to watch going forward, but it has seen a lot of momentum of late. Kara.
It has. Someone who's not in the UK is Mark Zuckerberg. Why? Because Meta Connect is kicking off later today. Analysts are anxiously watching for any groundbreaking announcement, like, well, maybe some smart glasses project. Brad Erickson, internet analyst at RBC Capital Markets, joins us now. Smart glasses has been where it's at from a hardware perspective for Meta. How can they push that story forward?
Yeah, I think it's just integrating more of the capability with Mark's vision on Meta AI, right? Like they've given some applications in terms of some of the translation capabilities, being able to, have some of the augmented reality capabilities. And I think you'll just see, we expect to see more of that tonight.
So really the vision of generative AI coming at the heart and why Meta AI is really amplified with the hardware story. But the competition's coming. We know Google's got them in the works. We know that, of course, Apple might or might not in the future. But Brad, therefore, what sets their deal with Ray-Ban apart? How can they continue to offer a little bit more to the experience than an augmented reality vibe?
Yeah, it's always going to come down to the same things that arguably made Apple so successful over the last, nearly 20 years, which is tight integration of hardware and software, right? Meta has the platform that people already know it for the various family of apps. They've created Meta AI, have more than 1 billion users. The utility that creates and the stickiness that creates for their customers, that's going to be the key thing. The hardware, everybody's going to be able to do, right? Just like they've always been with any piece of consumer electronics hardware. It's the software that's going to keep people coming back if they're going to come back.
Brad, thank you for bringing up Apple, and you also referenced translation. Last week at the iPhone event, Apple shares swung from a decline to positive territory, and Duolingo shares plunged when Apple demonstrated simultaneous translation through the AirPods Pro 3. A year ago, Meta demonstrated simultaneous translation through that generation of Ray-Ban Metas. Why did Meta not get the same credit for that technology that Apple did a week ago?
Yeah, I think part of it is just it was so new, secondarily, just relative to the stock. You've also got a giant core business, right, that you're comping, and that's clearly not going to be the focus of it, nor is it necessarily clear how you would yield an advertising business out of that. So I think that's just mechanically, that's kind of the primary reason. But clearly, this is going to be, a capability for a lot of companies here going forward, and certainly could be a super cool complement as, again, Meta looks to build in all these capabilities to these new glasses.
A lot of people still don't understand the Meta AI story. With ChatGPT, I just have an app on my phone or on my MacBook. I use it every single day, right? With Meta, I have a standalone app. It's integrated into Instagram, WhatsApp. I am an owner of the Ray-Ban Metas, a different interface or medium to use it. But do you see kind of what the end thing is going to be for Meta? How consumers actually interact with the work they've done on the model side?
I don't think anybody does, candidly. I think one of the things that I'm always struck by as we all study and learn AI every day is that, week by week, month by month, we kind of all have to expand our minds on what the capability is. Vibe coding is a great example, something we've been spending a lot of time in lately with the web design companies. People are using these things to develop applications, not to build businesses necessarily in the traditional sense. That's where everybody's brain would have gone. But they're creating daily productivity tools. Enterprises are using them to create actual internal work processes, right? Unrelated to their core software. So there's all sorts of new things. I think Meta AI is very similar in that, we know that it's going to be able to provide, like you said, ChatGPT functionality with the app. What we don't know is how else might people build that into their day-to-day lives, whether it's for work, personal or productivity or what have you, that's going to be value add and get to a point where you're going to say, hey, I can't live without this new capability in my life. And we don't exactly know what that is yet. We're learning about it. We're trying to sort of expand our minds, but we haven't gotten there yet.
Well, I mean, Mark Zuckerberg's been expanding the amount that he wants to spend on it and the appetite and ambition, that's for sure, Brad. And he's been given a pass. And you think the stock could climb even higher up to 850, another 9% gain on where we currently are. How much does the TikTok story bear into its bread and butter right now?
It matters, but TikTok is a very small business compared to the size of Meta's overall ad business. I will say that, for a quarter or two now in our channel checks talking with advertisers, what we have heard was, the stalled or the uncertain future of TikTok had really caused advertisers to pause any spending growth. They're still spending, to be clear, on ads on TikTok, but there wasn't nearly as much growth. To the degree that we get a deal here at some point, maybe that provides clarity, becomes a little bit of a headwind, but I don't want to overstate it because TikTok's still, somewhere in the, call it 10% of the business relative to the size of Meta's ad business.
Brad Erickson of RBC Capital Markets, thank you very much. Now, coming up, Lyft CEO David Risher joins us to talk about the company's new partnership with Waymo in Nashville that's coming next year. The stock is having a severe and big upwards reaction to this. We'll discuss it. This is Bloomberg Tech. Lyft and Waymo are partnering to bring self-driving taxis to Nashville. Customers will be able to request driverless rides on both companies' platforms, and Lyft will provide fleet management for Waymo's Nashville operations. Let's get to more with Lyft CEO David Risher. This is something you've been working on for some time.
That's right.
And the state of play is very clear. Waymo also has a partnership with Uber in different markets.
Yep.
You now have a partnership in Nashville.
Yep.
Just explain the rationale for you on why this is a great go-to-market for robotaxi.
Well, as you know, we've been saying for a while, we think self-driving cars are going to be hugely market expanding for rideshare. It's a really good product. And then when we looked at potential partners, of course, Waymo, has to be at the top of the list. The great thing about this partnership is it does two things. It supplies demand. So if you're in the self-driving car business, you got to have demand, and we got lots of demand every single day, and we do it in a very integrated way. But the other thing is, as you just mentioned, it supplies fleet management. And that sounds kind of geeky, but it's really important that every one of those cars be ready to drive, 24/7 if needed. And that's something we're really good at. We've been doing that for a long time.
So you're emphasizing the sort of capital light business model for you, right? The counter argument is the Tesla or the Zoox one, which is control the full stack, right. Hardware, software, operationally, the app the consumer interfaces with. Would you argue that you can scale this faster going this route, go to more cities quicker?
I would, yeah. I mean, this allows every company to specialize, right? So Waymo can really focus on providing great self-driving technology. The Waymo Driver is obviously a great product. They partner with OEMs, the car manufacturers, that can choose the best, car for them. And then we can provide the fleet management, as I say, that keeps the cars clean and charged and ready to go, as well as the demand, so that anytime a person wants a car, they can get one, or they can get a driver car, right? I mean, they can get both. So I think it's a great division of labor.
Let's talk about that fleet management, Flex Drive, because you're going to be building, you're going to be putting some capital expenditure to work, David. Yeah. Why does that make sense, and when will that be finished?
So we've been in the Flex Drive world. Let me explain for a second. So about a decade ago, Lyft decided that for a certain type of driver, it really makes sense to have cars that they can rent right on the platform. And they can we can take care of the maintenance and making sure that those cars are always ready to drive. So that's what we've been doing for about a decade now. So when we look at the autonomous vehicle world, look, when you see a car driving around the city, it looks like magic. It looks like no one had to touch it. But no, someone had to charge it. Someone had to clean it. Someone has to maintain it. Someone probably has to reboot it from time to time. And we're really good at that. So as you say, we're building a new depot there. We've got a small one. We're building a bigger one for this partnership. And what it does is it allows the cars to be ready to drive. Think about, so when you travel on an airline, and you know that, of course, they want the airplane in the air, but they also need it to be ready to fly at all times. They want that turnaround to be super fast, and that's what FlexDrive does. It means that people like Waymo can get the most out of their asset, which is super good for them.
Look, today, investors love this announcement, and the shares are rising. Shares have been doing well all year because you've had 3 straight quarters of profitability. David, how are you going to finance what is a little less asset light, is building these facilities to help keep all our auto cars clean?
Yeah. So as I say, because we've been in the FlexDrive business, the subsidiary business, for a long time, we've actually had capital deployed to that for a long time. We have about 24 locations in about 15 different states across the United States, which I think gives you a sense of how this kind of partnership could scale over time. And we own some of those cars ourselves. Others of those cars are financed by other groups. So the good news is this won't be a significant change to the current strategy. It's just sort of a re-vectoring, let's say, of the money we spend more towards autonomous.
Okay, scale over time. This morning, Bloomberg tech producer Marguerite Gallerini put this table together. You know the table, right? It explains the roadmap from here. So let's look at it together. This is 2026, and it focuses on Waymo principally, but there's you there, right? Nashville. Yeah. You are going to come up against Uber in negotiating with Waymo for cities that are not yet claimed for. What are the advantages that you're going to present to win that business with Waymo against Uber? And how much are you going to have to give up, to get a deal done?
Yeah. So I think the way I would look at that is one of the reasons we were so, I'll call it patient in working through this deal, because it took a while, we wanted to come up with something that is good for Waymo, good for Lyft, and good for riders. And that's hard to do. It's hard to have, kind of a 3-way win. We feel really good about it and feel like this is a great model for us to expand to other cities in the future. But look, city by city, some places we're actually going to compete with Waymo itself, right? Because, for example, here in San Francisco, they've got their own
Appreciate
app.
that admission, yeah.
Of course. So this is something that we have to kind of recognize and say, how do we come up with a construct that is really durable and, frankly, can benefit all the companies? And then the other guys will do what they do, and, we'll see who does a better job.
Look, people are going to accuse me of wanting to create a headline here, but it's a really important question. Yeah. Tesla and Zoox are committed to their own go-to-market model, right? We talked about they control the full stack. Yeah. But have you held discussions with both Tesla and Zoox to say, look, this is the model we're doing with Waymo. We can do something similar. Do you see that as being realistic?
So, of course, I don't want to comment on conversations we might be having. What I can tell you is we're talking to everyone who finds the partnership model interesting. You know, so there are, of course, always companies, whenever you see a new industry, you have some companies that say, I want to do it all. And frankly, if you look back a couple of years ago, just about every company in the self-driving space was in that zone. They wanted to do everything, you know, top to bottom. I think over time, most companies find, particularly when it's capital intensive and quite complex, like rideshare is and self-driving is, that a division of labor where everyone does what they're good at is the best model. But we'll see. Yeah. You know, it's still such early days.
But you struck deals with interesting players in Europe, Baidu. What's it like working with a Chinese giant? What were those negotiations like?
You know, that actually, I'll tell you what was very interesting. It came together fairly quickly. And in part, I think is, you know, frankly, Chinese companies are kind of built for speed. You know, they, for those of you who don't know, you know, Baidu, you can sort of think of them as kind of the Google or Alphabet of China. They have many businesses, but self-driving cars are a very important one for them. And we committed that we would roll out some of their technology in 1 to 2 markets we would expect in Europe over the next 12 months or so. It's still very early days there, but I can tell you they've got really high standards for their technology. We're super excited about working with those guys, and we'll have more to say about that next year once we start to roll out in Europe.
1 minute. How hard is it to get to New York?
I mean, I can take a flight there pretty easily.
but the auto, the robo-taxi, how hard? When am I going to have it here?
I love that. You know, it's going to take a little while. New York is a complex place to do business. The streets are complicated. You know, there's a lot of interest there. Look, you know this, Caroline. I mean, Lyft has been there for many years. It's super strong in New York. We also run the City Bike program, as you know. Super excited to bring self-driving there someday. But that was probably going to take a little while. Sorry about that. You're going to have to wait for a little while.
My addiction with the bikes will just have to continue. Lyft CEO David Risher.
There we go.
It's always a joy to have you on the show. Take care. Meanwhile, coming up.
Thanks so much.
The global data center build out, it is hitting maybe unsurprising records, of course, thanks to this AI boom. What does that mean from a construction standpoint? We've got the perfect CEO on next from procurement platform Kojo. This is Bloomberg Tech.
This year's Global Markets Conference theme is mega, making Europe great again. But the conversation is broader. We're in Hong Kong to hear perspectives from the US, China, Japan, as well as Europe. What we're seeing is clients diversifying their counterparties. BNP Paribas is headquartered in Europe, but we've been in APAC for 160 years. We're optimistic about working with our clients to turn these global perspectives into real, actionable, and relevant strategies for growth.
I mentioned earlier in the show that Microsoft will invest $30 billion in the UK as part of a push to expand AI infrastructure. We also heard from Grok about its data center plans. Of course, tech companies are pledging to build more data center capacity around the world. Let's bring in Maria Davidson, CEO of Kojo. It's the largest construction procurement platform in the US, giving her a unique insight into the data center build out. I think we can get to where you fit into the process of what is just massive infrastructure as a project. But that your reaction first to what's happening in the UK, it seems to be the next market in this AI cycle.
Oh, absolutely. I mean, when you think about how much potential there is in the UK, I think it is extremely exciting and very, very untapped. So I love to see companies like Microsoft and Google coming in and investing in the UK, and the US and the UK actually working closer together.
You say a lot of potential in the UK. Why?
I think because, one, there's extremely talented workforce in the UK, and you have world-class universities, you have incredible research like DeepMind coming out years before anyone would have expected an outcome like that in the UK. And so I think that means that in the UK right now, if we keep on investing, I think we're going to see a lot more DeepMind-like outcomes.
I've got to say, you've got 3 Brits around a table talking about the opportunity in the UK, so I'll diverse us a little bit because we're 3 Brits that sit in the US right now, Maria, and you're building businesses to try and make supply chains clearer for contractors, for builders out there. And I'm interested as to what the scale is like here in the United States and what the key bottlenecks are that you're trying to fix.
I mean, the scale is enormous. So just this year, we have $40 billion going into the construction of data centers in the US. That's expected to grow more than 10% a year. So by 2030, that's going to be $65 billion. That's unprecedented. And the biggest issue with building these, it's not getting GPUs. It's getting the materials and finding the electricians to be able to actually meet this demand.
Okay, so your role is ensuring that when the contractor, which is very hard to come by and labor is short and we've seen immigration policies hit that, but when you get them on site, they've actually got the pieces and the parts to work with. What has been some of the most complex areas when it comes to particularly the hyperscalers need and the data center build out?
It's a lot. When you think about the construction industry in the US, even though they're building some of the most sophisticated infrastructure out there, right, they're building projects that involve huge amounts of technology and AI infrastructure specific needs, they still largely have to rely on pen and paper and Excel to track where things are. It's hard to know what's arriving when, right? These are all huge challenges. And so when you couple that with the fact that there are 500,000 workers missing from the US construction workforce, and you couple that with the fact that materials on average are 44% more expensive than they were in February 2020 before COVID, that starts really creating a perfect storm.
I actually think it's worth going a step earlier in the process than what Caroline just asked about, right? We've kind of learned over the course of the last 2 or 3 years about how it works in the United States. You have a financing partner, you have someone like CrudeOil putting it all together. You need to select a site. Then you've got to talk to the utility because you need to power that site. The utility has to think about where they get the electricity from. Is that going smoothly and well, that initial process?
It depends. It's definitely gotten a lot faster. If you think about your average size data centers, right, or data centers on the smaller side, maybe 10 to 30 megawatts.
Right.
Those previously would have taken, let's say, 24 months to 36 months to build. Now you're seeing data centers built probably twice as fast, in part because things like site readiness, interconnection, they're all being dealt with in advance. Now, I think prefab is a huge subject here because the more that we can lean into modular construction, the more we don't have to rely on the sequential building, but we can actually build in parallel.
And there's also like a self-fulfilling prophecy in the sense that all of the AI names who actually just end up leasing the capacity, right? They don't even own the thing, but they would say, oh, all the work we're doing in AI is actually going to benefit the planning and execution of these build-outs. I guess that's what you'd say you also help with.
Yeah, absolutely. I mean, a lot of it is the better planned that you can be in advance, the better the project is actually going to go. And so if you know all of the components that you're going to need, if you have the mapped out schema, if you have all of those interconnection blocks ready to go, then, of course, contractors can be much better prepared.
I want to talk about you, about Kojo, about what the $94 million you've thus far raised, 600 construction companies that you're working with. You've just had an add-on to your Series C, I believe. How much are you seeing inbound? How much are you fighting off people wanting to put money into your company because they're realizing it's about bricks and mortar, it's about the very underlying infrastructure right now?
We're seeing a huge amount of inbound. The focus for us has always been, how can we empower contractors, right? How can we take the contractors that for a really long time were completely ignored by the tech industry? And specifically there, I'm talking about the trades, right? The electricians, the folks working in mechanical and HVAC and drywall. They, for a very long time, had very few solutions that were built specifically for them. And so for us, it's about saying, well, how do we build solutions that are specifically targeted towards you and that solve your biggest pain points, like knowing where your materials are and having the visibility of how you're doing against your estimates in real time?
Well, you're just completing a $10 million Series C extension. Come back when you're raising yet more, I'm sure. Maria Davidson, CEO of Kojo. It's great to have you on the show. Meanwhile, that does it for this edition of Bloomberg Tech. We've done a whole host of things, Ed, but we're going to count down to Meta Connect tonight. Of course, tune in tomorrow for an interview with Meta's Chief Product Officer, Chris Cox, live on the show tomorrow, which, Ed, you'll be doing.
Yeah, looking forward to that. I have a lot of questions about the relationship between software and hardware. After all, that is technology. Check out the pod. You know where to find it. On the Bloomberg Terminal, as well as online on Apple, Spotify, iHeart, and all kinds of other places on the internet. Thank you for watching. This is Bloomberg Tech.
This year's Global Markets Conference theme is mega, making Europe great again. But the conversation is broader. We're in Hong Kong to hear perspectives from the US, China, Japan, as well as Europe. What we're seeing is clients diversifying their counterparties. BNP Paribas is headquartered in Europe, but we've been in APAC for 160 years. We're optimistic about working with our clients to turn these global perspectives into real, actionable, and relevant strategies for growth.
continue to expect that we'll see the 25 basis point cut delivered this week.
The Federal Reserve opinion is 3% is neutral. My view is 4% is neutral.
The big debate there is, do they show one more cut after September, or do they show two more cuts? And I think it's going to be a very close call.
The risk is that the Fed ultimately won't deliver as much as they should.
I don't think anyone would be completely shocked by, a more dovish bias here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, it's Fed Decision Day.
Much slower. I've just signed his document and all of the papers, and Steve Myron is now on. I have a better instinct than him. If you look, all the economists got it wrong. I got it right. They should listen to people that are smart, but they have to make their own choice.
The president expected to get exactly what he wants, with that decision just hours away. We're live from the home of Bank of America here in New York City, where some of the very best of the firm will be joining us, including the man himself, the chairman and CEO, Brian Moynihan.
And honestly, John, to me, this is the key economic indicator. What are
versus the inflation data, or at least that's what those are some of the sounds we think we will hear and see in the summary of economic projections. But generally speaking, it is an environment where if the Fed is more focused on the labor market, as we think they will be, then rates are going to probably continue to decline even more than what is currently priced. Now, we think investors should be long the belly of the curve, receive the 5-year part of the curve, due to the fact that the market is only pricing a Fed that's cutting to a little under 3%. And we think, as we've discussed before, the market is underappreciating the range of outcomes that can exist below the neutral rate where the Fed says they will cut to. The Fed's independence does come into question when you think about these things, but we see risks, at least in the fixed income world, that this is a Fed that will be increasingly dismissive of inflation, focused on the labor market, use that to justify a string of rate cuts. And if that's right, and I tell Jared that, it sounds like risk assets are going to do really well, or at least that would be my expectation.
Mark is asking a really provocative question. Why would they stop at 3? I think it's the right question to ask going into 26, because this could be a very, very different Federal Reserve. Why would they stop at 3? And how hot are they willing to run this thing into next year?
It's difficult to make predictions, especially about the future and the mindset people will be in with economic data that will also be difficult to predict. I think the point about the opacity on the labor market is incredibly important here. Where the Fed might stop and why they might, I think, depends on the data. And the message that I get from investors pretty clearly is we care about total returns that we can take home now and risk that we don't have to think too hard about. And if you suggest an asset allocation or an investment policy that requires a lot of contingent planning for the path of policy, the path of the economy, it starts to look pretty difficult. We know that there's yields available in the market today on assets that are giving you reliable cash flows. You don't have to reach out for speculative growth into the future. You don't have to reach out for speculative duration in the bond market that requires a lot of planning around these contingent policy decisions. So more and more conversations with investors that we have are focused on where can I get reliable cash flows from a business that I can understand, where I don't have to make all these grand macroeconomic assumptions about policy or the economy.
If I can just add to that, one of the things that we have seen in the bond market, and certainly you all have noticed, is that there's been a bit of a bull flattening in the rates market right now, which means that rates are going down, but it's led by the very long end. Really dismissive of fiscal concerns, which were so prominent a few months ago. And what we think is happening, at least in the Treasury space, is that investors are reducing some of the steepening positions that worked very well. But to Jared's point, they're also reaching out and they're trying to lock in duration and coupon where they can. They're just trying to get those interest rates before they go down even further. And the market may not like the fact that it has to extend right now, but it's really trying to lock in where it can because it does sense there's a big turn in the rate cycle. And later this afternoon, we're going to see evidence of that.
Jared, I just want to ask whether the prospect of yield curve control or the suspicion that that could be deployed has killed bond vigilantes.
It may be the prospect of yield curve control. It may be expectations around fiscal policy and the widespread adoption of industrial policy that might be more productive if we can try a bullish scenario on for size, for once. whatever the range of catalysts and scenarios, I think it's pretty clear that the kinds of fears that we've heard about, some of us our entire career, haven't still been realized. Think about 7% budget deficits in peacetime, in an economic, and strong bull market, and the 10 years is so quiet. It's amazing for anyone who's been afraid their whole career about the bond vigilantes. When will they come? Maybe they're a much further distance off than. Well, maybe it's yield curve control that finally wakes them up. But if it's not that, it's always something else, isn't it?
If I can add on to that just briefly, there's been a lot of focus in the market, at least yesterday, due to some Bloomberg reporting, highlighting the fact that Stephen Miron, in his prepared remarks for his Senate confirmation, did talk about the Fed's third mandate, which doesn't get a lot of focus. But if you read the Federal Reserve Act, it is true there's a three-part mandate: maximum employment, stable prices, and moderate long-term interest rates. Now, many in the market believe that you don't need to focus on that third mandate because if you take care of the first two, on labor and inflation, then interest rates will be moderate. But the fact that that was mentioned has, let's say, awakened some to the notion that, oh, wow, maybe this is actually a precursor to the Fed using its balance sheet in very non-traditional ways. Now, that's definitely reading between the lines. There's not any elaboration on that, but certainly the market, I think, has been a little bit more open to that, and that may be, on the margin, contributing to some of the increased bullish sentiment at the long end of the U.S. rates curve.
This was a great way to start the programme. Gents, appreciate your time.
Thanks so much for being here.
Thank you. Looking forward to it. Plenty more still to come on this programme as we count you down to that Fed decision. Big question. How's the coffee?
Well, the coffee is great.
Yeah,
and honestly, it sounds like a video game. I love being on the trading floor because it always sounds like...
The sound of the Bloomberg.
Yeah. It's
music, right? It's a beautiful thing. It's a beautiful thing.
I love it.
Let's get you an update on news elsewhere with your top stories in your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thanks. House Republicans unveiled a stopgap spending bill to keep the government open past an October 1st deadline. The measure would keep agencies operating through November 21st and provide new funding for security. Democrats oppose the bill, increasing the chances of a shutdown. President Donald Trump announced a deal to keep TikTok running in the United States. According to the agreement, which has yet to be finalized, U.S. companies including Oracle, Silver Lake and Andreessen Horowitz would take an 80% stake in the social media app. China's ByteDance would own less than 20%, satisfying a 2024 U.S. law that required the Beijing-based company to divest. A close encounter for Air Force One on its way to the UK. A New York-based air traffic controller noticed a Spirit Airlines passenger jet flying at a similar altitude and on a converging flight path with the president's plane. The controller alerted the Spirit pilots to change course immediately. The planes were never in danger of exceeding safety thresholds. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the Bank of America senior semiconductors analyst, Vivek Arya. He joins us next, live from New York City, here at the headquarters of Bank of America, right here in the heart of Wall Street. This is Bloomberg.
In France, when we do something, it often ends up iconic. This radio antenna, for example, iconic. Or a gift to a friend, iconic. A little something for breakfast, iconic. When we aim high, when we go deep, when we make hearts beat faster, and when we make them beat again, when we search for something, and when we find it, when we triumph, even when we stumble. Iconic. When we get people moving, when we get the world moving. Iconic. Why? Because we do things our way. Stylish, bold, exploring, innovating, carrying our history and values into the future. Make it iconic. Choose France.
The Federal Reserve opinion is 3% is neutral. My view is 4% is neutral.
If the takeaway is that we're not starting 25 basis points per meeting, I think the market sells off.
If the Fed wants to cut rates to stimulate an economy with no excess capacity, they're just going to create more inflation.
The risk is that at some point next year, the Fed says, look, we have to actually hike.
We're looking for 25 basis points later on this afternoon from the Federal Reserve. Some people looking for 50. Standard Chartered, SocGen. They're the outlier that's going into this meeting. The big question for a lot of you is the guidance. Show me the guidance for 25 and beyond into 26. Can those dots come down from 2 down to 3?
Yeah, and will Stephen Myron's guidance be actually available to it? Will his dot be included? You asked me yesterday, what does his dot look like? Unclear whether we'll see it, because they had to be submitted on Friday. Do they make an exception for him?
We're going to find out a little bit later this afternoon. That's the big tease for the decision later. Just where is Stephen Myron's dot going to be? Now, Governor Myron, of course. Your equity market shaping up as follows. Equity futures on the S&P 500 just about unchanged. We've been treading water over the last 24 hours. A little bit positive on the Russell 2000, up by around about 0.1%. If you turn to the bond market, 2-year, 10-year and 30-year bond yields shaping up as follows. Twos have settled down around 350. The surprise of the last 2 weeks coming into September was the bull flattener that Mark Cabana was talking about. The long end of the yield curve. Yields starting to come in. We've got 10s around 4.
Yeah, and Mark Cabana talking about how a lot of investors are trying to lock in lower yields, as it does seem like the Federal Reserve is dead set on lowering rates. And the question now is just what's the limit? The question that I have is, when do bond vigilantes come back, or are they a fiction? Are they going to be a novel, not some sort of nonfiction creative endeavor?
Will they be crushed by the Federal Reserve in 2026?
Are they going to be crushed by yield curve control? Have they been crushed by circumstances that seem to have moved against them?
Yields down by about a basis point so far this morning. Let's turn to tech. What a run. A 9-day winning streak on the Nasdaq 100 halted just briefly yesterday. On tech, Vivek Arya, the senior semiconductors analyst at Bank of America, writing the following. The cyclical framework still broadly favors semis, but market volatility could re-energize investor debates. Vivek joins us now for more. Vivek, good to see you.
Good morning.
Good morning. Thank you for having us. Let's just talk about your sector. It is like the only sector in financial markets right now. It's where all the focus is. Walk us through why it's having such a good run at the moment.
Sure. I think, semiconductors are participating in every aspect of the global economy, right? AI is the most prominent of them. But if you take the role of semiconductors and automotive, right, that's a multi-trillion-dollar industry that is transforming with the advent of more electrified cars, right? And semiconductors today are only 2% of the cost of making a car. So think about where that goes over time, right? Industrial, look at things like factory automation, cybersecurity, medical instrumentation, right? PCs, servers, cloud computing. So what's happening is that as the global economy is getting more automated and smarter, I think that naturally increases the role of semiconductors in the economy, and we think this continues.
At the same time, we seem to have introduced